welcome from Chainlink Labs, Head of Tokenization, Colin Cunningham.
Good morning, and welcome to SmartCon 2025. Thank you all for being here. Thank you for giving us your time and sitting down with us over the next 2 days. And for everyone live streaming and joining with us around the world. We're excited to be here in New York City. Last time we were here, it was 2022. And I think it's fair to say a lot's changed. We're in a unique moment. We're in this moment where traditional finance, blockchain, digital assets, and infrastructure are converging. And there's no better place to do this than New York City, the epicenter of global capital markets. SmartCon stands out in what is a very busy week here in New York. Together with New York Blockchain Council, we're excited and proud to inaugurate New York's Blockchain Week, where we'll honor the past and what New York has become for traditional financial markets, while looking forward to the future and what Web3 and innovation will do for the city's future. And this is our biggest SmartCon ever. All right, we got 2,200 attendees, 71 fabulous sponsors, and 300 speakers. From traditional finance, Thomas Zschach from Swift, Dan Dene and Nadine Shakar from DTCC's Digital Assets, and Chris Perry from Broadridge. From the government, we have Patrick Witt from the White House, David Burt, the Premier of Bermuda, and Bryan Steil from the US House of Representatives. And of course, in Web3 and DeFi, we have Stani, the founder of Aave, Ed Felton, the co-founder of Off-Chain Labs, Joe Lubin, CEO of Consensus and co-founder of Ethereum, and of course, Sergey Nazarov, co-founder and CEO of Chainlink Labs. Across the world, traditional financial institutions, policymakers, and DeFi builders alike are building on Chainlink's platform to redefine how value moves and markets operate. Together, we're establishing the foundation for data, cross-chain interoperability, privacy, and compliance. And now, this entire ecosystem that we're building together is bringing together in this room the most forward-thinking and brightest minds in global finance and Web3. SmartCon is more than a conference at this point. It's truly become where the future of our industry takes shape, where ideas lead to infrastructure, and where innovation becomes reality. The world's assets are being tokenized. No one cares about that more than me. Payments are being programmed. And markets are growing more transparent, more efficient, and more liquid than ever. Over the next 2 days, together, we're going to explore how Chainlink is at the foundation of it all. How tokenized assets are unlocking liquidity and opening new markets. How on-chain payment rails are reducing counterparty risk. How interoperability across blockchains and traditional financial systems is becoming the bedrock of the next financial infrastructure. And how financial institutions, policymakers, and Web3 are coming together to define the new global standard for trust and connectivity. So use this time challenge assumptions, share insights, build partnerships. Because if you can envision it, you can build it on Chainlink's platform. So what we do here together over the next couple of days will set the course forward for our industry for years to come. So on behalf of Chainlink, thank you all for being here with us. We look forward to connecting with many of you in these halls and in various side events around the city throughout the next 2 days and throughout the week. And now, with that, we'll officially kick off SmartCon. I'd like to now give it over to Representative Bryan Steil from the House of Representatives, who has a message for us from DC. Thank you.
It's great to be with you for Chainlink's 2025 SmartCon. It's Congressman Bryan Steil, Chairman of the House Subcommittee on Digital Assets. The future of blockchain is bright. We're living through the transition from centralized internet of Web 2 to the decentralized world of Web 3, where blockchain innovation will drive the next generation of the digital economy. Tokenizing real-world assets can make markets more efficient, reduce transaction costs, and open new opportunities for investment and ownership. Just as the U.S. benefited from being the home of the giants of Web 2, we need to ensure the future of Web 3 is built here in America. To realize that goal and the full potential of blockchain, we need regulatory clarity and a framework that encourages innovation while protecting consumers. That's why Congress has been working to provide clear rules of the road. The Genius Act, which passed Congress with strong bipartisan support and was signed into law in July, was the first step, creating a framework for the issuance and operation of stablecoins and bringing legislators, innovators, and consumers together to strengthen U.S. leadership. The next step, that's clarity. That's the Clarity Act, which will establish a clear market structure for digital assets. The House has already moved this bill forward with more than 290 members voting in favor, and we're working to advance it through the Senate. Our goal is simple: ensure the United States leads the world in Web 3, not by creating a regulatory structure that penalizes innovation and novel ideas, but one that rewards them. Certainty will enable you, the innovators and developers and entrepreneurs, to build here in the United States and secure U.S. leadership in digital assets. We want an environment that encourages innovation, not in boardrooms and law firms, but in basements and dorm rooms, where the next generation of builders will create the future of finance and technology. I look forward to seeing what we will create, what you will create, and how you empower the future of Web 3 here in the United States. Thank you, and enjoy SmartCon.
And now, please welcome your MCs from Chainlink Labs, Zubin Pretap and Zaji Reyes.
Good morning and welcome. Thank you for joining us at SmartCon 2025. I am a huge New York fan, so SmartCon is the high point in my life, and then SmartCon in New York. What more could I ask for? How are you doing today, Zschach?
We're great. Super excited to have you all here. As Colin just mentioned, we have more than 300 speakers today from traditional finance, DeFi, government leaders, and more who will be taking the stage. Before we go any further, we want to thank our title sponsors, Swift, Euroclear, and Space and Time. We would also like to thank our platinum sponsors, Aptos, OKX, Plasma, Polygon, The Graph, and XLayer, and many more who have helped make this event possible.
And I want to remind you all, you can all get a chance to win a free ticket to SmartCon 2026 by scanning that QR code up on the screen. Okay, so the winner will be chosen during Apurva's keynote speech later on today. And while you can scan that, there are other things that you should know about that's going on, right? So the Build to Scale Village is outside the expo hall, the Chainlink Platform Hub on the 3rd floor if you want a deeper dive on the platform. The Fidelity Networking Lounge is on the 4th floor, and the Link Luncheonette sponsored by Polygon, on the second floor for some delicious treats.
And this year, you can connect with others by tapping your Click badge. So at the bottom of your badge, you'll see a little device which you can actually connect with others. It will also light up throughout the day to indicate that lunch is starting and that we have special keynotes on the stage. So make sure to pay attention to those colors. Tag @Chainlink Labs and hashtag SmartCon on all of your social media posts. And we are giving away a limited amount of Chainlink beanies. So make sure to show your SmartCon social posts to the front desk to be eligible to win one. Let's kick things off with our first discussion from Hype to Rails, a decade of digital assets. We have of Chainlink Labs, Fernando Vasquez, and of State Street, Donna Milrod.
Good morning, New York.
Good morning, New York.
There you go. I would like to start by thanking you for joining us today, both in person and remotely. I'm very honored to have a very distinguished guest today with us to open the conference, Donna Milrod. Donna is an executive vice president and chief product officer at State Street, responsible for leading the strategy, value propositions, and growth at her asset servicing business, including digital asset solutions. Donna is also a member of State Street's executive committee, which is the company's senior leadership team. During her distinguished career, she's held leadership positions at Deutsche Bank, DTCC, and also senior advisorships at Broadridge, McKinsey, you name it. You have a pretty long, ABC, so I'll stop there, Donna.
That just means I'm old.
There you go. So from Hype to Rails, Donna, both you and I have been working on this industry from the traditional finance side of things for quite a while, more than a decade. And during that time, DLT technology has evolved from being a niche experiment, something that many people thought was a toy, a gimmick, to something that has the potential to become a pillar of institutional infrastructure. Could you tell us, from your perspective at State Street, what were the key developments and turning points that enabled that shift?
Yeah, so I think, prior to maybe 2022, it was like the realm of the true believers, and folks really focused on crypto primarily and all that promised. So as you said, kind of niche players, et cetera. And then you had to go through the bumps along the way with any new technology. So you saw kind of culminating with the FTX debacle in 22. And then you had the beginning of the crypto winter. So from a traditional bank perspective, we're a pretty big custodian. There was interest. We definitely participated in trying to understand the technology behind cryptographic rails. And that was super promising, but then with the crypto winter, everything kind of slowed down. And then you saw the age of regulation. So all around the world, you saw regulators kind of climbing onto this technology, as well as kind of cryptocurrencies more broadly. So you saw MiCA, you saw things happening in Asia, you saw the New York Bit license come around, and then culminating in 2025 with this current administration, with the Genius Act. And then the Clarity Act to come. And I think you've also seen, from a US perspective, the regulatory shift in attitude. I think Mickey Bowman and our new head of the SEC are very proactive and very focused on how to make this technology pervasive and open to all the players in the markets, especially their focus on kind of U.S. remaining a leader in financial markets. And now you see big banks kind of coming into it, institutional investors getting into the tokenization game, tokenizing real-world assets, but not just that, like trying to figure out other ways to take advantage of this technology, finding new distribution paths, et cetera. And then you see the market infrastructures coming to play, many of whom are sponsoring your conference. So I think where we are this moment in time is really about figuring out how to get the best of both worlds, both TradFi and DeFi, together, and I'm hoping that we talk about that during our session.
I also would like to further something you just said. Some people assume that it was only after this shift in Washington that banks start to get interested in this. But banks like SmartCon have been working this for almost a decade. You make significant investments back in the day.
Yeah, absolutely. I mean, we've been, I think about this, I think you asked for the past decade. We've definitely been at this for over a decade. And again, like, I don't think as with any new technology, you don't understand all the risks at the beginning of it. So you start with experimentation, and then over time things evolve. And I think you'd see, even 2 years ago, you'd see the beginning of what the infrastructure would actually look like. And and I wouldn't say we're there yet. We have plenty more to go.
We'll get into that later. I'd love to know what are the lessons that you learned during that journey. And kind of related to the scale that we think more clear regulation is going to enable. I have a thesis that I would like to put forward, and please let me know what you think, Donna. So I think that having agreed upon standards for data, interoperability, privacy, and compliance will be critical to enable the adoption of stablecoins, tokenized securities at a scale. What am I missing here?
Well, I mean, what's wrong with your thesis? That makes perfect sense. So I think it's important to kind of step back a little bit and remind ourselves what are the inherent principles within TradFi that are really important to take into a Web3 environment. And I think, as I said before, we've learned a lot of lessons. So assets, institutional investors, for adaptation to happen, for adoption to happen, you need to have some of these principles. You need the institutional investor to come in, not just the retail investor to come into Web3. So in order to do that, you have to ensure that assets are safe, right? Our big banks, our institutional money managers, our asset owners are protecting the individual investor. So they have to make sure assets are safe and that you can do that at scale. Records need to be accurate, and as I said, investors need to be protected. So when we think about, maybe something that would be helpful is when you think about traditional finance, think about kind of 3 main principles. One is this notion of safekeeping of your assets. So custody should be independent from trading. Client assets should be in a bankruptcy remote environment, and protected, and you need to be able to have a real auditability, and the custodian chain of ownership needs to be clear. So assets need to be kept safe. The second is around governance and accountability. You need to make sure that the firms that are playing these roles have, really are well capitalized, that they're resilient, that there's good compliance standards, that you know who your customer is, all that kind of stuff. So really good governance and accountability. And then the third is really that scale play, infrastructure at scale. And that, TradFi is defined by that. It's been years and years of fragmentation that slowly has been pushed out of the system with kind of more centralization, more standards around data, about operating process, around infrastructure. That way you have real, kind of predictability on how things settle and settlement finality, et cetera. So if you think about that, those are the best features of TradFi. The most important thing to do is figure out how you bring that into a DeFi world. We have $315 trillion in assets under custody globally. That's $315 trillion. I think when DTCC comes up, they can tell you how many transactions flow through their infrastructure every day. It's in a quadruple millions measurement. There's no way you're going to get adoption on Web3 without those 3 principles being cared for. So getting to your question and your thesis about stablecoins and tokenized assets, I actually view that as the bridge between TradFi and DeFi. And you see that happening every day. But the reality is, even in a stablecoin environment, even though there's $4 trillion kind of in the marketplace today in stables, they're really only used for, cryptocurrency transactions. So they're not really there yet. Yep. But every single day, progress is being made. And I think tokenization is doing the same. It's helping the world's investors and the players within that financial services ecosystem to take those real-world assets, bring them into a Web3 environment, get the advantages of Web3, but not lose what I just talked about, trust at scale.
I would like to ask you about a custody. Because in many cases in crypto, people might tell you, your keys, your crypto, your keys, your asset. But you're telling us when it comes to institutional players, they want custodians, qualified custodians like yourself, right?
Yeah.
Do you see that role changing over time, or
hopefully
how do you see
they'll still want
out?
our custodians. Will it change over time? I think the role of the custodian will definitely change over time. I mean, how could it not? But again, I said 315 trillion. This will be my third time saying it. There is no way the institutional investor is going to transact in an environment where they don't have someone that they trust. It's just not going to happen. I guess that's my thesis. Do you agree or not? You can tell me. But
no, we have seen that. I think for retail, self-custody is here to stay. But in many cases, the big institutional players, they're not good at doing custody. That's not what they do, right? So I think banks like yours will be key enablers for a DLT-based financial.
And I think custodians play a role, definitely have a role to play, not just as a trusted counterparty, but again providing that bridge between traditional and traditional finance and digital finance, as well as within across chains. We've done that ourselves in trying to advance the liquidity in tokenized markets with what we did on Kinesis with our being the first third-party custodian to connect to a third-party blockchain for fixed income issuance for an institutional investor. And we'll continue to do more of that because we believe in Web3. And we believe in that role that we play, both as kind of bridge between traditional and decentralized finance, as well as between chains. That's what we have to do for our clients.
Something that we really like about Web3 is that it brings utility to token holders. Because at the end of the day, even for institutional players, why would you become a token holder? You can have the option of buying an asset in a traditional format. Why bother? And I think Web3 has shown the way there. The Web3 ecosystem has been trailblazers, I would argue. You as a token holder have access to lending pools. You have mobility cross-border, which is instantaneous, right? I think that's something that traditional funds should aspire to. But to get there, we need compliance. You said, Donna, we as Chainlink developed something called ACE, the Automated Compliance Engine. And that's one of the reasons we did it. Because we want to automate all of that. If you keep doing things manually, again, in brute force, this is not going to scale. No. So having compliance at a scale, for me, is the technology to keep an eye on for the next few years. I know it's boring, it's not sexy, but that's what, again, I would argue is going to move the needle there. Just to touch upon compliance, privacy, you name it. But in the early days of blockchain, one of the foundational principles was that greater transparency is achieved through on-chain data. But the financial industry has pretty stringent auditability and permissioning requirements. So how do you combine these privacy needs of institutional systems with the transparency of public blockchains?
Yeah, so I think that the theme is very similar about how you bridge the best of both. And I don't think that you necessarily need to be rigid about that. This concept of them being diametrically opposed. So I think you're starting to see how, especially within the layer 2 world, we're trying to figure that out. So we, as a kind of industry more broadly, are trying to figure that out. So you see layering architecture happening where standards are kind of embedded in that layer 2 place with compliance. You see within smart contracts, for sure, you start to see both notions of permissioning, auditability, all the things that I just talked about. And again, bringing that transparency in the system that you get from kind of a level 1, making sure that that layering ability that is starting to emerge, really gets the best of both worlds. I'd say protecting privacy and those tools are kind of in its infancy. We need to figure out how to reduce the loss of theft. And of course, corruption and bad actors. So I think you're starting to see those compliance features again making their way into smart contracts. So that it's just kind of a different way of thinking about it. But like again, if we go in with the mindset, I guess maybe two things. One is how do you get the best of both, but also don't create fragmentation, which is something I've been talking about for years now. I always maintain that we, as financial engineers, are really good at creating fragmentation, and then people then spend decades and careers figuring out how to fix fragmentation. So my call out to everyone who's listening today is, please, no more fragmentation.
Actually, I would like to double click on that, on fragmentation. What I've seen in certain countries, and I'm investing in Japan and in Tokyo for more than 2 decades, I've seen a lot of consolidation when it comes to the blockchains that institutional players like to work with. And so I see this constellation, to be here to stay, and then maybe the US and will have its preferred 3-4 chains, the same in Europe, same in Japan. But at the end of the day, nation states do care about sovereignty, right? So in certain cases, what the country says or regulator says is kind of move the needle in terms of what the director of State Street end up choosing. And if you want to transact on cross-border, you might end up in a situation where, okay, there's no fragmentation maybe within the US or it's limited, but you go to other countries and they're using something completely different, right?
Yeah, but capital markets don't work that way. They're not regionalized. They're not, sovereign. So it would be naive to think that we won't figure that out. We're really smart people. We figure this stuff out. So when Swift comes up and talks about it, I'm sure they'll give you a little bit of a history lesson of how Swift came about. And I am sure something similar will have to happen in a Web3 context. Capital markets just don't see borders. So we have to create standards. We have to get a regulatory environment that is consistent. It doesn't all have to be the same, but it has to be consistent so that capital can actually flow freely. That fragmentation that is, I think, detrimental to the outcome we're all looking for, it puts more pressure on the need for interoperability and, kind of these governance standards that are consistent.
Yeah, I would agree. There's also hope that, especially on the tech side, there's going to be a convergence, right, and standards will be created. We at Chainlink are very committed to work with, not only regulators, but standards bodies like, ISO, eventually NIST, you name it, to make sure that, again, we come up with the technology stack works not only in the US, but globally. But I would argue that we'll still have some degree of what I call legal, differences between different countries, right? Just like we have today in traditional capital markets, that's pretty clear to say. So we might need legal wrappers and translation, legal interpretability, right? Yeah, and
I think programmability is not to be discounted. I think this is where you can kind of see these things taking effect. Like I think about the MiCA rules and what's happening in different countries in Europe around protocols for smart contracts. Some of that is best practice. Some of that we're just still learning on and it's still evolving. I think when you hear from Bermuda, for example, they have a really interesting kind of forward-looking framework for a regulatory environment where you can get some of these critical features that are so important for trust at scale, for adoption of Web3 protocols. So there's a lot of examples out there, and I think, again, we're in this time of transition.
So one thing regarding privacy, we as Chainlink, we support chains that provide privacy by design, things like the Canton network, and also layer 2s that use CK proofs. And we think at the end of the day, it's going to be the customer, it's going to be State Street, institutional players who will decide what's the best technology for them. Also, I'd like to keep talking a bit more about custody. Institutional adoption often hinges on trust and robust custody solutions, as you said before. How does digital asset custody mature, and what gaps still remain before it achieves full mainstream adoption? So that you tick all boxes for your institutional players who want you guys to keep holding their assets on.
Yeah, so I think it's a principle. You have to stick to the principles. So I said it before about how you safeguard assets. I mean, every custodian has to do that, whether you are a digitally native custodian or you're a more traditional custodian. Again, you remember safeguard assets, governance, and scale. So I think you're seeing a convergence happen there too, just very slowly. And I would just say, maybe I'm talking my own book, but like you need to have a level playing field where everybody is, operates on the same rules and same principles. That's what clients want, right? They want to make sure their assets are safe, they know where they're going, and they get there with some finality, and that they're being supported by institutions that have strong capital, really good resilience, good compliance programs, et cetera, and that they can do it on a scale basis so that as new products come along and innovation happens, their trusted counterparty can take care of that at scale. So those are the principles. So when I think about what we're doing at State Street to get into the digital custody business, which we'll have our platform ready by the end of this year for both tokenization and custody, our role hasn't changed in our view. It's just the technology that's changing. And I think that's true for kind of many of my peers. And then I'd say on the digitally native custodians, you see them coming to the banking regulators, getting banking licenses, thinking about how they're going to capitalize themselves and conduct themselves within a regulatory framework that's the same for all. I think there's a lot of talk in this administration about self-custody, that people shouldn't be precluded from doing that. In my view, that's really a retail construct, not an institutional construct. You would never see an institutional investor custodying their own assets.
Do you see the way you engage with your clients changing by starting to hold assets in the tokenized format, or do you see the process is staying the same vis-a-vis your institutional clients?
Yeah, so our clients depend on us to do all the processing. They don't do anything. They give that to us to do. And I'd say that there's three groups of clients. One's who are complete followers. They just don't have, kind of the resources to really, go into digital full on. Then there are the people who are, at the bleeding edge, who, love to experiment, and they've been out front. I think many people see tokenized money funds as disruptive to ETFs as ETFs were to mutual funds. Given what's happening in distribution and how fast it's growing, I would say that's probably right. And then there's those in the middle. They want their infrastructure players, their service providers to figure this all out for them, and then they'll come along and they're curious. So I'd say that, I wouldn't say that they're changing the way they operate. They're expecting us to change the way we operate for them.
I think that's going to be good for us to be able to scale. You can be the enabler for those institutional investors. That means there's going to be more adoption. And as you guys connect to utility venues that are inspired by Web3, I think there's going to be more demand for tokenized,
I agree.
securities.
And you see that every day.
So we can get the flywheel going. Again, busy question of time. The last decade has been quite bumpy. It's not only FTX. A lot of things happened along the way. But as we look forward to the next decade, what do you see the most practical, enduring opportunities for digital assets?
Yeah, so I said this already, but we're in a time of transition. So I think there's a lot of innovation happening, a lot of adoption that's happening every day. And as you see more move into the institutional realm, you'll see more of that. More tokenized funds, more tokenized assets of all kinds, and new ways to distribute on different chains. And hopefully, we will figure out a way to make them all interoperate so we can figure all of that out. I'd say the one thing that's definitely on the horizon is new technology, yet again, that will maybe displace or look like Web 4. So, quantum is a pretty big threat, I think, from a cryptographic world. So I think we think about that a lot, especially with respect to data and data security. And then I also highlight agentic AI. I just came from another conference in FII in Saudi Arabia last week, where there was a lot of discussion about a future, imagine a future in Web3 where you have an AI agent talking to an AI agent conducting transactions that's programmed. And there's none of us are around to do any of that stuff. So I don't think we've even contemplated what that looks like yet.
So with that said, I couldn't agree more. I think data security, trusted computing, compliance will be playing a key role. And we at Chainlink are developing products like ACE and also private smart contracts. So please keep an eye on that. But I don't want to steal the thunder from our CTOs and CPO. So I'll leave it at that. Thank you again, and enjoy the rest of the conference.
Thanks.
Thank you. It was a pleasure. I think we should supposed to go for the front.
Thank you, Fernando and Donna. So next up, we've got a panel on infrastructure that's going to be on reinventing infrastructure for the on-chain economy, next-gen asset management, and that's going to be moderated by Colin again. So please welcome Colin to the stage.
Morning. All right. We're talking asset management, we're talking infrastructure, and we're talking on-chain. Before we get into it, I want the great panelists that we have to introduce themselves. And Mark, we will start with you. Go ahead.
It sounds good. Thanks very much for having me today. I really appreciate it coming in virtually to you all. Mark Garabedian. I head up digital assets and tokenization for Wellington, and I've been in this role since 2022. And my background prior to that is trading. So I traded for 2 decades. I've traded everything, every which way, all across the globe. And that gave me a lens into the plumbing of the current market structure system. And so I was able to understand how this technology can disrupt and make the new system more efficient. Thanks for having me.
Thanks for being here. Matt?
Thanks, Colin. Good morning, everyone. Matt Horn. I have the privilege of running the digital asset strategist team at Fidelity Digital Asset Management. I've been in the role 6 years, and previous to that, I was 7 years with traditional ETFs.
Hey, everyone. I'm Will Peck. I'm head of digital assets at WisdomTree.
Hi, all. Kathleen Wren. I'm the global head of digital assets at Invesco. I've been in the role for about 4 months. We're creating a global digital assets team for the first time at Invesco, but I've been in the space since 2019. Before Invesco, I've been at JP Morgan and DWS working digital assets, and been in asset management for the better part of 2 decades.
All right, here we go. Mark, first question's coming to you. As we look at where we're at in the cycle, or where we're at in digital assets broadly, we're seeing this shift in moving on chain. Talk to us a little bit. What are some of the operational challenges and some of the infrastructure challenges that you all have seen and kind of encountering at Wellington as you're moving through this new paradigm?
It's really, if I was to sum it up with one phrase, I'd say technology debt. And when I say technology debt, what I mean is, institutional asset managers, we're all well-oiled machines. We have systems, we have processes, risk controls, compliance, end-to-end frameworks, things that are coming in that we're being ingested, things that we're pushing out the door, but they all work harmoniously with each other, and they're all built effectively on the same technology stack. And on-chain finance disrupts that because it really is an entirely new technology stack, and it represents an entirely new end-to-end process. So the largest hurdle that we're facing is not just that you have to build to this new technology stack, but how do you integrate it with your legacy technology? Some institutions, particularly the trailblazers, have built things that sit separately, completely outside of their systems, and so you have 2 systems that are running in parallel, and that's difficult to do. Some folks are embarking on having that sort of full broad integration so that everything works seamlessly together. But you know, from my lens, I think it's those legacy systems that we have that we rely on so deeply and fundamentally across the firm. Where do you pick and choose to replace them? How to integrate them, and how to have, you know, a new system set up for the plumbing.
Anyone else on the panel have anything to add from that view?
No, I would just say, you know, tokenization has really, I think, reset my thinking around, you know, what does it take to run a fund or an investment product, right? You, as an asset manager, you create investment IP, you merchandise it through a vehicle, and then you sell it to clients. A lot of that doesn't change with tokenization, right? Tokenization doesn't really obviate some of these responsibilities, but it does pose synergies and scalability benefits, but also some new challenges too to kind of merge it all together with the legacy system.
Yep. Now, Will, I want to come to you and talk a little bit about one of the benefits of tokenization is kind of taking advantage of smart contracts, creating these on-chain, effectively like tokenized portfolios, if you will. You've been at WisdomTree a good minute. Talk to us a little bit, just as y'all are thinking about some of the innovative products that y'all brought to market over the past couple of years. How are you thinking about creating kind of tokenized portfolios of the right type of a basket of investments for kind of this on-chain or digital future that maybe your clients want to access?
Yeah, absolutely. So, you know, WisdomTree is we're the world's largest independent ETF sponsor, and that ETF DNA is really core to what we do. So I think a lot of us take it for granted today, but you go back 20 years ago when WisdomTree was kind of founded in its current form, and ETFs were just a small fraction of what they are today. So today there's something like, I think nearly $20 trillion worldwide in the ETF wrapper, and back then there was something like 200 billion. And so our approach to tokenization was kind of looking at it in a very similar way. Of saying what's going to be this like next disruptive wrapper in asset management. We came pretty quickly that it was real-world asset tokenization on public blockchains that had the potential to do that. And I think a real key point in terms of like, so why were ETFs so successful? And I think you know, some people might say cost, and I think that misses the point a little bit, because there's always been low-cost Vanguard mutual funds, right? To me, it was about a new, different user experience in financial services, right? It was that all you needed to access an asset anywhere in the world was a US brokerage account. Then you could buy Japanese stocks, you know, Korean bonds, whatever it might be, you could do that through your brokerage account. And we see a similar pattern playing out with kind of an enhanced user experience and enhanced distribution with tokenized assets, where all you need is a wallet on your smartphone, right? And you can access an asset anywhere in the world. And there's a lot of benefits that come with that standardization. So for us, I think it's never really been about, oh, let's cut out a couple basis points from the cost and pass that on to customers. It's all about, can you create a new, different, better user experience for, you know, whether it's a subsegment of people who want to engage with your asset management products. And that's really what we're focused on. You know, we manage nearly $700 million today in tokenized real-world assets, one of the largest providers out there. And it's very early innings in that. That was a long answer to a simple question.
No, I was just reflecting on how very early the inning is. Yeah, it's a good point. Kathleen, coming to you for a second, right? Like one of the things that we think a lot about at Chainlink, and one of the things I think about, even what Will said there, right? When we're creating these investment portfolios or bringing these tokenized assets to on-chain, right? We have to start creating some type of standard, right? By which how we kind of interoperate globally, move across jurisdictions. Tell us a little bit, just when it comes to like standard creation or creating kind of operations on a global basis, how is Invesco thinking about that as we think about kind of like on-chain asset management?
Yeah, I think that comes from collaboration.
Okay.
So maybe take a step back. I think there's really kind of, for asset managers, why the time is now is because there are really 5 key themes that are playing out in real time. The first 2 are growth factors, and the following 3 are kind of driving factors for those growth factors. So I think as we all can agree on this in this room, stablecoins have found product market fit, 10x over the last 5 years. It's exciting now with more institutions, jurisdictions launching regulated stablecoins. What's going to happen there? The second is the tokenized funds really are getting significant traction. It will almost double since over doubled since the beginning of the year, which is very small, 35 billion relative to traditional finance standards, but it's really meaningful progress. But those are 2 growth areas. But 3 driving factors are that blockchain infrastructure is really institutional grade now. So a lot of the collaboration we would do with Web3 partners really has the scalability, security, and compliance that we need to really build meaningful progress. Second is regulatory clarity really is here in a lot of jurisdictions and is developing across globally. And then finally is where, you know, asset managers being able to partner with on-chain providers is really a big unlock, because we can really innovate and iterate much quicker than if we were to build everything internally ourselves. And so that's where collaboration, whether it be around launching new products or creating global operating standards, is really critical, both as asset managers together, but then also with industry partners and regulators as well.
Got it. Maybe a question for the group, just when you mentioned stable coins and also tokenized funds, where do we place or how do we think about like tokenized deposits and what they mean for on-chain asset management in the framework of what you provided? Like how important are those in the context of what y'all are doing on a day-to-day or kind of looking forward basis?
I think that's kind of an open question. Like I think with Genius Act's given stablecoins, much greater clarity in terms of like a form of money, right?
Yep.
And frankly, like a very secure, safe form of money, given like kind of the narrow banking elements, right? And so I think I sometimes wonder if tokenized deposits are kind of a solution in search of a problem in this space. I think the example that we're seeing the most kind of utility for those is kind of certain financial logistics types of transactions where there is value in a bank being able to issue commercial bank money on chain. But I think that's different than how some people think about it, where they're like, oh, I'm just going to be holding like, name your big bank tokenized deposit in my MetaMask. Like, I don't think that's going to be how it's going to go. I think they're more going to be used for like financial logistics use cases is my kind of take on it.
Yeah, I would add, there's a lot of ways we're thinking about the future, and it's hard to know with certainty where this goes, but right now I think there'll be money at rest and money in motion. Money at rest will be in a money market token type product where you're earning a yield, roughly 4%, call it, and money in motion will be in stable coins, right, moving around this digital economy. And maybe there'll be different elements of that money at rest, right, whether it's tokenized deposits or money market token. So I think that's sort of where we're at right now, thinking through it.
And I think when you think about whether it's tokenized deposits or stablecoin, really it's programmable money. Right now, the key use case is payments, but over time, you're going to have more utility for that, that's where I think more tokenized funds come into play for more demand.
I'll just add in too, I think we all know distribution is the biggest key to this, and so it's like, whichever one proliferates the most. It could be stablecoins, it could be tokenized deposits. It's wherever the money is going to have access to the most areas of the economy and areas of the world is going to end up being the chosen path.
Yeah, well said by all. Matt, I want to come to you thinking a little bit about tokenized money market funds and how do we port on-chain some of the regulatory requirements that we have to have around money market funds? What are some of the compliance standards that need to be met? Obviously, Fidelity's brand speaks for itself on a global basis, and that's something that's been built up over quite a long time. So, especially for Fidelity, just give us some insight maybe into how you're thinking about what do we need to see on chain, right? As we think about embedding compliance or thinking about regulatory, giving the regulators what they need in order for these money market funds to perform on chain in a way that unlocks some of the utility or accesses some of the distribution that Mark's talking about.
Yeah, sure. So I think when you do something like this and undertake a task of tokenizing a security like a money market fund on chain, you have to approach this with certain design principles in mind. So Fidelity is very client-centric. We always have been. We're so very protective of our clients and their information and their best interests. So that was sort of foundational right there. But also you have to bring your legal risk and compliance teams along to make sure you're doing things in a compliant manner. Because as I said before, just because things are in this new chassis, this new token wrapper, it doesn't obviate your responsibilities from regulatory standpoint. So I think having everybody at the table to build these things from ground one was really important, right? Now, there are enhanced efficiencies you get with this technology, and I think for the time being, we still operate ours in a traditional way with the on-chain version as a digital twin. So we still kind of have both records and official processes in place. But over time, it will migrate more on-chain. That's just the direction of travel here, no doubt, right? But we're going to do it thoughtfully and slowly and make sure we get it right, because, again, you have responsibilities here as an asset manager.
We issue a tokenized money market fund, one of the largest in the world right now. Ticker's WTGXX, WisdomTree Treasury government. No government, just WisdomTree Treasury money market digital fund right now. And I expect this to be one of WisdomTree's largest funds in 3 years. Like, I think there's true product market fit in this space. Like, people have found like the yield generation, the kind of ability to do native peer-to-peer transferability, the ability to compose this in DeFi to be extremely valuable. And I expect, especially as stablecoins continue to grow, that billions of dollars at the least are going to flow into this kind of category of assets. So we're extremely bullish on the tokenized money market fund space. I think a lot of the stuff of record keeping can kind of be overcomplicated for people. It's just like, if I hold this in my wallet, can I transfer this to an eligible user, right? Can I post this as collateral in like Aave or something like that? If you can answer those questions and do it well, I don't think it matters what's happening behind the scenes. And I think there's going to be a lot of value that comes from that. I think these have true product market fit, and there's going to be a continued explosive growth in this category going forward.
Yeah, I mean, the ability to meet your clients in different ways now than before. Yep. Like, Fidelity and other asset managers always tried to meet your clients where they're at. But with this digital asset, being global and 24/7, there's so many different ways now to go to a client. They can come directly to you with a wallet. So it's very interesting now. And I agree with Will. Like the stablecoin space is going to be massive. I think a lot of money market tokens are going to be reserved collateral for this space. Fidelity Digital Interest Token, FDIT is ours, and very optimistic with this category, as Will said, over the next 5 years.
Got it. Go ahead, Mark.
I'll just add too. I've been fortunate enough to have been able to partner with Will on a proof of concept that we did a couple of years back, and I'm going to pump his tires a little bit because I think it was a phenomenal experiment that we did. Results have been published, and we got to work with a lot of tremendous people. Two things that came out of that. So one, through their platform with WisdomTree, they embedded digital identity, and that's a huge unlock in this space. I know some folks get really nervous when we talk about digital identity and giving up credentials and stuff like that. I think the way that we went about it in that proof of concept, really allows you to unlock the full usability of these tokens in a safe and compliant manner without having to give up, personal information to every single platform, throughout the world. It's just more of a verification process. The second piece of it, I firmly believe that the killer use case that the world is going to find from blockchain technology is the ability to borrow against your assets. So we featured, Will mentioned their WisdomTree money market fund that was tokenized. We featured that as part of the proof of concept where, somebody who is holding onto that money market fund could make it borrowable from other people who are posting collateral in order to take and borrow on it, and they earn some extra yield on it. For the people who are making that borrow, they're able to mimic something that ultra high net worth investors have been able to do for decades now, which is not have to sell your asset to meet an obligation, take the tax hit, and lose the upside on the asset. But you're borrowing against it, you're taking out a collateralized loan, it's a very low interest loan, you can meet your liquidity obligations, you retain the upside of the asset. That's a killer use case that this technology is going to bring to the markets.
If we pair that idea, Mark, just with, you're mentioning digital identity there, and then Will, kind of your comments around composability in DeFi. I don't know when the proof of concept was, right? But when we kind of think about, if you're bullish, right, on-chain money market funds, but we know we have to have this, we know we need composability in DeFi, but we also have to maintain digital identity or kind of regulatory standards. What's the path there, right, to that unlock? Is this just continue to stay the course? Or do we think there's fundamental changes that need to be made?
I mean, I think so. The reality with all of these tokenized security products, the ones that are issued onshore today, is that they have kind of transfer restrictions around them, right? So you can only transfer them to an eligible holder. Some people manage this through a whitelist. You can do kind of a digital identity solution. So we issue a soul-bound NFT, so kind of a wallet tag to any wallet that we know is eligible to hold WisdomTree's funds. So you can easily start to envision, though, how this grows, right? Like if I'm able to trust and say, hey, Fidelity or Invesco is also tagging these wallets. I know they're stand-up people. I know where I can find them. I can rely on their tags and start to expand the addressable universe for who can hold these products, which just grows the amount of people who can transfer them peer-to-peer, and in the future just start trading them OTC directly to each other, right, on a peer-to-peer basis. I mean, that's what you're seeing with DeFi dexes in crypto. So I think that's the direction of travel. It's funny, people have been talking about this for 5 years, though, and we actually have not made that much progress on it. So I do think there is going to need to be, I am a little skeptical on all asset managers who are definitely competing against each other, coming together and saying, oh, here's the perfect solution. I think some of us just need to drive it forward, establish standards, and then try and move things along that way, because I do think that's how you achieve like the potential that we're talking about here. And a lot of it relies on the Coinbases, the Krakens of the world, who are actually onboarding people into the space, who are where people are kind of creating these wallets from. We need them to kind of, attest and do more in the space as well.
Okay.
And maybe just add, I completely agree. I think I was saying more interoperating to create standards, not necessarily role. And asset managers should all take their own different strategy in order to go to market, which are all very different and varying.
That's fair. Kathleen, I want to come back to you now with Will made a comment earlier about kind of like off-chain books and records, I think, right? And talking a little bit. So let's go back we were on-chain, now let's go back to off-chain, right? Which is the real-time operations, the speed, the settlement, the 24/7, 365 nature of DeFi, right? We're thinking a lot at Chainlink about what does reconciliation look like, or how do we do synchronization between on-chain activity, right, and off-chain books and records. From a real-time operations perspective, maybe it's only been 4 months in Invesco, right, but you've been in this space a while. Give us a little bit of a sense of like, how are you thinking about that problem? And I think it's a rather important problem to fix if we're going to see the proliferation and the success that we all want to see on-chain. What's your view?
Completely agree. I think it's a very exciting opportunity for us as managers as well. I think that tokenized assets really are changing how asset ownership is recorded, exchanged. That's going to present a lot of new product models and delivery mechanisms for us as managers to explore. And so I think it's important though also that we walk, crawl, run. As Matt mentioned earlier, it's important to have kind of the off-chain validation with the on-chain records. So it's going to be an iterative approach to get there. But I think it's an incredibly exciting opportunity.
Got it. Anything to add?
No, I would just say, the mental model I think one should consider at this point is the token becomes a new vehicle, the wallet's the new sort of brokerage account, if you will, right? And distribution is now global 24/7. And there are challenges, right? As Will hit on, a lot of us will play around with DeFi with tokens, and it's seamless, it's instant, it's 24/7. You can pledge an asset and get a loan instantly. And you say, wow, this is pretty amazing. And then you try to do it on the TradFi side, and there's this friction. And I think that's where a lot of us want this industry to get, but it's going to take time. And there are rules in place for a reason with traditional securities, right? You have to know your customer, and doing that at scale, peer-to-peer, takes time, and you have to have industry standards, as Will hit on there. So I just think, it's going to take some time. You'll have some different solutions tested in market, stress tested, see if they work, and then I think industry standards will evolve over time here.
I think that's why also you have to meet really clients where they are, and that's why I think we're seeing operating in 2 different verticals. One, continuing to launch crypto-linked products and traditional wrappers like ETFs. That's where the traditional investor is right now. Right, over time, they are going to want to hold tokenized funds as well, but we need to create more utility to kind of bridge that gap. And so that's why we're hyper-focused on both verticals, but understanding that different clients in each vertical.
Yeah, well said. Mark, I want to come back to your comment around distribution. Let's talk a little bit about interoperability. So for me personally, I'm a big fan of, I think there's a new blockchain every week. And I think that creates both an amazing opportunity in the space, but also to some degree, right, that creates some complexity, especially for traditional asset managers. What's your view, or how are you guys thinking about it at Wellington, right? When you think about the opportunity that exists in some of the major, historical blockchains that are well known, versus some of the new upstarts and new liquidity sources that are emerging on chain. How do you reconcile that, right? And what's the responsibility of traditional asset managers, like all of you here and all of our panelists, versus what's the role regulators need to play or other financial institutions off chain? Would love your take.
Yeah, so I guess the first thing I'll say is that we have a lot of blockchains now. We certainly, and to your point, it does seem like a new one is spinning up every other week. So there's still a lot of innovation money that is going towards blockchains. And the other place that has soaked up a lot of innovation money is I'll call collectibles, the collectibles space. I'd love to see that innovation money start to shift towards wallets and identity, because as you're hearing from my co-panelists up here, that's really where we need the next step of innovation, whether it be hosted custody or self-hosted custody. digital identity frameworks and whatnot, like that's going to be the big value unlock for this space. When it comes to choosing between blockchains and distribution, so it's interesting sitting in the seat that I have and looking towards tokenization and where are the strategies and partners and peers that we can work with in order to proliferate our alpha generating strategies in the token space. I get a lot of the blockchains that will call me up and they'll say, hey, we've got this and that and this and that, and they'll quote their features and their time to finality and various other talking points in order to pitch the chain. My response to them is uniform across the board. I'm not the one who makes that decision. It's the asset owners who make that decision. They're the ones who are going to choose where the blockchains, where their assets, which blockchains their assets are going to sit on. And to be honest with you, within certain degrees, obviously it needs to be a robust and secure chain, but if the asset owner comes and says, I want it on XYZ, then that's where we're going to end up delivering the product. Fortunately, players like most notably Chainlink have made that decision a lot easier. And I think, you had Donna Milrod on earlier, and she was talking about how, banks can play a role in that sort of interoperability featuring as well. And so, I don't think that the fragmentation of blockchains is necessarily a hurdle anymore. I think it's something that we've largely solved for. I just reiterate again, I'd love to see the innovation money start moving towards custody and digital identity.
Well, it's great that we've cleared that hurdle, at least, because that was a big topic probably like a year or two ago.
A long time.
Yeah.
Yes.
All right, well, that's progress. Anything to add on that? Kathleen, anything to add on your side, or Matt on your side?
I just want to make a point that all three of us worked in ETFs before, and so did Mark, I believe. So there is some analogies here, right? One of the reasons I think ETFs became what they are now is because with mutual funds, you had to get approvals for every platform to get accessibility. It was a high friction approval process. ETFs, if you had a brokerage account, you could buy them, right? So there's a sort of accessibility issue that Mark kind of hit on with these blockchains is asset managers are going to issue on a chain that's going to optimize around many things, right? Security, scalability, et cetera, but also distribution, right? And there are a lot of interoperability solutions now in the space which do solve that problem, which is really fantastic.
And maybe just add too, I think that it's exciting that we moved on from the narrative of permission versus permissionless when it comes to interop. I think we need to spend more time focusing on how do we have interop between kind of institutional grade DeFi solutions that asset managers can integrate to create more utility for tokenized funds.
I mean, that is great news that we're not talking about permission versus permissionless. That is progress as well. A lot of progress on this stage today. Will, I want to come to you and kind of go back to this, talk a little bit about, we talk about utility on chain, and we think a lot about, we talk about transparency, some of the efficiencies. There's also just an immense proliferation of data, right? Talk to us a little bit from your view, or from the WisdomTree view. How are you thinking about what data do you need to bring on-chain for these various instruments, and what's important? And then also, as you're thinking about transactions occurring, right, and the amount of data that's happening in kind of these new markets and these on-chain interactions, what's important to WisdomTree or whatever, or to your clients, right, and what's happening on-chain from a transaction perspective specific to data?
Yeah, no, that's a great question. I think they're going to see, especially as these things become more and more tradable in a secondary market, kind of greater demand for data availability, right? Specifically on-chain, right? The ability to ingest data and then make decisions around it. It's great that, in addition to kind of like whatever API data we make available, right? Like we've got a whole API suite you can integrate and then get the data for all of WisdomTree's funds from there, also being able to broadcast that on chain. It's just going to be critically important, especially as you're talking about things like borrow-lend protocols, right? So I think that's a key focus area for us as I'm doing the 2026 budgeting. I'm certainly being mindful of that in terms of how important it's going to be to make sure that the data associated with our funds is out there. I mean, with a money market fund, the NAV is always $1. As we're talking more about variable funds, you don't know what the NAV is going to be, and it's certainly as these things start trading in the secondary market, which we think is going to come in the near future, that becomes critically important. You see the same thing with ETFs, right? The ability to keep the bid-ask spread kind of in line with the NAV. Again, I think that's just going to be important, and it needs to be a major focus area going forward.
Anything to add, panelists? All right,
great,
we're gonna look to the future. The inevitable question. So we're not talking about permission versus permissionless anymore. We're not talking about fragmentation anymore, Mark. And Will's over here preaching composability and DeFi. So things are looking up. But it's a long road ahead. There's a lot that still needs to happen. Mark's been talking a good bit about digital identity and wallets and innovation capital moving in that direction. For all of the shops that you work at and these large asset managers, and we look at the next 5 years, what are the material things that need to change on chain? What's the infrastructure that needs to be made and built? What needs to happen from a regulatory perspective, potentially? What needs to maybe even change from a historical way of thinking inside of these traditional asset management institutions, right? In order for us to get to the next level. Kathleen, let's start with you and we'll go down the line.
Yeah, I think that tokenization, really is much more than just a foundational shift in technology for asset managers. Really, over time, going to be a shift in how capital markets operate, and so it's going to take a really approach for us on how do we make things more modular, programmable, interoperable over time. So we really see the next generation really being kind of on chain longer term, but it will take a while to get there.
Yep.
Yeah, I think stablecoins or on-chain money broadly needs to keep growing, right? So like if we're sitting here in 5 years and stablecoins are only 400 billion as opposed to about 300 billion today, then that's not going to be successful. Like this is all predicated on the fact that money is moving on-chain, and I think that's the starting point. And so stablecoins, on-chain money at the base layer needs to keep growing, as well as just wallets need to proliferate, right? We need much more people holding wallets, or brokerages or other people need to kind of embed wallets into their own distribution. But I think like a lot of people ask me, it's like, oh, Will, like why don't you sell these products to financial advisors like WisdomTree's core client set? And like they just can't hold it. Like they can't handle it. There's no wallet infrastructure or anything like that. They are, financial advisors' technology is always kind of slow to catch up. So I think we just need, like Mark was saying, I think accurately, just a real proliferation of wallets in addition to on-chain money in order to see the growth of this industry.
Yeah, it makes sense. And I would just add, the more we can bring sort of that Web3 use case experience and benefit to more of a Web2 experience, frankly, and almost where that technology is powering the day-to-day experience today for our clients. They're getting the benefits of liquidity and financialization of their assets without having to kind of go into the crypto space directly, right? Because most wealth is still on the TradFi side. We know that, and a lot of users just won't do it, right? So I do think over time, this infrastructure will be the backbone of the TradFi system, and with that, you'll have sort of these better experiences for clients, and I think that's when you're really going to see the space take off, is when you can deliver a solid experience in a traditional way for a client.
Yeah, well said. Thank you. Thank you for our panelists.
Thank you.
All right, thank you, Colin, for walking us through the on-chain economy. Now we will be moving on to our next conversation, when code becomes capital, Securitize and the great rewrite of finance. From Chainlink Labs, we have Fernando Vasquez, and from Securitize, Carlos Domingo. Please welcome them.
Thank you. All right. Hello again. It's been a while. So we have another distinguished guest. This time, it's a technologist that I've known for quite a while.
Many years.
Many years, too many years. Carlos Domingo, CEO and founder of Securitize. Actually, as a technologist, he used to be the CTO of one of the biggest labs in Europe. He spent more than a decade in Japan, like myself. So a lot of...
And we're both Spanish as well. So.
Yeah, what are the chances, right? So with that out of the way, I would argue that your approach, Carlos, when it comes to blockchain DLT has been quite unique. While much of the industry is still debating the how of tokenization, you've been putting assets on chain for quite a while. And now you're asking what happens when the entire system, becomes, financial system becomes software, right? Everything becomes a smart contract. And what I think is really unique about you guys is that you've been trying to bring institutions on chain instead of trying to disrupt them. Because many people, in DLT and blockchain think that, again, this tech is all about disrupting the existing players, but you pretty much from the get-go, you got regulated, you're working with BlackRock and many other players. Why did you take that approach?
I think we're trying to help some institutions and disrupt some others. so the companies we work with are asset managers. So asset managers, at the end of the day, they rely on ledgers to update the beneficial ownership of their investors and to be able to pay dividends, to do redemptions, etc. So for an asset manager, using a blockchain and tokenization is an upgrade of the underlying ledger technology. What that doesn't disrupt the asset manager, it actually opens up more opportunities because their products become more efficient, easier to transact, more accessible, etc. What it disrupts is the traditional service providers and the traditional intermediaries that are basically make money with the inefficiencies of the system. So we help some and disrupt some others.
Maybe you refer to the likes of transfer agents, but you yourselves, you had a transfer agent, right? You got a number of licenses,
correct.
Right?
I think the transfer agent doesn't get disrupted, gets transformed, right? To start with, the word transfer is a bit of an oxymoron in the case of a transfer agent that operates on chain because you don't transfer anything. The transfers happen at the blockchain automatically with the help of smart contracts, but you still keep the integrity, if you want, of the cap table on chain. You're the entity that issues the smart contracts. You're the entity that acts in case somebody loses their private keys, in case there's a fork on the chain. So there's a number of things that still somebody needs to take care of it. I think that the role of a transfer agent completely changes, and we have been referring to this on some SEC submissions we've done as the tokenization agent rather than transfer agent, because we don't actually intermediate transfers anymore like a traditional transfer agent does.
So in the first panel today with Donna from State Street, he was telling us that when it comes to institutional investors, they will want to keep working with qualified custodians, right? They don't see, again, institutional investors to manage their own wallets anytime.
We'll see.
Anytime soon. So what's your thesis on that? Do you buy that, or?
I think that it depends. So maybe traditional investors will still want to use qualified custodians, but maybe they'll move to digital qualified custodians that use, tokenization and blockchain, etc. But I think that there is a new generation of people that believe in self-sovereignty and owning your own assets and manage your own assets, and they don't want them to be custodied by a bank or by some other intermediary. In the same way that you want to have, your digital assets in your wallet, you also want to have your stocks and your bonds and your mutual funds and everything. So I think that maybe her comment applies to their customers, but if you talk to, I don't know, Robinhood customers, maybe they'll tell you something different. Yeah. So it's a generational issue, I think.
Yeah, so maybe the retail, they will have options, right? They want to do their own custody, that's fine. And they want to, have someone else to manage their assets on their behalf. That's going to be an option. And I guess that just Securitize would enable both.
We don't care. Like, we issue assets on chain, and if the end investor wants to hold them on their own, wallet and deal with their own keys, it's fine. If they want to just use some key management system, like we do internally with Fireblocks, that's also fine. If you want to use a qualified custodian like Anchorage, you can also use it. Our tokens are, ERC20 tokens on EVM chains and whatever other standards on other chains. So we're agnostic to how people actually do the custody of them.
Yeah, I kind of like what you said, and I really like your approach. And I do think that qualified custodians, traditional banks will organically grow into a DLT-powered financial ecosystem. If you look at the capital markets today, it's not that back in the 60s, part of a cabal here in New York decided what capital markets would look like in 1980, and then in 1995, and then in 2025, right? That was not the case. There was, again, many bumps along the road. Again, it was organic growth, and I would argue that the same is going to apply to DLT and blockchain. It's not about disruption. It's about how we organically grow into this new, financial ecosystem.
Correct. Look, when workstations and then PCs and phones, etc., started, that didn't make mainframes disappear overnight, right? There's probably still banks that still have mainframes somewhere, right? So this is not that everything disappears and a new market emerges. Is that a market starts building out in parallel, and then over time, the assets move from one place to another. So
absolutely. So one of these smart contracts and blockchain is that you can codify financial services in a smart contract. But you look at the way you develop software, you have agile development methods. You can ship updates pretty frequently. But in finance, it may take years to change a process within a asset manager, within a broker-dealer, within a bank, you name it. So what happens when these two worlds fully merge? Assume that this convergence is going to happen, right?
It is happening already, and it's kind of interesting, right? Because what do you rely? Do you rely the software and the code as the law, if you want, as what the regulations are being codified in software, or you rely the output of the intermediary? And then the other thing that blockchain brings to regulators is transparency, right? Like, especially on private markets and to some extent on public markets, you have to rely on an intermediary to tell you that something happened. There is no actual evidence that, let's say, a transfer of security happens.
Yep.
When you have a blockchain, then the regulator can actually look at the ledger to just really see what transactions have happened, if something has failed, if something has, finalized, etc. And they'll be able to actually get information about how regulations have been enforced without having to talk to intermediaries, which I think is very powerful, right? Because it actually goes to the source of truth, which in traditional markets is impossible because those ledgers are not accessible.
So technically, you might be able to do all of that, but do you think we have the right regulatory framework in place to be able to automate as much as we want?
I don't think it's an issue of the regulatory framework itself. It's an issue of the regulatory people ability to actually go and find the data what it is, right? Like we've been surprised. Like we've been dealing with the SEC since 2019 when we registered as a transfer agent. So this is 7 years of dealing with 3 different administrations. And then now, when we file something like a new addition to the capabilities of our broker dealer, and we tell them how we implement it, etc., they actually ask us for the code. So they have somebody that knows how to read code, which they didn't have before. So they've started to understand that this is something they need to be looking at if they want to really understand how regulated entities operate when you operate on top of a blockchain.
So you see the SEC and other regulators globally to follow that template?
Well, this is the SEC, or what I'm telling you. So they'll have to, right? Because also, by the way, for them, as I mentioned, it's more transparent, right? They don't have to rely on my own self-attestation that I'm doing things this way or another one. They can actually look at it. So.
Yeah, and I would argue that that's going to be a prerequisite for this industry to scale.
Yeah, and more transparent, right?
More transparent. Absolutely. Let me kind of get back to the original premise, right, which is that DLT and the fact that you can codify business process in software is a key differentiator. Some people might tell you that securities have been dematerialized for quite a while, for decades.
Since
right?
the 70s.
Since the 70s, right? So what's different about tokenization? Again, people might tell you, we already had dematerialized securities for many years. We had that in ledgers. Maybe they're separated, they're not connected to each other. But what's the benefit?
So yeah, as Fernando was saying, it's very interesting. So in the 60s, the way securities were being transacted was with paper. So to settle a transaction, I will have a share certificate, and I'm a broker-dealer, and you're the other broker-dealer buying it, and I will have to physically hand over the paper. So most people don't know, but the New York Stock Exchange used to close on Wednesdays to be able to settle transactions because they have to people physically move mountains of paper from one place to another. And then obviously that didn't scale very well. So he created something called the paper crisis of Wall Street, where Wall Street literally collapsed. The volume grew and they couldn't settle the transactions on time. And then at that time, Nasdaq, which Nasdaq used to be the National Association of Broker-Dealers, just became an electronic trading venue, so they could do electronic quotes. And then they had the problem of settling, so they created DTC, so Central Securities Depository. So that's for public equities. Now, private markets don't have any infrastructure. So that's a much bigger problem. Now that has been the way, and that's called the dematerialization of the securities, because you don't have the share certificate, but you have an entry on a DTC database. Now the problem is that that solves the problem we had before, but it creates other problems that we have today, right? Like, you know, as we were talking about, we're going public through a merge with an SPAC.
Congratulations, by the way.
I don't know who holds the shares, which is ridiculous. It's like this company is about to be my company when we go publicly. There is no ledger where I can see who holds the shares.
Yep.
Why? Because they are in this obscure centralized database that settles T+1, that nobody has access to it, that what they hold is actually not their own ownership, but it's like an entitlement towards what the broker-dealers have, and each broker-dealer only knows what they have. Like, it solves a lot of problems, but it has created many other problems, and it is definitely not very scalable and not a solution. And then updating these things is complicated, right? You have to update the DTC ledger, and then sometimes the transfer agent, the broker-dealer's ledger. You have to update the cash ledger of how cash moves, and in private markets, it's even more complicated. So I think that moving this to kind of like a public distributed ledger where everybody, you know, writes and reads out of the same place, and all the transactions and all the movement of both tokenized securities and tokenized cash happen there, is going to provide a ton of efficiencies. And I believe this is kind of like the next upgrade for capital markets, moving from electronic markets, which is what we have today, to digital markets, where you have native digital representations on public distributed ledgers of the ownership of the securities.
And beyond efficiencies, what about the utility side of things? What can you do as a token holder with that token? Do you think that's going to play a role? If you can have access to, let's say someone buys an asset from you guys, and then you connect them to a DeFi pool where they can borrow stable coins against it. Do you see that as something meaningful in terms of incentivizing people to hold a security in a tokenized format?
Look, I've always believed that innovations that are providing efficiency are not as interesting as innovation that provides new markets, right? That create new use cases and utilities. So if blockchain and tokenization was only about, let's make the ledger more efficient, blah, 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 it will be fine, but it will not be that interesting. The interesting part is what can you do when your securities are kind of in this public ledger that you can actually do things with them. So you can transfer them peer-to-peer. I don't know if anybody has ever tried to move securities from a broker-dealer to another broker-dealer. And this is public securities. If you go to private securities, it's even worse. It could take you days, if not weeks. So that ends, right? Like I can just send it to you from my wallet to your wallet, and the smart contracts will approve the transfer, etc. You can do other things, which sounds like a stupid thing, but when companies pay dividends, you don't get the dividend immediately. Because why? Because they don't know who you are. Like they don't even know you hold the shares. So they have to go through this web of intermediaries to figure out who was holding securities at one point in time to be able to pay the dividend. So that means that if the dividend takes like a month to reach to you, out of 12 months, you're only putting your money at work 11 months, because 1 month the money is floating around the system trying to get to the investor. So that's something it's money you're losing basically. You could just reinvest. The same thing about like you know, collateral management and all the things we were talking on the back about, like balance sheet efficiency. Like if things settle immediately, then I have the security, so I can then post them as collateral and then borrow against and do other things. You can go to DeFi protocols, and you know, we're working with you guys on Aave Horizon, so you can post 24/7 collateral and borrow during the weekends, which, believe it or not, in traditional finance, it's almost impossible to do it unless you're like a super large institution. You can, think of other use cases, things people don't do today. Like I can, walk into a place and I can actually prove I'm a shareholder of that business and get a discount because they have a proof of ownership of the shares in my phone with a crypto wallet and a token. So you can think of scenarios that do not exist today, like you go to, I don't know, Target, and then you get a 5% discount if you're a shareholder, and then more people will want to be a shareholder, or Apple.
Absolutely.
So there's tons of other things that, the things that we see today happening, and the things that we don't see today that will happen in the next 10 years when securities are basically digitized, and there is a very simple way for you to prove ownership of the security and move them efficiently.
So it's efficiencies and utility. That is the future. That's why tokenization makes sense. And please stay tuned. We get this announcement coming from both of us in the next few days. But just to wrap up, I'd like to pick your brain. I would like to say how do you see the end game. If the future of finance is programmable and composable, what becomes of the intermediary, right? And are we moving toward disintermediation or re-intermediation? With the likes of you being the new intermediaries, or existing intermediaries taking on new roles?
That's a very good question. So I'm old enough to remember when the web started, and the web was supposed to be this decentralized publishing platform that anybody could, talk to each other directly without intermediaries, and it was supposed to disintermediate. And that has not really happened. What has happened is has re-intermediated into different players, the Googles, the Facebook, the Apples of the world, that just happen to be much better intermediaries. They are cheaper, in many cases free. They also give you, a much better user experience, more services, etc. But it has not really disintermediated. It has moved the intermediaries from one place to another. So are we going to have the same thing with blockchains? To some extent, yes. To some extent, there'll still be the need of to some degree of intermediaries. Are not going to be the same for sure. And some of the ones that from a regulatory position, let's say like transfer agents, survive, they will not act the same way. Like the way, as I mentioned, we don't even intermediate transfers. We don't, transfer agents, most people don't know, but they make money by holding the dividends that are being unpaid and earning an interest on it. If we pay dividends on chain, we'll pay immediately, so that's not a revenue stream. So the new intermediaries will have to reinvent themselves and their different business models that the technology enables and eliminates some of the cost and fees that the old intermediaries were taking.
A better future. So thank you, Carlos, for your insights, and thank you all for listening. Again, enjoy the rest of the day. Thank you.
Thank you.
All right, everyone. I hope you've been enjoying the morning. We're going to take a quick break for refreshments. Please visit our sponsors outside. The Link Luncheonette is sponsored by Polygon on the 2nd floor for some delicious treats. Visit our developer lounge on the 3rd floor and show your social posts to the help desk to get that beanie. We'll see you at 10:50 a.m. Thank you.
Please welcome back to the stage Zubin Pretap.
Welcome back, everybody. Hope you had a nice break, feeling refreshed. Grab some caffeine, maybe a snack. Up next, we have a panel on the Unified Ledger led by Mark Nichols from Ernst & Young. Please welcome to the stage Mark Nichols.
All right, good morning still. Hope everyone's enjoying it so far. Thank you for sticking around with us following the break. I'm delighted to be joined today by Dan Dooney, who's the Chief Technology Officer of DTCC Digital, and also Jürgen Wachnein, who is the Head of Innovation and Digital Assets at Euroclear. Myself, Mark Nichols, I co-lead our digital asset practice and consulting business at EY. And wow, what a great 9 months it's been for this industry. There's been an awful lot going on. There's a lot of progress that's been made. But where I wanted to start really was to let Dan and Jürgen really introduce what Euroclear and DTCC are to the digital asset ecosystem, given their key role in the traditional financial infrastructure that exists today. So maybe I'll turn to Jürgen first, and can you sort of talk us through a little bit, what does digital assets mean to Euroclear, the role you're trying to play within the ecosystem?
Yeah, sure. Very happy to be with you all, and first of all, a big thank to Chainlinks, because I think it's quite unique to be able to bring like two huge traditional institutions like DTCC and Euroclear on stage, and try to bridge the gap between DeFi and TradFi. So just to put things a bit in perspective, we are a financial market infrastructure, and we are systemic to the job we do. And I like to basically try to have a business conversation around everything digital assets and traditional assets. And just to put things in perspective a bit more, I think 4 years ago, we had like 36 trillion euro of assets under custody. And today, 4 or 5 years later, we have 42 trillion of assets of custody. It means that we have grown more than the full crypto industry over the next 5 years. So what we're trying to basically say is we are embracing this change. We believe we should basically be able to service any kind of assets, should this be traditional assets, digital assets, and make it a seamless journey for our ecosystem. That's a very important point.
And Dan, how about DTCC?
So a central securities depository that we're both a part of is effectively the consensus model for the securities market. It's the place where all the records must agree to have a complete record of ownership. And over time, we've gone from T+7 down to T+1, and we're looking ahead to a T+0 world. So as the consensus model for financial markets, we look at blockchain, and we both see it either as an existential threat, there's a better way to do consensus, or an enormous opportunity to retool as we target T+0 in the end. We see it as an opportunity, both of our organizations. We're looking to leverage the way that, and change the way that financial markets work using this technology. There's really not a better conduit than our organization. So Jürgen mentioned 43 trillion in assets. We represent $100 trillion worth of assets. And really by working together, we are at the center of the financial ecosystem. And by using partners like Chainlink, we're able to move, I think, very quickly and completely update financial markets to use these new tools. So we're excited about the opportunities, and we think that we're a critical part of the future of blockchain financial markets for some important reasons. When our organizations were formed, there were many different financial records that existed broadly through transfer agents in our market. And every institution had to interact with all of those various ledgers in order to be able to produce a record. And that's why we had T+7 settlement, and that was falling behind. It couldn't handle the scale of markets. So they set up an organization. In our case, we're a DAO. We're actually owned by the financial markets as a core infrastructure element that provides that single consensus layer for the various markets. This tool, or this DAO, ultimately through blockchain, it can be transformed into the new financial markets. So we're excited about the opportunities there.
Maybe to add something on that, and I think it's quite interesting. We haven't created ourselves like 6 decades ago, and you can imagine how many things have changed over the 6 decades. And guess what? Euroclear has always been here to support the growth of the capital markets through any kind of innovation you can imagine, should it be technological, financial, or even crisis. And the future is not going to be any different of that. What's really challenging today is the pace of innovation. And you know, as much as we are incumbents, we have to think as well about the ecosystem we take together with us in this journey. And we have to become the change agents that are going to support this transition to a more, you know, where you have more convergence between traditional and DLT. And where is bridge?
And so maybe to pick you guys up on this a little bit. So we've got $143 trillion. I guess it'll be more than that because your number's going to be euros. So let's go something north of $150 trillion of assets on the stage. We've got this convergence of the digital asset ecosystem with the traditional financial ecosystem. Are Euroclear and DTCC competitors, or are you collaborators as we move to this new, more agile market infrastructure?
Collaborators without a doubt. So you can't move, right? Global markets, financial markets are becoming more and more global. So there's a need. They have a different regulator than we do. Across jurisdictions, we face very different customer bases. So in that way, we don't step on each other's turf, but we have the same set of problems. So I mentioned how we had all of these diverse ledgers when our organizations were created. Guess what? That's replaying itself. The old is the new, as we see a proliferation of distributed ledgers. And the need to unify these ledgers across jurisdictions, across asset classes, is as real as it has ever been. By collaborating on these challenges, we can create a truly global market with shared data, with value that can move across borders efficiently. And that's why we're tackling these problems together.
So definitely, you know, we are collaborators. And let's look back a little bit to what happened, you know, in the last 3-4 years in the digital asset space. We have seen a proliferation of initiatives. And that's great because it has been solid expertise and knowledge in the market. And guess what? Despite the lack of adoption and volumes, still, nobody's backing up. They're continuing on the journey. But I think, you know, there has been a shift quite recently because it marks the end of siloed initiatives. That's over. Either you are creating bridges to connect people and connect assets, and with Unified Ledger where you have the money, you have the securities, you have the data sitting in the same place, but every siloed initiative now has to come to an end. So it's an era for collaboration. That's most important. I think, you know, DTCC and us together with Clearstream, we kind of embodied that in the work we did around the digital asset securities control principle. You know, because of our size and our role, people come to us and they would like to collaborate. And we do welcome them with open arms. But at some point, the conversation needs to have some structure. So, you know, we established a set of principles. It's fair to say, okay, thank you very much for your ID. Are you regulated? No, I don't know, maybe soon. What's your take on asset protection? These are things that are core to our heart. What's your take on cyber resilience? So, you know, this set of principles are basically giving to everyone out there a kind of roadmap to the pot of gold, the real world assets. Everyone is coming to try to understand how we can tokenize that. And we have shown the way, and we're going to publish a new version of it, which is double-clicking on one of the most fundamental problems we're trying to solve, interoperability and governance.
Yeah, and you guys are working on some really amazing stuff, so thank you from behalf of the industry as a whole for the work that you guys are doing. But if we take a little step back, so we're here to talk about unified ledgers. So Do we think we're going to end up with a single unified ledger? Or is this about an interoperability play? Is it about standards? And is it about making everything so they can connect to each other? I know, Dan, this is a topic close to your heart, so maybe I'll turn to you first.
Well, there's a physics problem. There can't be one ledger in the end because of the trilemma. So if you want to get to T0, that means all transactions settle nearly instantly, which means every ledger must agree on ownership state. If you want one, that's easy if you have only one ledger, but then you're limited to somewhere between 1 to 10,000 transactions per second. That's not going to cut it. That means transactions have to go somewhere else. So in the end, there will be a ledger of ledgers or a network of distributed ledgers, and there's a need to then produce ground truth from that network of distributed ledgers, layer 1, layer 2. We call this layer N, where value and data can move freely between the various distributed ledgers that are able to then scale to, we think, 1 trillion or a million transactions per second is going to be necessary to support full T0.
So you said 1 billion transactions per second.
1 million transactions per second.
I just wanted to make sure I heard the number correctly. Jürgen, anything that you would add to that?
So I fully agree. There's not going to be one to rule them all. That's kind of very clear and making consensus amongst, I believe, most of us. Nevertheless, we see still that depending on the geographies, even depending on the use cases, you might have different places. And why the unified ledger concept is quite appealing, we can see that everyone is trying to work on that, and we see more public and private, consortium coming to life now. Working on this is far from being easy. And then it comes back to, what are you trying to solve for? And, we can spend hours trying to discuss and define interoperability. Is it the ability to move a token from one place to another? Is it connecting supply and demand? Is it going over legal fragmentation? And all these topics are quite, of importance. So in Europe, we have, new initiatives, led by the ECB, trying to figure out the unified ledger topic. We see as well other initiatives out there. I think they're all solving part of the issue, and we need to connect now all the dots. And I think, thanks to the great collaboration we're having, we'll be able to support the overall journey towards a more unified ledger, or unified ledgers. I think the S is super important.
Yeah, that is a critical, and folks should recognize what a CSD is responsible for. In a given market, the ownership state at a specific point in time is the job of a CSD. We must, when you pay a dividend or do shareholder voting, you can't double count who's holding those individual shares. So the fact that my son is due 2 cents for his Microsoft shares as a dividend payment, the system has to support that all the way to the edge so that every share is accounted for and everyone is treated fairly. So as value is distributed across many distributed ledgers and is moving frequently, recognize the challenge there of observing that ownership state so that there is no double counting. That's ultimately what CSDs do, and that's really the unified ledger of ledgers that we're responsible for in the end.
I appreciate, Dan, we speak here about CSD, but it might not be a very popular topic in this kind of conferences, but we're happy to explain the value of a CSD, the importance of a CSD whenever you want after this panel.
And Jürgen, you hit a little bit on the European sort of readiness, where we are in the European markets. And Dan, I'd love to hear a little bit from your perspective where we are in the US markets. Obviously, we're seeing certain announcements from other sort of market infrastructure players, exchanges around tokenization of assets, existing assets that are on traditional rails moving on-chain. I'd love to get a sense from each of you as to how you see the current state of the regulatory environment, market environment, readiness as a whole in your respective regions. Appreciating, Jürgen, that you do live and work here in the United States as well.
Well, clearly, the last 9 to 10 months has been very exciting in the US markets. So the regulatory, the growing regulatory clarity has been a huge unlock for the markets. You can see the impact as the US is all in on blockchain. And that's causing every institution, every major financial player, their boards, as we discussed, they are focused on distributed ledgers and how they can deliver value to their customers. In the same way that regulatory clarity is important as an unlock, Jürgen pointed this out, the principles of control. How do you recover value that's lost or stolen or misappropriated? How do you make sure that there's a proper record of ownership end to end? Setting those principles is also a big unlock, and it's part of our responsibility to the market as we work with technology providers like Chainlink, is to make sure that there is that clarity which allows the markets to move forward quickly. You see both of our entities moving aggressively into these marketplaces to provide clarity for the ecosystem, really supporting our core roles in these ecosystems so that you can unlock the innovation and make sure that it's done in a way that's safe and secure for the end investors.
I think, we have to give a lot of credit to the regulators on the work they have done over the past years. I think the progress that has been made on CBDC, stable coins, MiCA regulation, Genius Act, you name it, are all building on each other to basically improve what somehow is missing from one regulation to the other. And I think, that's great to see how each geography get inspired by the other and the acceleration that it pushes, obviously going more towards the tokenized world. Now we have to be aware as well that there is a speed race not to be missed. So you might want to innovate, but if you're not going at the right pace with what's happening in the market and being connected to this new reality, it might get out of sync. And this is where it starts to become more complicated. When I see the progress that has been made and the way the regulators are leading in discussion, creating the right ground and the right framework for all that is super supportive. But I would as well mention that the job we have to do inside organizations is super critical to be able to adapt ourselves to the 24/7 and tokenized world business. We have to appreciate that this is not necessarily something everyone is used to. So while everyone is doing things either in production or the level of scale is not here there to have a full transformation at the organization level. I think the work we have been doing with the Global Blockchain Business Council on the risk mitigation framework is super important because that's basically level setting. What kind of new risk do we have to cope with? How can an organization get ready for that? And somehow that seems to be a tipping point. When that starts to become a center of attention, is showing that this might be the year that we're going to see the scale and adoption.
Yeah, it is interesting. There is jurisdictional FOMO to some degree, but even as there's pressure to move forward quickly, keep in mind the responsibility in these markets. So we saw a major hack yesterday, hacks earlier this year with over $1 billion worth of value lost. Those are small markets by comparison to the markets that we're responsible for. So you could imagine if you've got $100 trillion or $150 trillion worth of assets on chain, and there's a major hack of $1 trillion, that would bring down an economy. So we have to do better than that. That's part of the responsibility of governance in these models. As we move forward at breakneck speed, we have to do so in a way that is proper and recoverable. And for example, the principles of digital asset security control principles are a piece of that. As all of these pieces fit into place, you're going to see rapid acceleration of the markets. We know that that's true, but we have to do so with proper controls.
Maybe just to add on that, because I think it's super important to highlight that. Getting Euroclear, Clearstream, and DTCC to work together for the greater good of the market, supporting the adoption and advancing of digital assets, that's super critical. If you look at the GBBC work we're doing on the risk mitigation framework, we're adding as well crypto-native companies, layer ones, and others to come together. And that's exactly like we are here in this room all together from different horizons, different viewpoints. We might not necessarily agree, but that's the power of the new conversation we have to get. We realize we need to build on each other. We need to collaborate if we actually want, these conversions to happen and for every one of us to be able to win in a significant way in this tokenized world.
And it's interesting, as we go and talk to the boards and the senior leadership of traditional financial institutions, they always talk about their 3 priorities. If you go back 12 months, AI was maybe just about on that agenda. Digital assets was not really on that agenda. It was a bit like, don't talk to me about AI, apart from a few firms. But if you now look today, you go and meet with them, it is all about AI, it's all about digital assets, and it's then pick one other thing that's relevant to that organization. But the common themes are always those 2 topics. And it's fascinating as they think about governance, they think about the risks in this ecosystem, but they also think about the commercial opportunity that they're seeing. And they're all coming hard at this. So it's going to be really important and really interesting to see how it evolves with your traditional member base and your constituents really coming into the digital asset ecosystem, and then the role that you guys can play. Which brings me to a question around, where do you see your organizations truly playing? And I know we've hit on this a few times, but what are those really exciting opportunities that you see for you to play? For you to not, maybe it's not necessarily a revenue opportunity always, maybe it's a little bit of just enablement for the industry. But what are those things? Maybe start with Dan.
So the first critical piece is we're looking to tokenize our $100 trillion in assets. So we're building out that framework on an aggressive schedule to make that possible, so that parties, if you want your shares of Apple or Microsoft or your ETF in token form in your wallet, we are working aggressively on that rollout, and news to follow. That's an enabler. Because now what that does is puts high-quality assets with the full rights of the securities entitlements on blockchain rails. That makes it a place where market makers can park value and can execute transactions, which will do a lot for the liquidity of these markets. At the same time, getting tokens is the beginning, but it's equally important to have really powerful applications, especially for institutional finance, at the same time. So we're rolling out a series of effectively institutional DeFi applications that are designed to unlock liquidity. Some really elegant smart contract frameworks. If you've seen the work that we did in the Great Collateral Experiment and how we use DeFi protocols for collateral management and lending, that's an exciting part of the future. But in the end, it comes down to governance. It's the most boring thing that's out there, but ultimately, what makes our organizations tick is that the regulators look to see how we make decisions. How do we decide on this ledger versus that ledger, or this technology for key management, et cetera? There's a rigorous process to make sure that people aren't making decisions willy-nilly. And that's in the end what keeps markets safe. We're trust agents who are closely overseen as we execute our market responsibilities. We're bringing those frameworks to the broader financial markets, really to the DeFi world, as we work together to unlock this new model. So it's that governance that we need to do together as we shape the broader ecosystem. That's probably our principal role.
So, George, just going back on your point around AI, and because we participated together on a project with Chainlinks around corporate action lifecycle management called Calm. And that's showing you don't have to pick both. You can actually amplify DLT and AI together. And I think, the ChatGPT moment that happened end of 2022 only could happen because there was a level of readiness that our institution, did, by hiring chief data officers, data scientists, investing in cloud. And when you had the right rails in place, whenever this moment happened, you could see the big competitor being able to react and go to market quite quickly. So the readiness was the key part. I think, to summarize a little bit, how we see things, definitely, as I told, we want to be the gateway for our clients to their assets, whether it's traditional, whether it's on-chain, managing the user experience in a safe and sound way, together with these infrastructures. I think digital assets are ready for prime time, and Euroclear will definitely host, or at least co-host the show when this moment comes.
So we heard it here first. Agentic, on-chain, programmable assets enabled by your firms is the future of digital assets and maybe financial market infrastructure. We should capture that somehow.
Trademark it, brother.
There we go. So as we come to our last 45 seconds, I'm going to give you each a rapid fire. What's your advice or your ask of the builders, the developers, and the constituents that are in this room as it relates to unified ledgers, digital assets, and your respective businesses?
The main advice is institutions have a role. They're trust agents, and while blockchain networks are trustless, ultimately there needs to be accountability in the ecosystem, so they're good partners, not the enemy in the end. And we see vice versa. We're excited about bringing DeFi technologies to institutional settings and working with the many idea creators that are out there.
I think, over the last years, we have done a big part of our job getting, strong expertise on DLT, digital assets, and your crypto-native world. I would encourage you to, as well, make a step towards us, understand better what our job is in the financial market system, and try to find a way to collaborate and get closer. We're open arms. We welcome you all for collaboration, but let's find the right way to communicate and collaborate.
Great. Thank you both, Jürgen, Dan. Collaboration seems to be the word here. Let's collaborate more and let's do some really cool stuff. Thank you, guys.
Thank you.
Okay, we've been having such a great morning. Love having you all here. Up next, we have Swift, Thomas Zschach. Please welcome him to the stage.
Hello, New York. Hello, SmartCon. Nice to be here. I titled my talk today, which I'm going to try to fit into about 15 or 20 minutes. I titled it Proof Over Promises. And I did that deliberately because I think we spent the last decade making promises and claims, sometimes outrageous claims, faster settlement, tokenized assets, everything's going to be decentralized. A lot of that's becoming true. We see that in motion today. But I think the era of promises is over. It's time to stop promising things and start to deliver real value. And I think from here on, I think with what we need to do is kind of prove things that need to be proven to be able to scale. And so proof of concepts aren't enough anymore. When we speak to our banks and we speak to our customers, if you want a really terrible response, say, we're thinking about doing a proof of concept. Over. We've kind of proven what we need to do. The technical evaluations are done. And we really need to move from these proof of concepts to proof of safety, proof of compliance, proof of trust. Everything we do in finance, and I'm not going to use the term traditional finance. I'm not sure how we came up with that term other than we needed a kind of a cool term for crypto Twitter. But it's all about trust. Everything we do in finance is about trust. So proof of promises means innovation in finance has to move to prove the value in production, not just promise it in theory or on a white paper or an outrageous claim on X or Reddit. It's really a call for accountability, for maturity, and moving from white papers and pilots to performance at institutional trust. And I want to put an important context in what we're talking about here today, because in a lot of these conversations that we're involved in, anywhere, online, in these type of forums, with client events, we all kind of migrate towards a retail implementation. And retail is super important, and there's lots of value that could be found there. all the buzz today, for example, in stablecoins is primarily around retail applications. But institutions and the way that large value moves money, and especially cross-border and around the world, it's just different. If I instruct to move $50 of a private stablecoin to your wallet, that's pretty easy. It works pretty well. It's fast. You have lots of options. You have lots of choices. That's fantastic. We like choices. We like competition. We like the innovations. That's very different than instructing $50 million from the US to Singapore. Actually, it couldn't be more different, right? So the comments that I'm going to make today are really around proof, but really more kind of geared towards an institutional context. So let's talk about what proof really means. And I wrote down some examples because, again, we're kind of beyond the theory and wouldn't this be nice and this is going to change the world and then no kind of color and content behind that. So let's talk about kind of different types of proof and how it might actually look as we go forward. And I'm not standing here today saying I have all the answers, I know how it's going to work, but let me give you some examples here. Proof of moving real value on public blockchains. It's not about demos, it's not about tokens, it's not about what I refer to as kind of onesies and twosies. Those are important, they need to be proven. But really what we're talking about, can you move real money, not altcoins, not made up stuff, real money for the value and the value of that money on public blockchains. It looks like there's a path to that, we're not there yet, but we need the same certainty, the same auditability, the same compliance in place to be able to do that. That's how today's financial systems work. And I can tell you in all the conversations I have in every place in the world, nobody's talking about changing how the financial system works. The question is, how do you use these new innovations? Some came through DeFi, some have come through other channels. How do you use those today to benefit and make things better for consumers, for businesses, and the way in which we move value around the world? Proof of identity in KYC. It was said earlier, you have to know who you're dealing with. There's no such thing as being autonomous in finance. Every participant needs to be verified, whether that's an individual, whether that's a bank, whether that's a person who works for the bank, corporates, asset managers, even autonomous agents. We're not just going to turn the world over to, oh, the agents are taking over, so therefore we don't care who's instructing the payment or moving value. That's not happening, right? So even agents have to be verified. Who's responsible for them? And how do we verify identity using cryptology in these open systems to make them more trusted? Proof of reserves and proof of backing. Every token and asset has to have something that's verifiable, whether it's cash, it's collateral, it's a claim. It needs to be audited. Financial institutions need to do that. Regulators need that visibility and transparency, and they need to be able to do that in a way that is easy to validate that the things that we said were going to happen actually happened. Proof of compliance. I believe that compliance can't live off chain anymore. That doesn't mean everything's going to go into all one singing and dancing blockchain, but money laundering, sanctions, the privacy of the data, these rules all have to be built into transaction logic. This is where you start to get real value. This is when you remove friction. Some people call it compliant programmability. One of the biggest promises we have with the new digital assets, whether they're stable coins or tokenized deposits or CBDCs, is the programmability of that value. And then finally, the proof of governance and finality. And again, this is not a subtle difference between retail and institutional. When something fails, there has to be recourse. There has to be a rule book. There has to be a way that we harmonize jurisdictions so that it works properly. Again, $50 is not $50 million. If you're a corporate treasurer and you're sending $50 million to your supplier in Argentina, it has to work. It has to be de-risked, and you have to know what's going to happen when things go wrong. So those are kind of the different types of proofs I think are going to be evolving. So let's talk about some real-world examples here. And we're seeing these proofs emerge across the ecosystem in every corner. I think in the last month, we've seen every major money provider, card network, and people who are stepping into this space announce deals, primarily around stablecoins. So if you don't see the progress, you're not looking for it, or you're trying to hide because it's everywhere. Let me start with one, and I'll call this proof in progress, right? Because it just got announced. But Stripe and Paradigm are going to build Tempo. It's going to be a layer 1 blockchain. It's going to focus primarily on to become a payments first blockchain. that's optimized for stablecoins and microtransactions. It's not a promise. It's a live test. Tempo is going to try to prove whether compliance and neutrality and governance can really hold up under transaction volumes. This is fantastic, right? To move this proof of progress is going to actually show us that this is not theory, that we can do it at scale. And that's just one of a dozen announcements that have been made recently. For Chainlink, for example, proof of verifiable trust beyond interoperability. And there's always a discussion about interoperability and how we connect systems together. We know. We've been doing that for 50 years at Swift. Swift started because domestic payment systems couldn't talk to each other cross-border. It's absolutely essential. It needs to be based on standards. It needs to have a rule book. It needs to be done in a trusted way that can be verified. So it's not that interoperability is not going to be important, but we're moving beyond that. We're moving into kind of important proofs about not only how the tokens move on the networks, but can we verify the truth that they actually happened? Do we have the audit trail for that? Chainlink has been kind of quietly building that foundation for some time now. We've been actively working with them on a number of different things. I mean, you've seen announcements that have come out, but they've been building these foundations. I think they're important foundations. I think about like CRE, for example. We're bringing verified real-world data and even regulatory proofs on chains. This is how you're going to show how institutions can implement trust, not only for themselves, but for the world. And I would argue, as you move to open public infrastructure, that openness and the right amount of transparency actually builds more trust in the system. And that's what we need. We need more trust in the system as we leverage these innovations. Now, it's not just about interoperability anymore. We need to verify the integrity. Who are the participants? Did it work? Are there proof of reserves? All these things have to happen. And so it is happening. It's not just about simple connectivity. And I think that we also see Chainlink's role evolving in all of this. And you're going to hear a lot more about that from Sergey's and the people in the lab. But the next frontier is not just linking systems. If we're going to do something autonomously, and you think about the intersection of programmable money with agents that could make up their mind and do things on somebody's behalf or on your behalf, it has to be done safely. It has to be done in a way that compliance is provable. And again, you can do all of these things, but if you don't do those things right, you never get to scale. And you probably end up with maybe a worse situation, which is fragmentation. So we have all these different systems that don't talk to each other or just talk to each other on the perimeter, but really the fragmentation ends up impacting businesses and corporations and financial institutions and of course retail and consumer people. So we're going to move well beyond just simple connectivity. Chainlink's role is going to continue to evolve, and that's going to be an important aspect for the industry. We're going to have to prove the things that we see today, whether they're stable coins, they're tokenized deposits, or CBDCs. All these things need to be proven in a number of different ways. We need to prove the data lineage that we have, again, in an AI world. Where did that come from? How do we know that's valid? How do we know that's certified data? How is my agent making a decision with data that I don't trust? Guess what? It's not going to happen. No responsible company's going to just hope for the best with the data that they have and start instructing payments or movement of value. Nobody's going to do it. It's not pragmatic. It's not practical. And it's probably not going to happen. Another example we see now is tokenized deposits. And there's all kinds of buzz around the industry. A lot of the buzz, whether you're in DC or New York or other parts of the world, are really around stablecoins. And I would reference a report, and there's a couple of reports like this, but Citi a couple weeks ago published a report called Stablecoins 2030. And they made an estimate I think is pretty well accepted now. Even Secretary Basant has made comments about the size of the stablecoin market going from roughly, call it $300 billion in stablecoins today to somewhere between 2 and 4 trillion, which is a substantial number, right? Citi in their report said the activity on tokenized deposits issued primarily by financial institutions and banks, and actually already happening, by the way, in Switzerland, in Hong Kong, in the US, in Singapore. These things are already happening. Citi said that the transaction volume in a year for tokenized deposits could be between 100 and 140 trillion dollars. Think of that number, 100 to 140 trillion dollars by 2030. And we're staring 2026 right in the eye. Now, it's not about having an accurate prediction whether it's kind of moves faster or slower, but these are real numbers and these are happening today. And this isn't about what's happening in the future, this is happening today. And the question is, how do you make that meaningful? And then how do you make that scale? Proof of orchestration. For some of you might have seen the announcement that we just recently made at Sibos about a month ago. Swift's going to prove orchestration. Not in theory, not in hype, but the kind of coordination that our clients are asking for. We're a co-op. We're not a for-profit first company. We're driven by our customers and what our customers need. We provide solutions that help our customers provide solutions to their customers. Right? That's what we do. And we've been doing that for a long time. So we made a deliberate, the first step, deliberate and very simple. 24/7 cross-border payments in the interbank market with tokenized deposits. Simple. The banks tell us they want it. They want to offer this service. They have demand from their clients. Is this the end point? No, it's the starting point. But it's the highest demand that we see. We need kind of continuous operations. We need the visibility. And we need compliance that actually scales. And that's what we intend to launch. And let me be really clear. It's not launched. And there's a lot of decisions that need to be made. We need to follow our formal approval process, our oversight, our governance. All those things are important to run at a way that people expect from Swift, and that's exactly what we intend to do. So we're building carefully within the regulatory parameters, in the full transparency of our supervisors, whether that's our board or the regulatory environment, and we're going to build it properly. And once that foundation is proven, then the options become even more interesting. Right? Can we connect to multiple private and public blockchains? That's an aspiration, but it's part of the longer-term roadmap. It's not in today's scope. But I think everybody, in the way that you see the way these things are moving forward, that there's going to be a lot of demand, and we're going to respond in a responsible way to help move these forward in a way that's acceptable, not only in delivering the value, but acceptable to how finance runs today. So I would say that the really important thing here is it's not about speed. Speed matters, right? And speed's important. It's about synchronized trust. You keep coming back to the same thing. It's about trust. If you can do something really fast, but you're going to run it off the edge, it's not going to work. And if it does work, it's not going to work for long. And you know what? I guess one of the things I want to kind of leave you with as well is why this matters. Let me give some proof of why this matters, right? And people, that are in the DeFi world, for some time, we've seen what happens when promises run ahead of proof, right? You can't prove reserves. You can't prove that it's operationally sound. You can't prove that it's compliant. We've seen what happens. You have collapsed bridges. You have lost funds. You have real people getting hurt. Right? Because you have retail investors being left behind. Nobody wants that. Nobody should aspire to that. And most people don't. And so it's not about speed, it's about synchronized trust, and it's about incorporating new digital assets and new settlement locations, and doing that and integrating that into what we have today. And it doesn't mean what we have today is perfect. It's not. There's a lot of room for improvement. But let me share one statistic with you that we published about a month ago going into Sibos. 75% of all payments on the SWIFT network, 75%, reach the destination recipient bank within 10 minutes. Most of those within seconds. We're not doing any research to speed up moving something at the sound of light, because that's not possible. 75%. Now, that tells me two things. One is we're not done, and there's still improvements that need to be done. And we're actively working with our community and the banks to address the 25%, to address the friction that's out there, because the 25% is not okay. So even though we talk a lot about tokenization in the future and where this is going, and I don't think anybody could be more excited about the Swift Ledger announcement than myself, but we have a day-to-day network to run that moves trillions of dollars every day that people rely on. This isn't either or. This is not a pivot to the future. This is us working on, one, removing the friction, And 2, it tells me we have a last mile problem. We're connected with 150 currencies in over 200 countries. In some cases, we have a last mile problem. And we need to work with that ecosystem, with that jurisdiction, with those banks, with those financial institutions to address that. And we're fully committed to doing that. So it's really kind of a two-stage approach here. So let me leave you with a couple of thoughts here. Proof over promises is not a slogan. It's the new operating standard for finance. That's the new standard. Proof that value is moved so that every regulator can verify it, so every investor can be comfortable, so every risk manager inside of every financial institution can prove that the value moved exactly how we expect it to move. Proof of the participants. They're known, they're compliant, and most importantly, they're accountable. We need accountability for lots of things, not just in finance, especially in this country. We need accountability. That comes out. We need proof that assets are backed, they're governed, they work well, and that the outcomes are final. Again, $50 is not 50 million. Outcomes have to be final. Disputes have to be dealt with. And that really is what's going to separate infrastructure of the future with ideology. That is the difference, is that we're going to get to the point where when we have these proofs, we're going to be able to do it at scale, we're going to move beyond ideology, and we're going to build infrastructure that can be shared publicly and in a very positive way with the world. And that's, in my view, what takes innovation and turns it into trust. And that's what we're trying to do. That's what we're all about. And we look forward to a really bright future. Thank you for having me today.
Thank you, Thomas, for sharing more about the future of the ecosystem. Now we're moving on to Tokenization is the Real Thing. From Broadridge Financial Solutions, we have Chris Perry.
Good morning. How is everybody today? On Election Day in New York City, how fun is that? Make sure you vote. My name is Chris Perry. I'm president of Broadridge. I am thrilled to be here today. When the great Frank Seibold of Chainlink asked me to speak at SmartCon, I was sort of like, SmartCon, I'm kind of smart, but I'm not a con. I mean, what is this all about? And he said, no, this is about smart contracts. And I said, smart contracts? I love smart contracts. I love smart contracts. When was the last time you were at the DMV? Raise your hand. Nobody wants to go, right? It's awful. It's awful. It's the do not do any workplace. Could you imagine if cars were built on chain, they went right down a path, the first owner was on the chain, the next one was on the chain? That's where we're headed. Imagine life insurance policies. Wouldn't that be great? If anybody's ever settled a life insurance policy, that is an absolute nightmare. So this is why I love the concept of tokenization. It's very real, it's very digital. And of course, I'm not here to talk about those real life things. I'm here to talk about the financial services vertical market. So at Broadridge, we've been fixated on this subject for a while. About 5 years ago, we invented and trademarked a concept called the ABCDs of innovation. And it was very simple. A, AI, that's the only time I'm saying that this time, just for the record. B was blockchain, it was right there front and center. C was cloud, which is now omnipresent. And D was digitization, which is also part of everything we do every day in life. These are profound technologies that we have embraced from day one, and it's made a massive difference. Now, let me talk a little bit about who Broadridge is. Broadridge sits in a very unique vantage point. We're at the center of what happens in financial services. We settle $15 trillion in trades a day. You know, that's kind of real. We are the veins and arteries by which the financial services system runs. And that's 7 billion customer communications. We have 150 plus global exchanges that we serve, 120 markets for trade processing we serve. In fixed income, our post-trade platform is the go-to-market choice for 20 of the 24 primary dealers, while 7 out of the 10 largest firms rely on our equities trade processing. So these are very real factors. And in this vantage point, we're basically a 60-year-old fintech grown-up. We became a public company about 20 years ago. I hope many of you can follow in a journey that allows you to become a big public company with 30 billion in market cap. We have intentionally disrupted ourselves over the years by leveraging innovation, technology, and driving digitization, and very importantly, democratization in the market. In wealth management, Broadridge provides a fully digital solution for the largest wealth manager on the planet. It's pretty exciting. We transformed our communications business to an omni-channel business. It was all paper years ago. Today, it's completely evolved. Today, what we do is 90% digitized communication for the proxy voting and information we send. So this vantage point offers a unique and direct view into the global market evolution. No other firm has this vantage point. No one is as excited as I am about disrupting us. You've probably heard of a little company called Eastman Kodak that doesn't exist anymore. Do you know that Eastman Kodak invented the digital photography, the digital photograph? But its paper and chemicals division said, oh, all our profit comes from over here. So they shunned that. That company doesn't exist anymore. The rest is history there, and we will not be in that category. The clients you see below are the people we do business with. So I'm really happy that it's 10 of the top 10 wealth managers, 29 of the top 30 custody banks. This is very important. Okay, so why does tokenization matter? We're living through a once-in-a-generation transformation. Truly, we're seeing 50-plus years of the way the infrastructure has worked, digitizing, tokenizing, and moving to inclusive of stablecoins, all in real time. Now, there's a regulatory backdrop that's becoming increasingly valid and enabling for this innovation, particularly the US administration, and Europe is really catching on. So this is not just this technology upgrade. This is a really transformational window of time where traditional assets that we know and love are going to move onto the chain of infrastructure. You're all here learning about all that today. So earlier this year, we did a Broadridge tokenization survey, which covered 300 institutions across North America and Europe. What we did was we asked them, where are you as custodians, asset managers, wealth management firms on your journey and your view on tokenization? 63% of the custodians said we were already on this and we're working on it. There was another 30% that said we have plans to do it in the next 2 years. By the way, they can't wait 2 years, okay? It's dog years in this game. You got to go very, very fast. But you can see that 90% of custodians are going to be engaging around this. In the asset manager space, 15% were already active. Some of those names you'll know, clearly BlackRock, Fidelity, Franklin Templeton, they're already in there, and 41% said that they would be moving along. Then there were the wealth managers. About 10% said they were engaged around tokenization. They're kind of looking around trying to figure it out. They're kind of fat and happy right now, but let me tell you, it's going to be a very big launch for them because now you can democratize and you can size up the way in which you want assets, private assets, to be able to be distributed through financial advisors, and it will give access to all of them. So why does tokenization matter? Well, it's not just a crypto experiment, all right? There's an element of governance that's really important. A lot of the speakers earlier today have talked about how important it is. SEC Chair Atkins just spoke about this. All the asset servicing things that need to be done still need to be done. Okay? If it's just token hidden, that's like an AML nightmare. That's not what it's about. You still have to do dividend flows, margin, you have to do options, all the things have to be done. So you have to think about how that's going to happen. Now, there's some wonderful advantages. You get instant settlement without counterparty risk. Imagine the global financial crisis. It took 4 years for people to figure out who Lehman's assets were owned by. Here, it's instantaneous. It's on the chain. Everybody knows the instantaneous transfer. So global accessibility, it's a micro marketplace because you can break down things to the smallest pieces. So it's really exciting. In the survey we did, 66% of the early adopters report greater transparency, better granularity, larger market opportunity. So this was really an exciting element for the survey respondents. And it tells us that, again, it's not a fad. BlackRock has launched the BUIDL fund. Fidelity has taken in billions in assets. BNY Mellon is working on a set of different asset services to do the asset servicing. So this is all coming together very quickly. Okay. Let's just dive in a little bit. I want to make sure people are reminded of the regulatory dynamics. The European Commission, the Securities Exchange Commission, they will all have more clear rules because they're working with people like us and like you to figure out how to enable this marketplace to become a more efficient marketplace. In 2023, BlackRock launched the BUIDL fund. It offers institutional exposure. That's a big deal because if you have the barbell effect, institutions that are really scale, very big dollars who take it seriously, it legitimizes things substantially. Pension funds getting in that game, really important. But you also have access to the retail investor. So it truly is making equality happen in investing. Other firms like WisdomTree are doing that, Robinhood's doing that, Invesco, Fidelity. It's now, it's not a matter of if they're doing it, it's just when will they be able to put it in the foray of things that they do to serve their clients. It will also further unlock fractional ownership of lots of other assets. We haven't really heard the expression NFTs in a while, non-fungible tokens. That is coming back to life. They won't really talk about it, but all assets, going back to the cars, all assets, art, other things can be put on chain, and the transfer ownership is, and the legitimacy, don't forget the legitimacy is really important. So I really believe there's a certain inertia. The adoption and implementation is because this is real. There are efficiency gains. It does create a more trusted and secure marketplace because of that ownership and legitimacy being there. So now I'm going to pivot to an example where it's very real. And the real dynamic is that Broadridge is the largest tokenizer of institutional assets in the world. We are tokenizing and have trading $380 billion worth of distributed ledger technology-based repurchase agreements. We chose repurchase agreements because it's a pretty risky, complicated margin collateral thing, even within firms. And we went from, it was 100 million earlier this year, it was 0 2 years ago. It is growing really, really fast. So it's modernized, it's very efficient. We have a Canton network play that we're a part of. We're the validator of the Canton network repo marketplace. We are announcing an ownership in a partial company with Digital Asset Holding and ourselves and others that will continue to drive growth in this asset class. Now, it is the beginning of more asset classes. This is a pretty inefficient asset class, which is why we went after it. Equities are actually pretty efficient, but it will be happening, and the reason that will happen is because we are on a path to where you're going to need to be competitive as an exchange by having at least 623 trading. Today, you can trade some assets at all hours anywhere in the world. There is no Greenwich Mean Time, per se, for trading in the future world. There is the ability to access markets, and this technology will enable that. Today, the exchanges are not competitive. I mean, they sort of have a 9 to 5 job. That's not how markets work anymore. But the technology is not where it needs to be to create real-time settlements, same-day settlements. That kind of thing is really an important aspect of where we're headed. You're going to have intraday liquidity, not just on assets that we're historically comfortable with, like a bond and a stock, but imagine intraday liquidity on an alternative, okay? Like on a PE-based thing, on a credit fund. We're getting to a place where you're going to have exchanges and liquidity available. Investors love that. They have a circumstance happen, they want liquidity, they need a place to go. A tokenized exchange will allow that to happen. The other thing that's important, as you see on this slide, is the regulatory dynamics. The regulators are opening their minds, they're engaging as part of the future versus historically what they did was they regulated the way everybody did things in the past, and they did a lot of regulation by enforcement, which means they would come in and see something that was done that they may have been doing before the last audit that was done, but nothing happened, and they do an enforcement. So that dynamic of where the regulators, the Genius Act, the Clarity Act, Europe has 2 acts that are in place right now that are making that happen. So tokenization is very real. It is live at scale today. It's just no longer theory. It's in companies that like ours that are very mature that recognize that if we don't drive this concept of modernization in real time and we stick to the way things were always done, that's going to be a sure mushroom cloud for old business. And what we're doing is also partnering with many of you where you are being able to bring unique capability sets that can be globalized because we have a footprint around the world, and I already described how many institutions that we work with. So our DLA platform has showed the world that tokenization and repos can reshape things. It has lowered collateral requirements. It has reduced the cost of capital. It has removed daylight overdrafts. These are the kinds of things that make for efficient markets, less cost, and institutions can be more profitable and also be able to provide better services and reduce risk. So those things are all important. I guess what I would say is sort of the first part of my slide, that tokenization is real. It's happening every day around us. In some respects, it can't go fast enough because, like I said, why can't Toyota make their car be on a chain that then just runs down the line for every owner until it doesn't exist anymore? We need that to happen in the broader world. I don't work in that world, I work in this world. So what we're trying to do is reinvent constantly, lower risk, work with the industry, and figure out a way that everybody will be better served. So tokenization is the real thing. It's been a pleasure to spend time with you. Thank you very much. Have a great day.
All right. Thank you, Chris. That was really insightful. And we are moving on to an amazing panel up next, some heavy hitters, The Future of Value, the next era of on-chain coordination, moderated by Chainlink Labs' Fernando Vasquez. Please welcome them.
Good morning again. I hope you enjoyed the first half of the day. I think we are the last thing standing between you guys and the lunch break. So we'll try to open your appetite. I actually have three great panelists with me. Sarah Hammer, Managing Director of Schwab, John Ehrenfeld, Head of Strategy at Swift, and Ed Budd, Chief Product Officer at Partior. Why don't you guys start by telling us a bit more about you guys and also your organizations? Because some people might not know what, let's say, a Partior or Swift play in the value chain of digital assets of traditional capital markets. It would be good to do that to set the context. So why don't we start with you, Ed?
Sure, thanks, Fernando. So Ed Budd, Chief Product Officer at Partior. We are sort of in the deposit token space, so think of us as the 4-year-old network that's been looking at moving that type of fiat between banks in a very correspondent banking style mode. That's done on a quorum network. It's been live for 4 years now, and it really focuses on that cash value transfer layer. Moving now more towards the world of settling capital markets transactions, so into the FX and DVP space. So it's a movement by a number of the large banks to really try to digitize that process. It's been it's been a long road given the regulatory positions of the past, and now that's a point that's accelerating.
We'll dive into that later. John, do you want to go next?
Yes, well, thanks for the invitation. I think I can claim that I was the only one wearing a suit on the first SmartCon in New York. That's not the case today, so that seems that the industry is changing, right? So I represent Swift. I think by now everybody knows what Swift does, but I can give you the high-level pitch, right? We connect banks, we connect corporates, we connect brokers. We have 11,000 endpoints in a network that is highly secure. We also develop messaging standards for banks to communicate themselves, and I think we're using all of those assets to also start moving tokenized value, which is one of the things that we'll discuss today. So I'm super happy to be here again.
So Sarah, you go next. You play a different role in this, value chain. Can you tell us
Yeah,
more
thank
about
you. I want to say first thank you to you, Rory, and to Sergey for inviting me today. It's an honor to be here with these incredible colleagues. I'm Sarah Hammer. I'm Managing Director at Charles Schwab. I head trading, digital assets, and artificial intelligence compliance for the firm. I'm new, less than 4 months in. And just a bit of context, I came from academia, served as Secretary of Banking and Securities for Pennsylvania during the banking crisis, was also Deputy Assistant Secretary at US Treasury, and my background is actually originally trading and portfolio management. So my views reflect my own today, but I can certainly speak from a number of different perspectives on the asset management and broker-dealer side.
Thank you for the introductions. So I will discuss in other panels, traditional finance is slowly, organically growing into DLT, blockchain-powered future. And in that context, you hear a lot of people mention on-chain finance, but that term, on-chain finance, means different things to different people. It can be anything from tokenized deposits to stable coins. And could you share with us how do each of you define on-chain finance in the context of institutional payments and settlement? Why don't we start with you, Ed, and then we go to John and Sarah.
So I suppose for us, the focus area is the movement of that representation of fiat. That's done in the context of bank-to-bank payments and in the context of settling capital markets transactions. So we've focused very much on what's called these days the deposit token part of the spectrum. So providing that layer, and importantly, the way we see it is less about the technology that enables a number of things and more about the rule book and the legal framework behind it that provides. I think a few panels before us talking about governance and the boring parts. That's the part of the value chain that this really represents, is the legal framework around which how that value moves. The enabling layer is the technology here.
And can you tell us a bit more about your approach in terms of the chains that you support? Whether you have your own chain, and do you see a future where the cash leg and the securities are the same ledger? Can you tell us more about your philosophy?
So Partior is a good example of something in the TradFi space that started before the public infrastructure space was available for those types of regulated activities to be on-chain in the public sense with the regulatory and legal certainty that I think is now closer today. So its approach is a network for just the value movement of that fiat, but it sees it as fully on-chain. It's settlement finality on-chain. They are the books and records of the banks on-chain. There isn't a secondary reconciliation process or another thing that goes on behind the scenes. So the step of moving towards that public infrastructure, public network model of that instant and value transfer with finality it's a stepping stone, given that they started 4 years ago when those technology choices weren't quite available.
Thank you, Ed. So John, what's your take on this term, which is a bit loaded? On-chain finance?
I would say that I don't see on-chain finance as completely different to what we have today, right? That the main difference is that from a technology point of view, the assets that you are issuing on-chain, they also contain the settlement logic that you need to actually settle them, right? So the main difference is that, right? Everything else, and I think we'll discuss this today, remains the same, right? Whether it's the compliance, whether it's the governance, whether it's that's not going to change, right? I think there will be things that will have to change, and we'll discuss later about, I think, where compliance meets cryptographic truth. That's one piece of the puzzle to solve. But I would say, honestly, other than just having the asset with the settlement logic built in, everything else is going to be the same. You will still need banks, you will need trust, you will still need governance, you will still need connectivity and standards, etc. Right? One big way of looking at it, or a different point of view of looking at it, is that for us, it's not going to be real finance until it reaches the levels of scale and of volumes that we have today on traditional platforms. Right? Today, we move the world GDP every couple of days. I cannot even put the number of zeros in that, right? So it's until the moment that you have those volumes, then the reality is going to set in about what it means, right? I think for now, as Tom was saying before, we haven't reached those levels. And that's going to be the true to see whether we can call it on-chain finance.
What about you guys, Sarah, as a broker-dealer? What's your take on that term?
Yeah, thank you so much. I really appreciate what Ed and Jonathan said. And I think to Jonathan's point, when I think about on-chain finance, I go to what are we trying to do? And I think we think about, are we helping investors invest, improve their financial lives? Are we speeding transactions, clearing and settling, for example, reducing inefficiencies, reducing risk, and reducing cost? And so we know the things that we are trying to do in finance, and then we think about how can blockchain and digital assets improve that. So that's actually the reason I originally got into blockchain and digital assets, is as a trader and portfolio manager, it was very apparent what the inefficiencies are of trying to clear and settle, whether it's T+3 or T+2 or T+1, right? So blockchain can help us reduce that time to almost nothing, and in the process, save money, increase efficiencies, improve communication, and bring potentially new capital to the markets. And we haven't started talking about tokenization yet, but that's something I really think about, and that's part of the purpose of our financial system. So bringing that on chain, but then again, as Jonathan mentioned, there are a number of things, operational, regulatory, for example, policy issues that we need to discuss in order to facilitate on-chain finance and to think about how will it change the processes that we have now, for example, around compliance or settlement finality, and what part of that do we want to keep or try to emulate in some way in the blockchain? So that's where I come from, is what are we trying to do in finance, banking, trading, asset management? How can blockchain do that better? And then what do we need to enable that to ensure that we're still maintaining the values and principles of the financial system that we want to maintain, but at the same time reducing cost, increasing access, allowing cross-border payments. So that's how I think about it, and I'm excited to hear more from my colleagues and you about what they think about it.
I like that you mentioned processes, right? Because as we bring the new tech, we might need to revise certain processes. And the project that we've seen in the past with Web 1.0, Web 2.0, moving fast and breaking things, that doesn't work here. The stakes are super high. We certainly shouldn't break payments where we're moving the whole GDP of the world in 2 days. That's not an option. So I'd like to maybe use an actual use case to basically try and go a bit deeper in this on-chain finance discussion. As many of you might know, Swift, UBS, and Chainlink recently showed that you can use ISO 20022 messages to trigger on-chain fund subscriptions and redemption. I'd like to ask John, what did that collaboration reveal about extending existing messaging standards into tokenized asset workflows? And particularly not just the standards, the technical standards, actually existing processes within banks. Is it actually possible to interact meaningfully with, on-chain business logic without needing to replace all the back office, middle office, risk management?
Yeah, it's a great example. You have a major bank, major wealth manager, UBS, issues a money market fund on chain, then you need a whole ecosystem to work that. You need transfer agents, you need those that are going to subscribe to the fund, you need those that are going to redeem from the fund, you need the investment manager, you need the bank itself, and then you need everybody else that is itself, pension fund, mutual funds. They need to trust the system, right? If you're going to put money on these new tokenized money market funds. So I would say we work on these projects as part of Project Guardian on the phase 1. Then we moved on the second part of the second phase of this project that we announced at Cybos. I think it shows that you can trigger on-chain events, in this case subscribing or redeeming from a fund, using a good old Swift ISO 20022 message, right? Because the reality is that even if you are a technologist, and even if you think that every single bank in the world will start interacting with chains using a node or even an API, you're up for a big disappointment, right? Most bank systems they run on COBOL or even something that I don't even know what it is. And even the most sophisticated ones, either for regulatory reasons or for legacy reasons, they understand Swift in, Swift out. Yep. So you can have a number of functionalities on chain that are the best, including a issuance of a money market fund that maybe gives you more yield. Maybe it's better too because overnight you can go and invest that money into DeFi applications, whatever it is. The interaction from the banks, legacy systems and back office into these chains will need to happen with technology and standards that already exist. So you have messaging standards, you have CRE or other technologies of Chainlink on how to translate these messages or interact with these chains. It's the perfect marriage of technology with legacy systems into a non-chain functionality.
I would argue that there's a different way of interoperability. Chainlink is pretty well known for being able to connect, different chains with each other and bring, data off-chain on-chain, but connecting, existing core banking systems to DLTs is also interoperability, right? So I think that's one of the many ways that we at Chainlink and partners like these people here sitting with us in this panel will make this transition of finance into, again, a DLT power future. Again, it's not scary, it's going to be organic. So this is a good takeaway for those of you who work for traditional banks and asset managers. So we're not taking any shortcuts here. One more question for you. During Summit, you mentioned that you were working on your own blockchain. How do you see interoperability between the Swift network and other chains playing a role in connecting global infrastructure? Because I would argue you have the biggest banking network in the world, right? So how do you see that playing out in the next few years?
Yeah, I would say for us, the most important piece now of this sort of evolution of our technology to continue to offer interoperability into the chains is it has three components. One component is how the bank's legacy connects into the chains, as I mentioned now. A second piece is how chains interact between them, something that CCIP does very well. And then the third component that we announced at Cybos is the launch of our own ledger, right? So why Swift would go into having a own ledger. And I think a lot of people have sort of see it as a side initiative of Swift, but the actual evolution of our technology has always been like that, right? So we used to have our own cables. Now when internet happened, we actually built our network over TCP/IP, right? Now you have this evolution where you have on-chain finance happening over decentralized public blockchains. It only makes sense that our evolution also works so that you have part of our Swift network, especially on the cross-border payment side, as Tom explained before, that runs over blockchain. So this ledger needs to be interoperable with others because it would be absurd for us to claim that we're going to be the only ledger that will have all liquidity and all assets. Nobody will ever be able to do that. So ledgers will have to be interoperable, and that's our reason to exist, is to interoperate with multiple systems. So our ledger needs to also provide that. Now, our ledger is not going to be as any other ledger in many ways, right? It has to be secure. Our levels of security, not any level of security. Post-quantum ready, has to be cyber ready at our levels of security. It needs to be interoperable, and then it needs to be co-designed by the banks. We're building this ledger with 40 banks. We have a prototype that we built with consensus over an L2 over Ethereum mainnet. So it has a number of things that makes it a real blockchain. It has a number of things that makes it a Swift-graded, bank-graded infrastructure, which is going to be different than others.
This is a good segue into my next question to Ed. I'd like to see how that would interact with something like Partior. And Ed, your Partior have been pioneering programmable settlement between banks for quite a while. I would like to say, what are the use cases that are the closest to scale adoption within the Partior ecosystem? Is that cross-border FX, liquidity optimization? Can you give us more color on what you guys are doing?
Sure, and maybe just to reiterate Jonathan's point there. So in terms of standards and dealing with institutions on their existing footprint, so message structures, process structures, Partior operates using ISO-only messages. It hasn't, to invent something new is utter madness to really connect people, but that's not just on the message level, that's also on the process level. So, for those that don't know those standards, you have CBPR Plus in there, which is all of the intricacies when you get into the wholesale and institutional world of making payments between banks for large value on behalf of other market participants. There's additional processes that go on behind the scenes. And all of those have got to be catered for, and they're in all of those standards already. And so there is Partior is a good example of something that hasn't reinvented any of those. It's moved that value on-chain without needing to do that, and that's actually a really critical adoption point. And so the areas that it helps adopt are, cross-border payments is a foundation. So it's obviously a lot of friction in that world today. But really it's a foundation for broader settlement liquidity activities. So the things I see closest, and it's closest not because the technology can't enable other things, but because I think the participants see the biggest balance sheet benefit from actually getting these things to work end to end is the key. So when it comes to intraday FX settlements, so FX swaps in particular, or intraday repos, those are very low volume, high value markets. They are all about balance sheet benefits. They're a very different proposition to retail payments at scale, for example. But the participants are driven by financial outcomes. They're driven by doing something that makes a demonstrable impact. So if we stay in the wholesale institutional space, between those intraday balance sheet focused activities and then collateral optimization, which is a separate topic but connected, because a lot of collateral processes, particularly at CCPs, require cash first and security second, and those rule books aren't changing anytime soon. So we've got to make the two work together. But from a payments perspective or a cash perspective, it's very much the cross-border payments moving into the intraday FX space and then interoperating with those platforms with collateral on them. And my view is some of that interoperability will hopefully be unnecessary in the not too distant future as some level of convergence of how these platforms operate and the availability of new infrastructures for them to move
So
into.
a quick follow-up before I go to you, Sarah. As the messaging and seven networks begin to overlap, what you guys are building, how can Swift and Partior work together to form a shared interoperability layer for on-chain payments? How do you see that playing out? I hope it's not a trick question.
No, I mean, I think we're already working together in the sense that you need the messaging standards to enable to interact, right? I think, again, there's going to be multiple chains for multiple use cases, and then there's going to be multiple applications of how banks use it. In the end, the banks that also are our shareholders are also the main shareholders of Partior. So I think at the end, banks, they don't want to have fragmented liquidity, fragmented systems. So I don't think there is a future where all of these things, they need to collaborate together. Otherwise, the banks are not going to be happy, and we know that, right? We know that very well. They make sure that they tell us that all the time.
So a question for you, Sarah. Are these guys building what you guys need in terms of being to serve the needs of your clients who might be asking you, oh, I want to have access to tokenized securities. I also would like to get settlement services on chain, or I'd like to be able to use Swift, or I want to use my treasury management system to make payments. How do you see the landscape?
Yeah, that's such a great question, Rory. And my colleagues touched on, Ed and Jonathan touched on a few things that I hope we circle back to. One is interoperability, which is a really important discussion, and then there are certainly a lot of things that are still being worked out around that on the TradFi side. And many institutions have different solutions, right? Some institutions are in multiple chains. Other institutions are in private chains. And then the question is, how are they interoperable, and what does that mean for us to enable tokenization? And the other one is collateral, which is something I love to talk about as a former trader and portfolio manager. And the attributes of blockchain and digital assets, for example, and how that can help us improve collateralization and reduce the need for it potentially, whether it's through an atomic settlement, for example, or really just tracking collateral in a way that improves the system that we had during the great financial crisis when Lehman blew up and we had rehypothecation of collateral and the whole thing was very messy. So those are 2 points that my colleagues made that I think are really important. You know, on the client side, you asked about demand, and I think that's the question, right, is what are clients asking for? And how does what we're thinking about in the blockchain and tokenized world comport with that? So are clients asking for tokenized products? And what do clients think about these underlying processes that we've been talking about? And I think there's sort of 3 different levels. So one is, I really think clients are generationally different. And this has been proven by a lot of research that's being done across the industry. So there's one generation that thinks about traditional finance and certainly would be interested in the efficiencies and the optimization that tokenization can offer. And that generation is also thinking about wealth investment, how can they better manage or even port their portfolio in a tokenized world, and what are the instruments and assets they would like to get access to, whether it's tokenized private funds, for example, or cryptocurrencies in the form of ETPs. That's one thing. And then I think there's a generation, and probably many folks who are here today, who think about investing in a totally different way. And one of the issues that's been raised is the idea of a super app. So what would a super app be? And you know, without advocating for one thing or the other, the idea of a super app is really that you have all of these capabilities in one app on your phone where you can not only look to blockchain and to digital assets to help you invest and invest in those asset classes that I mentioned, but also optimize and rebalance your portfolio. And again, you know, without necessarily advocating for one thing or the other, give you access to brand new types of markets, for example, prediction markets. So the idea is that a super app would allow folks to be able to do all of those things on their phone with one click. And I think the demand is different across generations, but what we can offer and my colleagues can offer in the world of blockchain and tokenization can provide those kinds of opportunities across different investor sets. I'm not sure that retail investors or high net worth really think about the trade processes that we're talking about here today. I know we find them interesting, but I think it's an essential part of the conversation because it goes to the heart of what we can offer. And so I was actually explaining to someone from TradFi the other day how the world would work if we moved to a fully tokenized world, an on-chain world, for example. And the idea of going to automatic market makers, for example, where price might be set by an algorithm and the dealer and broker-dealer means something different or doesn't mean anything at all in that world. And the idea of what is a transfer agent, can blockchain be the transfer agent and the ledger serve as books and records, you know, all of that is very new to a lot of people. And this person kept asking, well, how do you know that the settlement is final? How do you confirm that? And it's hard to explain unless you start from what are the attributes of blockchain: decentralization, immutability, transparency, that whole piece of it is completely different in the world of blockchain, and you have these efficiencies. But as we've talked about today, you also have all the operational issues that we need to talk about. How do the compliance processes work? Can they be on-chain, for example? Is there legal recognition of settlement finality? So that piece of it, I don't know that investors think about it, but I do think it's really important.
I can relate it to that, and Jonathan, you alluded to that, right? That you're building institutional grade rails, or security, privacy, availability are critical. Could you share with us what are the safeguards that are critical to protect client data and transaction confidentiality as these workflows more and more move on-chain? No particular order.
Well, I mean, I think it's to the point of Sarah, right? So I think banks need to get used to how blockchain technology works and that many things are different. Reconciliation, zero, immutability, transparency, cryptographic truth. You need to trust that, right? Today you trust a counterparty, you trust a central agent. Tomorrow you will have to trust an algorithm or a mathematical equation, which is hard for some people to understand. But then the blockchain world needs to understand everything that happens on chain. That's not going to change, right? KYC registries, compliance checks, all of these things will continue to happen, many of those off chain, until there is enough functionalities that are embedded into the chains that the regulator and the banks are comfortable. So it's sort of like a meet in the middle type of thing, right? For me, that's going to be key for confidentiality, etc. What you want on chain, what you want on chain until everything goes together. But for now, there's a clear separation between the two.
Absolutely. Thank you for those comments, John. It's a good segue into the closing remarks, actually. Because I would like to see how you guys see the end game. How do you see things playing out in the next 5 years? I would like to see how you would define success and what you see as the main potential catalyst, right, to make these convergences between the traditional finance and on-chain finance actually happen, and what do you see as the biggest risks? So let's start with you, Ed.
I think for me that the key, lending to some things that Sarah said, it should be invisible in terms of the pieces that we're doing around settlement, that the end customer really shouldn't care but should trust, and legally those things have all been tested. Having that on true public infrastructure, I think is viable in that time frame. I think there'll be stepping stones on that journey, but ultimately we're going to be able to get there a lot quicker. We've been doing this for quite some time now, but it's definitely now within that time frame we're going to see the types of things we're talking about invisible in the background on that public infrastructure.
Thank you, John.
I would say I think we're on year zero. This is today is where this starts. We have the regulatory clarity. We have the institutional trust now. You have the banking community working with the crypto community, which in levels that we've never seen before. So for me, I don't know. I cannot predict what the next 5 years are, but I can tell you that last year we were not year started. I think this is the first year that this is going to ramp up.
Sarah?
Yeah, Fernando, thank you for that question. This is the question, right? What does it look like? What does success look like? And going to the issue of what are we trying to do? And in my mind, that's a world where we have worked through and addressed the issues that we have talked about today and achieved our objectives of reduced costs, efficiency, settlement finality, and opened up more investor access and opportunities for investors and for financial institutions, whether that's real assets, whether it's private funds. That's the whole world of what are we trying to do, and I think success looks like us providing those things that we want the financial sector to provide.
Just one final comment. I think some of the roadblocks, regulatory roadblocks, are finally out of the way. So I think now it's up to us. And I think that many people in this room are agents of change. So it's going to be you guys working with Schwab, Swift, Partior, and Chainlink that will make this happen. Enjoy the rest of the conference and have a good day. Thank you.
Thank you.
Thank you. Thank you, man.
It's been an incredible morning. We're going to go ahead and break for lunch. There is food on every single floor, so please make sure to walk around, check out the Link luncheonettes. We have an exciting afternoon lined up with Chainlink's co-founder Sergey Nazarov taking place right after lunch, so please be back by 12:55. And to all of our virtual attendees, thank you for joining us online. Programming resumes shortly. Thank you.
Check, 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 check. Hey, 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 hey. Check 1, 2. Hey, hey, hey. 1, 2. Hey. Check, check, hey.
Our program will resume in 5 minutes. 5 minutes. Please welcome back to the stage, Zubin Pretap.
Everybody, welcome back. Hope you all had a nice lunch, got some energy back into you, maybe tapped your cards around, met a few people, made some introductions, talked about Chainlink in the future. Up next, we're going to have a talk about the next wave of on-chain growth, and it's going to be delivered by Nate Holliday, who's the CEO of MakeInfinite Labs. But before that, I want you guys to check out this video.
The world is changing faster than ever before. It's one of the most exciting times to be alive in human history. But if you're a young person entering the job market, or paying off student loans, or trying to buy your first home, the future may also feel uncertain. That's not the world we want to leave to the next generation. So we're building a new one. Blockchain is about empowering individuals to own their future. We believe that's more important than ever in an AI-powered world. DreamSpace gives individuals the tools they need to create apps by chatting with AI, monetize their business on-chain, and win in the AI economy. Built with Microsoft and powered by Space and Time, DreamSpace is built for everyone, not just those who already know how to code. With DreamSpace's AI app generator, smart contract tools, and built-in community distribution, it's never been easier to bring your ideas to life and build a better future for yourself with blockchain technology. Generate your first app today and win in the AI economy with DreamSpace, powered by Space and Time.
All right. Hi, everyone. My name is Nate Holliday, co-founder of Space and Time and the CEO of MakeInfinite Labs, a research of AI and blockchain development company here in the United States. First, I have a question. How about those build rewards? All right. Today, I'm going to talk a little bit about creatives and the next wave of on-chain growth. Look, it's no surprise if you're in this industry that large institutions are coming on-chain. Big banks are coming on-chain. If you follow Chainlink at all, you're seeing all the announcements around banks and institutions that are coming on-chain. Space and Time and MakeInfinite Labs are working with large banks throughout the world, US Bank, Fidelity, UBS, and others. With a tamper-proof database and with oracles on-chain, right, we now have the infrastructure that we can power all of these banks that are coming on-chain. And it's great, right? What does that mean? That means that the banks are going to continue to get bigger, that more on-chain applications are going to come on, that more transactions are going to come to the chain, and it's going to get bigger and bigger. And for the protocols like Chainlink and Space and Time and others that work with these banks, it's going to be great, right? But one thing that we're missing here still is mass-scale individual adoption. If we look at the Electric Capital report, there's 27,000 developers that are building applications and protocols in Web3. And that's great, right? And they go and they get rewards and they get incentives to build on blockchains, and they go from one blockchain to the other, and they're hoping to build applications that will power the future of on-chain businesses. And a few killer apps have come, right? We see Pump, we see Polymarket, and there's a few killer apps that have mass adoption. And that's really great, right? They go out and they get usually VC funding, and they build cool applications, and they go get developers on their team, and they can go build really cool applications and new businesses of the future. But A16Z just had a research paper that came out, and they estimated about 70 million people are today in the crypto industry. And my question for us all is, what do these 70 million people do all day? What are these 70 million people creating all day? And what tools can we provide them that they can go and create businesses on-chain? Today, we're introducing a creative platform for the 8 billion individuals throughout the world. Generate applications using AI. Deploy apps to any blockchain. Monetize your business on crypto rails or not on crypto rails. Right now, anyone can build a business of the future independent of what school they went to, what education they have, what their network is, what VCs they know, whether they have a lot of friends that are developers, and that if they have a creative idea, We want to unleash their potential to build something of the future. We've co-engineered this with Microsoft and are launching this. And it's really exciting because for creators, they can create an on-chain business from idea to an application in a matter of minutes or hours. It's easy to monetize this. It's fully deployed on the blockchain. You have built-in distribution through various blockchain ecosystems, through space and time and other ecosystems. You have complete built-in distribution. And what about for the protocols? Protocols that we're working with love DreamSpace for one reason, right? Before this, what would happen? They would run a grants program, and they'd say, hey, come submit your grants, and we'll try to pick the best projects, and we'll give you a grant to come build on our blockchain, and hopefully it works. And if you got the grant, then you'd go out and you'd build your protocol or your application, and you'd come back in 4, 5, 6 months, maybe a year, maybe 2 years, and you'd be like, here's what I built. And hopefully it takes off. For protocols now, they can start to align incentives to applications that are product market fits for their blockchains, right? Come build, come show user growth, come show revenue growth, and for that, you'll get incentives based off of growth, right? Because with proof of SQL and with verified database technologies through space and time, now we can track user growth, revenue growth, any monetary means that you can align incentives to. And this creates a flywheel effect that more apps come onto the ecosystem. Whether you're a developer or not, if you have a creative idea, you can now build in crypto. So what does this mean? This means that you can now build anything on the space and time ecosystem. If you have a DeFi app, if you have a social app you want to build, if you have a bakery you want to start up, or a pizza joint that you want to start up, right? Any app that you want to build, you can build. Right? My son, he's almost to the age of where money matters to him, right? He wants to get a job. And he says, Dad, I need a job. I said, well, go start a dog walking app, right? Go to all the neighbors, right? Go say, hey, I'll walk your dog. Sign up on this app. You can pay me. You can pay me in dollars. You can run a credit card in Stripe. You can pay me in Link tokens. You can pay me in space and time tokens. You pay me whatever you want, right? But anyone now can start up a business if they have a creative idea. Look, I think we were put on this earth to create things. And far too often, society has become a consumer society, right? We all consume, but very few create, right? When we think about the world of on-chain finance, right, there's going to be a large institution. It's going to be wonderful. And like I've already said, I'll say it again, protocols like Chainlink and space and time that are servicing these large institutions and banks, it's going to be a great environment for them. But we need everyone to participate. We need everyone to create. So far, we launched this just 2 months ago. We have 150,000 active or committed users. You might have followed us. If you follow us on Twitter, you'd see that we signed the largest institution in Indonesia, 60,000 students. And higher education, a university, is now running DreamSpace AI labs to create new and unique experiences for their students. Over 32,000 applications have been developed. There's over $17 million in ecosystem revenue. And there's tier 1 and ecosystem blockchains, over 15 partners. And so today we're announcing the launch of these protocols on-chain with DreamSpace, co-engineered by Microsoft, for these ecosystems, and we're going to be building more and more across the partnerships in the industry. So with that said, I want to thank you for your time. I just want to end on this. It's time that more people get involved, right? It's time with AI and the emergence of AI, with DreamSpace and space and time now, you can generate any type of application or business that you want. You can start to monetize that. You can deploy it to communities, and you have built-in distribution with it. And at the end of the day, right, the economy is changing, right? We are moving to an AI economy where those that create and have ideas and can generate ideas and put them out there fast into the market and gain mass adoption and ramp scale are going to win. And it doesn't matter if you have strong technical background or not. The future belongs to the creators, and what we're doing here is allowing anyone to participate and win in the AI economy. Thank you for your time. Hope you have a great time in New York City. Thank you.
Thank you, Nate. Now, next up, we're going to hear from Sergey Nazarov, the co-founder of Chainlink. Thank you. Are you going up?
Sorry, is it turning on? Thank you. Great. I appreciate all the excitement. Very good to see you as well. Excited that we're back together again for another great SmartCon. Thank you all for coming together. I really appreciate it. I think this event, is kind of always an annual watershed event for all of us to get together in the Chainlink community and learn from each other and really see how we can get Chainlink to go to the next level. I'm really excited by the great mix of people I see here and at our events, which are the DeFi folks, the crypto degens at extreme degen capacity with like the extreme degen capacity. And then also the TradFi folks, which is an interesting mix of people. But I think we're still trying to make it happen. But it's slowly happening. Slowly, everybody's realizing that working together is a good thing, which is great. I think it's also a really exciting time for our industry. That's at a kind of unique moment where it's going to go, in my opinion, now mainstream. And for the longest time, I've heard about everyone's desire from the earliest days of Bitcoin, when it was about microtransactions rather than store of value, about the mainstream adoption of our industry. And so I think that's a shared goal that our community and every other community has, is how do we make our industry go mainstream? And my view on that has always been that it has to be extremely collaborative, providing value to all parts of the world and all different ecosystems. So my view on that has always been that you don't need to eliminate a whole bunch of parts of the world. You need to bring them into the fold. You need to make them run on the technology that represents our industry, and you need to force them to run in the ways that our industry defines as correct, which makes certain issues impossible and makes the world work better. So I think we all know and we all agree and we all understand that the Bitcoin white paper came out of the 2008 financial crisis There were a number of large issues before the 2008 crisis. There's been a number of issues since then. I think it's always good for all of us to remember kind of what we're doing. Yes, we're building DeFi. Yes, we're enabling the degens to make unbelievable amounts of money in DeFi. And I'm very happy about that, and that's a great thing, in addition to all the other great crypto stuff. But you know, the reality is that I think our industry was really started to solve a fundamental societal problem about how systems that hold value and that allow people to transact work. And that the failure modes of those systems, you know, whether that's Lehman Brothers or Silicon Valley Bank or any other number of examples, even some examples from our own industry, that those failures really shouldn't be possible. That the system, the financial system, should work in a way where it isn't a broken set of promises, and it isn't a broken set of assumptions, and it isn't a bunch of people quietly deciding to screw over society to their benefit and to the detriment of the rest of society, right? So that's, I think, one of the core ideas of Bitcoin, which started our industry. It's been one of my core ideas as I've been in this industry for a while. And I think now, as I think about mainstream, what mainstream means to me is solving that problem in a way that brings the existing financial system on board with our industry. So making the existing financial system and the DeFi degen community very compatible, and to have their economic interests align and to have them help each other become successful. And that is the thing that's going to both take our industry mainstream and enable this technology to get adopted in a way that actually powers the world rather than just powering a subset of the world, right? So what do I mean about this technology and why is it better? I mean, the first idea that we've always been talking about is cryptographic guarantees, and the idea that legal and paper promises are very limited in the sense that an institution or a person can give you a promise, but they don't really have to keep it. There's no system really making sure they keep it. Whereas cryptographically and mathematically guaranteed events like smart contracts and blockchain transactions and Oracle networks are guaranteed. And so this cryptographic guarantee is something I deeply believe in, I feel a lot of us here deeply believe in, and that it's something that's a new way to guarantee relationships between people, where there's a mathematical guarantee about our relationship. It's not a guarantee of my choice or your choice or anyone else's choice, or whether we like each other or don't like each other, or whether we agree with each other's politics or don't agree with each other's politics. But it's just codified what our relationship is, it's mathematically guaranteed, and that's how it's going to work, irrespective of anyone's desires or choices or views, which I think is the better way for the world to work. The second key foundational idea, I think, has been smart contracts, and smart contracts as a single source of truth, right? So when you folks go on Etherscan, or when you look into blockchain transactions at an institutional level, you're looking into a cryptographically guaranteed single source of truth, right? This is the definitive record of what happened. This is definitively what happened with ownership, or in the case of Chainlink and Oracles, it's the definitive thing that happened with data or identity or cross-chain or a number of other things that we'll talk about. But the single source of truth and the golden source of truth idea, I think, is extremely valuable. It's something that the internet and technology companies tried to achieve in the 80s and 90s, and they were unsuccessful. And now I think our industry is actually the one that's going to achieve it by taking all the different records and systems and transactions and decisions out of everyone's hands and putting them into a smart contract. And getting a smart contract to hold the truth, to operate against the truth, and essentially make the decisions that were codified between us, irrespective of our views or feelings, and to make sure that those decisions meet all the conditions that I need them to meet, that you need them to meet, and that in the case of institutions, a regulator or a society needs them to meet. Now, I've been building smart contracts pretty much since the beginning of the beginning, and what I've seen is the evolution of smart contracts as a technology. Smart contracts were always attractive to me because they made misbehavior impossible. They made it impossible that people could do the wrong thing if they wanted to. And they could only do the right thing because the smart contract kind of forced that outcome. But really, the definition of what a smart contract is has expanded over the years. Circa 2014, 15, 16, I've really seen smart contracts be about, hey, there's a single chain. That single chain is doing token issuance and having a ledger. Maybe it's doing some voting with the tokens, and maybe there's some exchange. There's no DeFi, there's no data, there's no cross-chain, there's no identity, there's no institutions. There's just a chain, a token, your keys, another guy's keys, and maybe an exchange. That's it. That's what a smart contract is. When DeFi kind of enters the mix, you arrive in a world where you start to need oracles. And from my point of view, this is when the definition of a smart contract shifted from just being about a single chain to being about the oracles and the contracts across chains, right? So the oracle is a mission-critical key system that's driven by consensus. Chain A is a mission-critical key system driven by consensus. Chain B, mission-critical key system driven by consensus. The other oracles, same thing, mission-critical key system driven by consensus, right? So that is what I started to define as a smart contract in my own mind and in the mind of some of the people that I work with on Chainlink. And so that's kind of what Chainlink did. Chainlink provided the initial oracles for data, for various types of data, and then for bridging. And Chainlink had a lot of success doing that, powering the majority of oracles and oracle usage globally, and the vast majority on very popular chains like Ethereum. And the reason for that is Chainlink's reliability, Chainlink's guarantees, the quality of the data, the quality of the reliability and the uptime. One good example that I'm very proud of is the recent AWS outage saw the vast majority of systems in our industry go down, even though they say they're decentralized and highly reliable, including bridges, data oracles, a whole bunch of stuff that isn't supposed to go down if AWS goes down. Guess what didn't go down? Chainlink. So Chainlink stayed up completely. And this is just a recurring pattern. So there's a recurring pattern where there's market events. There's a recurring pattern where there's reliability events that affect both really high cost, high quality, top tier, tier one centralized systems, and affect what we think are the tier one decentralized systems, but don't affect Chainlink, right? So for me, it's actually really impressive to build a system that's this reliable with an increasing breadth of what it does. And that's what I'm going to be speaking to you about today is what is the increasing breadth of what Chainlink does. But it's always going to be important that as Chainlink does more things, it continues to be reliable because people don't put their money or connect their contracts or put value at risk in unreliable systems, which in my opinion is, whoever else is trying to do what Chainlink is doing is probably less, or in many cases, obviously less reliable than Chainlink. So far, Chainlink has, through this reliability and set of services and capabilities, enabled over $26 trillion in transaction value. A lot of that is across DeFi at this point, but if we're able to get institutional adoption to where I think we can get it to, then I can easily see another zero next to this number at a minimum. So I can definitely see a lot of adoption still left to be had and a lot of growth still to be had, both in the DeFi sector, but the institutional sector is a whole other story. The key thing that's happened so far with Chainlink is that it's provided different standards. It's provided data standards, cross-chain standards, compliance standards, privacy standards, which we'll share about today and tomorrow. And those standards have created lots of key services. And those key services have made really reliable smart contracts, really reliable next-generation systems, really reliable DeFi, now really reliable institutional applications. And that's definitely something that we're very proud of. But what we found actually is that there's two problems. In addition to having the breadth of services, right? So you do definitely need more and more types of oracles, more and more data oracles, bridging oracles, identity oracles, compliance oracles, now oracles for AI interactions. And there'll be more and more as contracts become more complex. And so you face the problem of creating more oracles in general of different types. And then the second problem that you face is really the problem of orchestration. So today I'm really proud that we announced that CRE is basically live and in production and available to write workflows for anyone. That's a really big milestone, I think, for Chainlink and the Chainlink community, because it introduces this capability of orchestration. Now, orchestration is basically the ability to coordinate multiple systems and services into one application. And the important thing to understand here is that as the definition of a smart contract expands to include multiple chains and multiple contracts on each chain, and as it expands to include multiple different oracle networks that provide data, compliance, identity, all these different things, the really big second problem, frankly, beyond making more oracles, is how do you organize all of this into a single application? That's pretty much the problem that we found. And I think what we're really trying to achieve with CRE is to become the unifying force and technology for simplifying that. So what I've seen in our industry before is that something like the EVM came in and it made it very cheap and efficient and simple to write smart contracts, whereas before it was a very complex process. But now the definition of a smart contract, from my point of view, has massively expanded, right? Now it includes hundreds of chains, tens of oracles, different data sources, identity sources, something that needs to give something to a regulator. That's what a smart contract is now, especially an institutional smart contract. And so what is the system that's going to simplify the creation of those things? That can't be a chain, because a chain doesn't do that. A chain doesn't coordinate oracles or make oracles. A chain doesn't coordinate other chains. There has to be a place that you run code to organize all the complexity of the different chains, the different oracles, the different data sources, the different identity systems, all the different requirements to comply into a single piece of code, right? And this is basically what we're enabling now with CRE, and our hope and our goal is that CRE will generate the next stage of our industry, just like the EVM generated this huge leap in innovation and growth when it simplified the creation of smart contracts. So please use it, give it a try, tell us what you think about it. We're excited to hear your feedback. It's live, it's in production, it's available to write workflows. Workflows are gradually being released into production and deployment for different developers. They're getting onboarded to start deployment at different rates, depending on their workflows, depending on what they want to do. But at the end of the day, I can definitely see CRE really powering the next generation of our industry if it's done the right way. And a lot of that depends also on your feedback and the Chainlink community coming together to build it, the right way. The basics of CRE and how it works is really the idea of workflows. Workflows is a common term in the enterprise and institutional world, where you basically build a workflow to manage a process and make an application work across systems. So in CRE, we have workflows, and those workflows use fundamental primitives like a chain reader, a chain writer, consensus, the ability to call APIs, the ability to manage secrets, the ability to do a number of things. And what it allows you to do is that instead of taking months or weeks to build an implementation that requires data, identity, cross-chain, you can now build it in hours, just like you can build smart contracts in hours or web applications in hours. So let me show you an example. This example is about the verification of reserves. Chainlink is already the largest provider of proof of reserves to the most stable coins, gold coins, commodity coins, all these different types of coins that need their reserves proven. But now someone can code up a proof of reserves proof on their own and basically launch their own proof of reserves oracle within CRE, and they can attach it to a stable coin, and they can do something called securement, which actually doesn't allow any more stable coins to be generated unless there's a reserves proof. So the proof of reserves part of the CRE workflow checks the custodian API. It returns the result on chain. The securement contract uses that to verify and approve or deny the minting of additional stable coins. right? So in the first part of this workflow, you have an issuer who wants to implement secure mint and proof of reserves. They don't want to accidentally mint hundreds of trillions of dollars in coins. They want to make sure that that doesn't happen because it's not so good for the coin or for our industry. And so they're going to avoid that by implementing this piece of code with one engineer in a couple hours. In the next part of the workflow, they can actually implement the automated compliance system of Chainlink, the ability to choose the policies that the coin has to follow. This ability to choose what the coin can and can't do according to the policies of the issuer is actually very impressive and valuable. It creates the first real compliance layer in our chain, which is one of the big hurdles to institutional adoption, right? So from my point of view, our goal is to do kind of three things. It's to grow DeFi into an even bigger and more successful industry by providing reliable infrastructure and better infrastructure for DeFi to innovate and build amazing things. It's to bring the institutions on chain, and that's where automated compliance and a lot of these things come in, because without these things, they just won't go on chain. They need to meet these requirements. And then it's to make it so easy and simple for DeFi to grow and for TradFi to grow and for both of them to work together with each other, that becomes a no-brainer, right? That it becomes a no-brainer to spin up a CRE instance, implement some part of your DeFi protocol in a way that it can ingest institutional money because it can comply through ACE. And then the institution is implementing ACE because it can use DeFi or it can work with other institutions. Now the automated compliance engine has verified the policy conditions, and it's going to do that by looking at all the different information. It's going to do that by looking at identity, the policies, and alerting that back to the system. The ability to manage these policies is really quite valuable and critical. And at the end of the day, what I really see happening with this is that you'll have institutional ACE users and you'll have DeFi ACE users, and they'll finally be able to transact. And you'll finally be able to see large amounts of institutional capital flow into DeFi because that capital can comply with the requirements to use DeFi, which right now it can't without ACE. The next part of the flow is CCIP. So we've minted a coin that we know is properly backed. We've verified it against our compliance policies, and now we're going to move it across chains. And all of this complexity for proving the reserves, complying with policies, and moving a coin across chains is organized and managed through a single piece of code running in the CRE. So to make something like this work, you would need 5 to 10 pieces of code doing different things, probably in different languages, in different places, and you wouldn't be able to show it to anybody because it'd just be some private code that you're running somewhere on some server. And that code is actually critical code that defines how this contract works. Now you have a single place where all this complexity around how to interact with systems, how to interact across chains, how to interact with compliance, how to interact with identity. You have one place where you can put it, and what this is really meant to do is, just like the EVM increased the efficiency of making smart contracts, this should increase the efficiency of making these advanced institutional smart contracts, where once again we believe the net new capital will flow into our industry from. We already see a lot of usage of CRE by institutions. So this is something we announced today between the Central Bank of Brazil and the Central Bank of Hong Kong, where they were using both CCIP and CRE. CRE was used for electronic bills of lading, working with Swift ISO 20022 messages, and CCIP was used to exchange various stable coins and central bank digital currencies, and then other assets as well. So at the end of the day, Chainlink really is the only system that can bring all this together, that can give you the ability to orchestrate all of this complexity across many different systems, give you all the capabilities like cross-chain, and I fully expect this example to start using the other capabilities of Chainlink as well. We also recently launched the Digital Transfer Agent standard. This is a set of contracts for fund tokenization. As you can tell from this diagram, CRE is very involved in how this works. And the thing I'll really direct you to is that you can't really build a reliable transfer agent contract without a system that's going to synchronize all these things back into it. And without reliable transfer agent contracts, you don't really get scalable fund tokenization. And without scalable fund tokenization, it's not clear to me how our industry is going to provide the next generation of high-quality real-world assets, right? So these are problems that we need to solve, and that I think CRE does a great job at, and then CRE actually will generate these templates and these contract standards, like the transfer agency standard, that's going to be very easy to implement. So if you wanted to use a transfer agent or make a transfer agent, or you are a transfer agent, and you suddenly decide, hey, you know, I really got to get this tokenized fund off the ground, instead of that being a 6-month process, that can be a 6-day process. And so now you're on the way to making a tokenized fund in a very small fraction of the time. UBS is now using this on production. This is another thing we announced here at the conference. And this is also very exciting because this is now on production and real, and UBS is using this for their tokenized funds, including the transfer agent standard and the NavLink standard, which is the ability to get data into the transfer agents. But the point is that all of these more advanced things are only really possible when you have systems that can properly execute them. And right now, there really isn't another system like Chainlink that can give you the data, the cross-chain transfer agency contracts, identity, and much less coordinated into a single workflow. That's just not possible anywhere else right now. We've also done a lot of work with top institutions using CRE and using CCIP and other systems recently as well. So ANZ and Fidelity did a transaction using CCIP and the automated compliance engine. I fully expect something like this to be running on CRE sometime soon. Then Connexus, JP Morgan's private chain, announced with us and using Chainlink for a transaction between their private chain and a public chain. And that is really based on CRE's ability to simplify the interaction between a highly regulated private chain and a public chain, in this case, a tokenized fund, right? So what you're seeing here is that a private chain from JP Morgan, the largest bank, with a ton of users on it, is now able to transact against public chains. And this is a great example of what I mean about how this benefits DeFi, because fundamentally the chain here, they have a lot of institutional grade stuff, but in a big way, they're a part of the DeFi movement, right? So this is what you're going to see more of, I think, from the adoption of CRE and the success of Chainlink standards, is you're going to see institutional transactions, but then you're going to see transactions between institutions and DeFi. And frankly, I think the more value that gets on chain from institutions in whatever form, tokenized funds, stable coins, doesn't matter, it just massively benefits our industry. Because the more capital, the more assets, the more cash that's on chain, the better it is for all of us. That's kind of just a simple fact of life from my point of view. We also use CRE in our work with Swift, which we released at the end of last year in Beijing. We allowed the Swift system to operate as it already operates, and then to lock assets on chains. We were able to build an entire application around this and use Swift messages to actually lock assets. And then we were able to allow the Swift system to do payments in its traditional format, and then for those payments to unlock the assets and to build an application around that. And the application allowed these transactions to happen, and then it returned back the single source of truth from the chain, right? So it proved two things. It proved that you can very efficiently use Chainlink and CRE to build flows around very complex existing systems, and that the on-chain records generated from the CRE workflows can be the authoritative single source of truth. And that's extremely valuable because once everyone in the world decides that blockchains and the data on blockchains from oracles are the single source of truth, that's the point at which I think we've truly won. Because if you control what is the single source of truth and the location where it is, you control how systems and the world works. And so we really need to be, that set of systems and standards. And I think that'll take the financial system and industry in a much better place where certain misbehavior is simply technically impossible. So I think it'll really benefit everybody. This was a really complex workflow, and we already built this with CRE at the end of last year. So we've been working on CRE now for some time. It's now released to all of you folks. It's live anyone can go write a workflow and simulate it and build workflows around a number of different templates and services and systems. And we encourage you to do that and are hopeful that you find it useful. If you have feedback for us, please let us know. And then, the deployment process of those workflows is happening gradually now. We're also building a really big ecosystem of high-quality data sources, payments providers, transfer agents, and all kinds of other service providers within the CRE ecosystem. And I think we'll also arrive at a place where any of you can build a service or a system on CRE to sell to another developer or to another consumer of that service. But some of the first folks that are starting to join this ecosystem just in the last couple of months have been some of the world's top data providers. So S&P Global, FTSE Russell, Tradeweb, and Deutsche Börse Group have all in the past few months started to put their data on chain via Chainlink. And I think that's because of all the institutional adoption that you see within the Chainlink ecosystem of CRE and the Chainlink standards in general. And I expect that to continue, and I think we're going to really build an amazing ecosystem around CRE. Once it's polished enough and it works well enough, we're going to really seek to grow the amount of data, the amount of services, payment systems, all the stuff that's easy to consume within CRE as a developer, or easy for you to add to CRE as a developer, either for your own use or for use by others. If you're interested in CRE and where it's going to go next, I encourage you to go to these sessions. We have a number of sessions from the product and business side on the left, there tomorrow, and we have developer sessions today on the right from our team and from Amazon Web Services. So you're welcome to go to these sessions and learn more about CRE and try it out as a developer. We're very eager to hear your feedback and looking forward to working with the community to turn CRE into a highly reliable, extremely useful, unparalleled in efficiency way to build institutional and advanced DeFi contracts, smart contracts. The other feature that I'm really excited about from a CRE point of view is privacy. So I've been kind of obsessed with privacy for a long time and implementing privacy well in our industry. It's something we've been doing a lot of research on for many years and working with the top researchers on, all the way back to the days of Town Crier, where we worked with Ari Jules and Fan Zhang almost 10 years ago now. I'm very happy to say that a lot of that great work with Ari and Fan and others, such as Town Crier and Deco, is now finally getting implemented in a unique and holistic approach within CRE. So the privacy properties of CRE will come from a long researched, kind of very well thought through system that is going to address the main problems of how to do private smart contracts on any chain. And the main problems there are disclosure of who the users are of the contracts, disclosure of the operations of the contract, and disclosure of the amounts and the movements of value through the contracts. And all of those problems should be getting solved through the privacy system running on CRE. How that system looks at a high level, and we're releasing information about this today as well. We're releasing the early version of this system later this year and early next year, and then we're releasing more of it throughout next year. The stuff we're releasing this year will be to a very select smaller group of folks, early next year to more folks generally, and then more general features and greater amount of privacy features during next year. But what it basically depends on is something called a Vault-on and Chainlink DKG, which is something that there'll be sessions on that you can learn more about. But what it basically does is it guarantees that your workflows in CRE stay private, your credentials to use the APIs to power those workflows with data or identity stay private, and even the outputs into chains can acquire a certain level of privacy, even if the chain doesn't usually provide you that privacy. And then all of the workflow code and all of the API requests can then be verified by your counterparty or whoever you want to allow to verify them, so that you have certain verification that the workflow and the system did everything correctly. So you don't have to rely on the trust assumptions of CRE or the decentralized Oracle network doing things correctly. You're relying on the trust assumptions of, in this case, an enclave trusted execution environment. But really, the approach we have to privacy within Chainlink and within confidential compute is that you should be able to use different privacy approaches. So just like the rest of Chainlink gives you options to get this data or that data, bridge this way or that way, check identity here or check identity there. You'll be able to choose different approaches to privacy, from trusted execution environments to zero-knowledge proofs to fully homomorphic encryption to a number of combinations of those different approaches. But there'll be more on this relatively soon, this year and then early next year. And there are sessions that you can go to from our research team where they're starting to share this with the Chainlink community, and they're starting to get feedback from their colleagues. We encourage you, if you're interested in privacy, to go see these sessions, learn about the approach, learn about how we're looking to generate Chainlink privacy. I think it's going to be very, very important for our industry. Privacy is really one of the key final big steps in getting our industry to power things on a mainstream global scale. And our goal really is to make sure that all of these services, the data services, the messaging services, the privacy, the identity, all of these different combinations of services and the orchestration of the services into advanced contracts is something that provides the reliability that's required to hold value, is something that's easy to use so that developers can quickly build high-quality advanced smart contracts efficiently and get them out into the market and become successful, and that meets the requirements of regulators and society and the world in general so that they can reach mass adoption at a global scale. Now, generally speaking, Chainlink is supposed to provide people choice. It's supposed to provide them choice about what data to use. It's supposed to provide them choice about what encryption to use, what privacy system to use. And we still believe in that, and we want to make the CRE and the privacy capabilities of the CRE and the data capabilities as kind of flexible as possible. So if you have a specific need that you have for CRE or from Chainlink, please share it with us. We're definitely here to help you, the developers and the people building the next generation of our industry. We're very eager to hear what you need from us and from CRE, and the Chainlink community is here to help you build the next generation of smart contracts that are going to take our industry to the next step. So, there's a lot of sessions on all this stuff. Too many sessions now for me to talk about them individually, but we have sessions on how to use AI, cross-chain, compliance, what we're doing on data for institutions and in general, a lot of sessions on CRE, some sessions on confidential compute. These are the sessions that I encourage you to go check out from a product point of view and to see what was really getting built. So I appreciate your attention and interest in what we've put together here. Thank you for coming to the event. I hope it's a great event where you make a lot of interesting friends and have some good conversations. I encourage you, in the spirit of Chainlink, to be very direct and have a good dialogue and have thoughtful conversations with each other about the future of our industry. And if you're a DeFi person and you meet an institutional person, be nice to them. Be nice to them. And if you're an institutional person and you meet a DeFi person, they make a ton of money. You should think about that. There's a lot of they make a lot of money, a lot more money than it seems, believe me. So just keep that in mind. So great to chat with all of you. Thank you for the interest in our work, and I hope you enjoy the conference.
Ladies and gentlemen, don't go anywhere. Our product keynote is up next. Our product keynote is up next. Don't go anywhere.
All right. Welcome back, everyone. We ask that you please keep your voices down as we transition into this next talk. Thank you, Sergey. That was incredible. So as we were just talking about, we are going to keep building on the CRE topic. We ask that you please scan the QR code that you're going to see on the screens to access an app that can get you eligibility to win a free 2026 SmartCon ticket. And this app was built on CRE. So we're going to be talking about that a little more, with solving hard problems will define our future, led by Chainlink's Apurva Joshi. Thank you.
Hello, everybody. This is my favorite kind of a crowd. We got builders, dreamers, and people who chose to solve hard problems. Today, my talk is all about solving hard problems, how Chainlink decided to take every hard problem, what kind of problems, what products we built, what solution that we built that moved our industry forward, and how our users are winning because of that. Starting from our first white paper to all the amazing things that we announced this week, Chainlink Foundation was built on a one belief, that solving hard problems will define our future. Because once you do that, you're not only moving the company forward, you're moving the entire industry forward. All right, so let's look into what hard problems we chose to solve, how the journey started, and we'll try and walk you through one of them, one at a time, reasoning behind it, and how we went about solving them. All right, four problems, really clear, needed for our industry to grow forward: data and interop. Getting data on chain in a reliable, secure, fast way is really, really hard. If you were in the industry for a long time, you will realize a single point of failure. Getting data from one API, one provider, was not the way to go. Getting two systems that are really different to talk to each other, really hard problem. Compliance, you cannot move capital without having compliance travel with it. Privacy and approve. You heard from Sergey. Keep things secret, but prove it. Well, that's cute. That's really hard, right? Keep it secret, but show me the proof. Distribution and connectivity. As you add more chains, more assets, the fragmentation is really, really real. Moving assets from one chain to another, integrating to others, really, really difficult problem. Everybody has a different protocols, different way of working with them. Those systems are fragmented, really hard problem to solve. Right, let's start with the data problem, right? Before there was DeFi or tokenization, there was one really hard problem that had to be solved. How do you get the data, a real-world data, onto chain in a reliable, secure, and a decentralized way? That was the problem. That was the hard problem that started everything for Chainlink, right? We created with the white paper. That white paper did not only solve the problem for us, but it created a category of a decentralized oracles, and everybody else followed. That was the hard problem that started everything. We went through multiple layers. If you were in the industry and following Chainlink, you will know there was an on-chain consensus, couple versions of them. Then the OCR came, second version, third version, we kept on iterating and solving harder problems on that side of the wall. Data feeds came in, data streams, the smart data. We did not stop innovating across the board. That one single innovation ignited the DeFi. It brought data on-chain that created real market. We worked with our partners like Aave, Compound, GMX, Camino, you name it, right, to build the ecosystem and industry forward. That was a really hard problem that we had to solve with the data. That's how we got started. That is our mode. That is what Chainlink's known for. As you fast forward 7+ years, right now, Chainlink just didn't join DeFi, right? I like to call it, we defined it. Today, about 70% of the DeFi is ran on Chainlink. That's 2/3 of a DeFi running on Chainlink. That is not a market share. That is market infrastructure. It is that powerful. The financial institutes, they saw the DeFi that has been running on Chainlink that has this reliable security, for the last 7 years, securing hundreds of billions of dollars, right, that earned us trust of a user. They decided if it can power DeFi, it can definitely power financial markets. Deutsche Börse, S&P Global, TradeWeb, they all decided to bring the data on-chain so we can tokenize. Money market funds, bonds, private credits, equity, you name it, right? That was the second wave on the data side that we end up seeing. The third one is even bigger, the governments. Recently, US Commerce Department decided to publish government data on-chain using Chainlink. Now that is big. As you can see, over the years, we've been powering protocols, then market, now nations. That is what winning looks like. None of that would have been possible without solving that one really hard problem. Right, data was the one that we kept on solving. Listen, it's not an easy problem. We still work really hard to come up with the creative ways and solutions to make it even more better and make that system more resilient, more powerful, so the markets can function. When we decided to build Introp, CCIP, that was, back in the day, Introp was the weakest link in the DeFi side. You would transfer a token, and you keep your fingers crossed that hopefully it shows up on the other side. There was news every now and then around bridge hacks, more and more chain coming up, fragmentation of liquidity, right? All kinds of problems that were coming in. When we decided to solve that problem on Introp with CCIP, we took a really hard stand that we will not take any shortcuts. We will go with a defense in debt, security, reliability, and a decentralization is going to be at the center of everything that we do. Because we truly believe in solving a fundamentally hard problems, right? It is very tempting in our industry to take a shortcut, to have a smaller win, do things in a different way just to get by. But that was a stand that we took. We wanted to solve the fundamental problems across the board with the Introp product that we built. Today, I like to call CCIP, when people ask me to explain what CCIP is, it's like a Fort Knox of Introp, right? It's the most secure way to transfer value, token, and a message across the bridge. And it didn't come that easy, right? When we solved those hard problems, took a step back, we helped the industry grow forward. Today, CCIP is powering more than 70 plus blockchains. The momentum is bigger than ever. We got Solana, we got Aptos. Last week, we announced partnership with Ton, Stellar, Canton. The momentum is real, right? Once you solve the hard problem, hitting the scale is really, really easy, right? We're winning for real. We're the biggest momentum for the product life that we had in a very, very long time. So very proud of the work the team's done on that side of the world. You heard from Sergey. I was debating whether I should name AWS or not. You know, so some of you know my background. But you know, it's always fun to take a dig at the old rivals. But yeah, when the AWS went down, essentially a larger cloud went down, the entire internet got cold, right? There were a few protocols in the DeFi infrastructure who took a bet on a centralized cloud, were down for a couple of hours. Chainlink wasn't. And that wasn't luck, right? That's an architecture. That's a decentralization at the heart of how systems work, right? This is why it's a great proof why decentralization wins. And you know, this conference is all about, Chainlink, right? So obviously, we talk about how Chainlink was up and whatnot. But I want to make a shout out to the team across our industry who is deciding to solve hard problems, making things decentralized, paying the debt. We were not the only ones that were up. There were a lot of people in our industry that were decentralized, running up, serving their clients, making sure the markets are working. A big shout out to everybody in the industries working hard to solve hard problems. Thank you very much. It wouldn't be possible without you. Because when we solve this problem, right, we assume the clouds will fail. But the markets should never be failing, right? And that's the core of decentralization. Big believer, solve the hard problems, the liquidity will follow, right? Liquidity will always follow security, compliance, privacy, and doing the right things. Let's be in it for the long run. All right, let's see how some of our users who are winning making a bet on CCIP, right? It's the power of CCIP. I want to touch on them briefly. Starting with Maple, really favorite use case. They have a stable coin set up USDC. They provide a great yield. They wanted to essentially make the yield accessible from anywhere. You got USDC on Solana. Syrup is minted on ETH with a single transfer with a programmable token transfer feature. They were sending value and a message. Send USDC from Solana to ETH. Get the syrup back into your wallet in one single transaction, right? That's the power of that. Aave, our favorite partner, right? They wanted to make sure Go is multi-chain without giving up control. So custom token pools. They wanted to make sure they have a rate limiting, they have full ownership of the contract, and the rules that they control. A power of a customization on that side. And Lombard, again, they wanted to make sure every transfer is compliant before a token is printed on the destination chain. So compliance first. They essentially use our attestation API off-chain to initiate and confirm that every transfer meets a compliance requirement before anything is minted. Really powerful use cases would not be possible without CCIP. All right, let's step back a little, right? We solved the data problem. We solved the intra problem. You heard about seeing how our users are customizing the product to slowly go towards compliance. Compliance is one of those words, right, that empties the room faster than a free food. Compliance. See, nobody's moving. That's great. This is why you're my favorite crowd. You're here to solve really hard problems. But listen, with compliance, the hardest part was understanding what is compliance. It's very difficult. Every country has a different rules, different jurisdiction. Getting compliance on a multi-asset, multi-chain, that's a really hard topic. Connecting your existing off-chain systems to on-chain, that is a really hard topic. Even if you figure everything out, proving that you're compliant, that's even more harder. And if you have to bring your institutional liquidity on-chain and proving then that you're really compliant, that's even harder, right? It's a really hard problem to solve on the compliance side. So if you make compliance an afterthought, you're not going to win in this market, right? This is also a really hard problem to solve. Let me walk you through how we went about solving this problem. I am very proud of the logo wall that you guys see here, right? These are all the users of Chainlink that are using and piloting with compliance product, automated compliance engine. It didn't happen overnight. Let me walk you through how we worked through that, right? We sat down with the banks, the FMIs, the regulators, the RW issuers, the DeFi teams, the people solving the compliance problem independently. We learned what issues they were trying to solve. We did not build the product for them. We built the product with them. Right? When you spoke with them, the first thing that comes out, like, well, identity, all different sources. I cannot work with one single identity provider. I have 10 different places to work with. Policies, they're complicated, right? There's some on-chain, there's some off-chain policies. You need a different way of executing them, different orders, different country perspective, in certain way. Really hard problem. The third one was monitoring and reporting. Everybody had invested heavily into their existing monitoring reporting. They wanted to carry the stack forward versus get something out of box. So when we sat down, we understood that compliance is not a one single problem. There are thousands of different variations. And when you have to solve something like that, you go back to the first principle of making things composable and modular. That's exactly what we're trying to do with ACE. We can work with any identity provider, plug and play, have a proof on chain that a counterparty can validate. Yes, that's the person that you're working with. The policy engine, where you can bring in your own policy, some out-of-box policies, any country, any jurisdiction, we can assign and tell us which order you want to execute those policies before the transfer happens, during the transfer, after the transfer, you name it, right? And then monitoring and reporting is always the critical part. So we plug and play with all kinds of monitoring and reporting providers in the ecosystem and work with that, right? So that was a hard problem that we had to solve. But when we solved with them, we found the best product market fit in the recent history of Chainlink. today compliance is not a bad word. Like every time you talk to people about this topic, the next question that I hear, tell me more. Tell me more. How can I use this? That's the power of this product. Really excited about this product. Biggest product market fit, like I said, in the last few years in a Chainlink history. All right, let's talk about how one of the pilots using compliance to solve a really critical problem. This is my favorite use case, and I'll tell you in a little bit why. Right? Think about a scenario. A regulator wants to manage and see the entire stablecoin life cycle end-to-end real time. Not after some news hits, few months after some bad thing happened, whatnot. That was the challenge for the Bermuda Monetary Authority. Chainlink won that RFP. We went in and brought in partners to work with us. Apex, Blueprint, Hacken. Apex was the stablecoin issuer. Blueprint was validating the identity of every single issuer. And then Hacken was providing a real-time analytics to make sure there are no bad actors before any transfer that happened and things along those lines. None of this would have been possible without ACE being at the center of the equation. ACE essentially brought all these partners in an ecosystem together. Before you print any stablecoin, ACE will call the proof of reserve to make sure there are enough reserves. It'll work with the Blueprint to make sure the identity of the issuer is meeting the requirements. And then the policies with the Hacken tells to make sure the wallet transfer that are happening that are not with the bad actors and things along those lines in real time before the transfer executed. That is critical, before, because that is the hardest part to solve right now, right? A lot of the problems that we see and we find out is afterwards, and it takes days and days to solve after that side of the world, right? But none of that would have been possible. The reason this slide is very favorite to me, because it shows the power of a Chainlink platform. All of my products that we build are used in solving this solution. You got CRE, you got ACE, you got data with the proof of reserve, you got CCIP to make the transfer. But you know what's even more powerful? It is not a one-vendor shop. We're not going out and saying Chainlink is providing you everything that you need. We're working with the partners in our ecosystem who are working hard to solve a specific problem. Apex, Blueprint, Hacken, you name it, right? Essentially, what we're doing here is bringing the partners together. We're staying true to what Chainlink is, net neutrality, providing a way and infrastructure for all of us to come together to solve a really hard problem, right? This is just not a pilot. This is essentially a preview to the future. Very proud of this use case. All right, let's talk about privacy. Chainlink confidential compute. You heard from Sergey. Really excited topic, right? This is one of the most amazing innovations that we've seen in a long time as well. Technically, really hard problem, right? When you talk about solving difficult problems, this is one of them. Privacy on a public chain. When you talk about that concept, the first response is, are you kidding me, right? I mean, this whole concept of public chain, how do you bring the privacy on it, is hard. But if you look back, right, we solved the scale problem, we solved the decentralization problem, we solved security, we solved compliance. Privacy is the next biggest unlock for our industry to grow really fast. It's very obvious to most of us that privacy opens up a new kind of RWAs, right? That were not possible before without privacy. The T-bills, the private credits, on the commodity side, real estate, you name it, that's all possible. That's very visible. They're visible RWA assets. But what privacy also does, that it enables those complex financial instruments that are not really RWA, that are needed for the entire system to work effectively, right? Calculating margin requirements, the corporate actions, model portfolio data distribution, these are problems of today. Privacy unlocks these problems that allows us to move all these RWAs on-chain in a right way and recreate the system that is more efficient and effective for all of us. All right, so I'm going to try and walk you through how the system works and try and simplify it. Right now, I grew up, I have two boys, and I grew up with them asking me this question, Daddy, what do you do for a living? Being a technologist is a really hard question to answer because they need to be able to explain to their friends. So when I heard about privacy, I was jumping up and down, and obviously, you get a question, Daddy, what is this? What do you do for a living? And I'll try and explain this to my son, what we're trying to do here. So let me take a stab, right? Okay. It's actually very simple. How does it work? You want to do a private calculation, you give us your security key. We're going to break that down into multiple pieces. Few people have them, but nobody knows who all has them. There is no way for anybody else to construct the key together to run the execution. The execution happens inside a secret chamber. The only thing that call those 6 different keys is the secret chamber. When the keys come in, they assemble together, they do the calculation, and then we destroy the chamber. Boom, it's gone. But there's enough traces and a proof written on chain and in different places where the counterparty, if they choose to, can exactly figure out what happened without ever leaking your PII. That's the system that we built. This is why this innovation is so critical. Yeah, it sounds like a sci-fi movie, right? I told you, we like to make things really simple. Yeah, that's what we do. But trust me, this shit's complicated. It's not that simple. If you want to learn more, our head of research is going to talk about this in detail and really geek it out tomorrow. I really invite you all to go see and talk about it and learn more there too. But in short, what is happening here is the 3 unique systems, right? You got a hardware in form of a TE today. It can be FHE. It can be anything else. It keeps the innovation going. Then you got cryptographic proofs with DKG and things along those lines. You got decentralization. Our industry has been solving these problems in pockets, individually, on the privacy side. And you have solutions from one single vendor. They will ask you, but you have to use my product, but you have to use that. Nobody doing in a net neutrality way. 3 different innovations happening in a different place. This is the first time in the history of our industry, Chainlink is actually bringing all these 3 different entities together and figured out a way to make the entire transaction private. That is that innovation. That is why this is powerful, because any of these 3 parts of the system can be compromised, but what is guaranteed that your data will still remain private and will be provable. And that's that innovation. That's why it is really complicated. I try to make it really simple, like a movie scene, but that's exactly what it is. That is exciting, right? And it's going to solve a lot of problems, right? Let's talk about one of them, the market portfolio data. In 2025, this should never be a problem. Right? For those who know what market portfolio data distribution is, it's essentially a recipe to investment, right? The asset manager has a secret sauce. They give it to the wealth platform. The wealth managers take it and do a bunch of stuff with it. You know how they send it today? Emails, flat files. Nobody knows which version to use. No reconciliation. What was the last thing that happened? Is it safe? Who saw it? Nobody knows that. It's a $3 trillion industry and growing faster. Hundreds of millions are spent in inefficiencies, right? Imagine bringing this data on-chain in a privacy-secure way, where only the right counterparty can have access to it. Everything is attested, verifiable. Anybody can see who had access to it and how it did. You remove the entire inefficiency in the system, process, people, waste of capital. And let's be honest, right? Who doesn't want to do that? But that's the power. That's the power of the privacy that is going to unlock. It's not about the obvious RWAs. These complex financial instruments, they cannot be on-chain without this innovation. This is why I'm really excited. All right, let's bring it home, right? You heard from Sergey about CRE, our not next, but a really big innovation that we're really excited about. Where does all the things that we talked about runs? ACE, privacy, it all runs on CRE, right? We run our products on our own platform that we give it to you all to build on it. And that's something we're really proud of. Why did we build CRE? As you start thinking about how the industry grew, more and more chains came in, more and more different protocols came in, different way of accessing data. Like if today you have to read and write to Solana, to TON, to EVM, different constructs, different programming language, different finality, it's confusing, right? You're going to end up with so many different smart contracts to work with. On-chain compute, off-chain compute. You want to have your legacy system connect to the on-chain systems, different triggers. All these things are nothing but a kind of a plumbing that you have to spend your time and energy before you actually go about solving a real problem for your end user. What CRE does, it takes that complexity away from you. It makes reading and writing to chain, it's just like reading and writing. Don't worry about which chain you're reading to. Don't worry about which chain you're writing to. You just read and write. You trigger a workflow. You do on-chain compute, you off-chain compute. A basic primitive. We abstract the complexity away so you can focus on writing really amazing problems or solving really amazing problems for your end users, okay? We're winning with CRE. There's tons of use cases. We got banks, EFMIs, Web 2, Web 3, DeFi. Everybody's excited, building on top of the platform. Some of the use cases that you see out here, the multi-chain and token manager, the bringing your own data, stablecoin mint, DVP, DTA, all of these at one point used to be a special project or a custom project. Today, they're all workflows, run on CRE. Really simple, right? And that's the power. Let's talk about three of those use cases that are favorite to me. One of them is Clint, right? Really innovating company in DeFi. They launched a new product called Railnet. What are they doing? They're allowing the users to create their own yield strategy. Any RWA, stablecoin, different complexity of a product or whatnot, and then build your own yield strategy portfolio and have fun. On paper, sounds really simple. But when you deal with all these complex assets on different chains and you have to manage all the different states and off-chain compute and what does it mean to the strategy, it's a nightmare. Now try and building that, all the plumbing yourself before you get to the core part that is the strategy. CRE made that possible, right? It does the state management and all the stuff, the plumbing that you needed was really simple. It reduced the time of development from months and months to days. Bankcoiner. They work with their other partners in the different banks around the world, different jurisdictions, different financial systems, different currencies to settle a cross-trade settlement for a small, medium businesses, right? It's essentially a trade settlement. Without that, these small, medium business users will never have access to this international market, to having those settlements run, right? To have the access to the commodity to be sold onto different parts. All they had to do was to just plug in and bring their own off-chain trade finance system on CRE. CRE made it happen. Finally, MasterCard with the swapper, with the 3.5 billion users wanting to buy token on Uniswap, right? You know, it's just like how the industry is moving forward in a way. You can buy them using your credit card, just like how you buy your Starbucks coffee, right? Really simple. The point is, like, listen, three very different use cases, three very different goals for the user, but one common thread, which is CRE turned the complexity into a simple orchestration. And they focused on writing what matters to them and solving those problems. Very powerful. All right. Finally, to bring it all together, in a way, financial markets are forward-looking. We all know that, right? DeFi has been innovating like crazy. Like, they're solving today's financial market problems by coming up with innovating solutions. You know, who would have thought that, you know, individual retail will be able to participate into providing liquidity into, you know, creating markets, right? And things along those lines, having a different kind of a leverage put in the system. None of these things that we ever had access traditionally. They are innovating really fast. They're the innovation engine of our industry. They're making new assets. They're making them more composable. They're providing utility, like you heard, that allows them to make a lot of money too, which is great, which is a great thing, right? In a DeFi side. DeFi is actually a true example of why hard problems are worth solving. Institutions are seeing that, right? They're seeing that tokenization is solving some real problems they've been facing challenges with, real-time settlements, transparency, programmable utility to the assets. If an asset's off-chain has a better way to earn a different performance on-chain, might as well go after that, right? And that's the opportunity that they are seeing in a way too. So for us to unlock the next phase of a growth for our industry, let's be honest, let's take a while of a little bit, right? We're innovating like crazy for the last 7 years. We come up with these amazing instruments to do great things and whatnot, but there's one single problem across the industry. That's liquidity. As you fragment more and more, as you do more and more applications and whatnot, everybody is looking for liquidity, right? And that problem has to be solved. But the good part is, in the absence of a lower liquidity, we're building products with amazing resilience as an industry, not just Chainlink, amazing resilience. So when the liquidity shows up, the system should work like a clockwork, right? But the problem of bringing that aspect, right? What institutions want, what DeFi wants, the liquidity has to flow in both directions. The institutional asset has to come on chain. The innovations that DeFi is making has to go to the billions out there in the world. This is our opportunity. Chainlink sits right at the center of this paradigm shift in the new financial market that we're seeing. In a single world, with all these innovations, what we're doing is we're unlocking capital flow. My ask to all of us in this industry, working harder to move us forward together, keep on doing the hard work. We're sitting in the middle, making sure we bring the right liquidity on chain so all of us can succeed from this point on out, right? This is the powerful state that we find ourselves in, and we do not take this for granted or easy. All right, we're not done yet. I want to talk about one final vision. You know, it wouldn't be a product talk if I don't talk about the vision and where we headed and why I am so excited about CRE and what it can bring. All right, let's imagine what happens next, right? You get more and more CRE developers writing workflows. Those workflows add to CRE network. Today, the workflows are private. Tomorrow, they will be public. It can be semi-public or semi-private. What it does, it allows the others in the user ecosystem to consume that workflow, call it, pay for it, and then create and solve another problem. Now, that's fascinating. Once that happens, CRE allows them to write and build those on-chain applications really quick by taking the complexity away. That creates a new dev, new workflow. You see how the cycle adds. As you start solving those amazing problems using workflow, workflow becomes a public utility that you can call, get paid for. That's an incentive to keep on innovating on that side. And that makes this platform really, really powerful, right? This is how we move product from the platform and a platform to an ecosystem that runs by itself. But listen, we cannot do it ourselves. I need each of you, the builders, the dreamers, the hard problem solvers in this room, to help build together and have this industry move forward, because I truly believe this is a EVM-like moment that we are facing in front of us. This is going to help us move our industry forward faster than anybody has ever imagined, right? Once these workflows become public utility, you solve the problem once. And also, don't forget, all these users that we're onboarding onto our platform. We talked about MasterCard with the 3.5 billion users, JP Morgan with their clients and whatnot. As they all work on this platform, you build on top of it, guess what happens? You have access to that distribution. You have to figure out just a way to do the right partnership with the right players. The hardest part is solved. You focus on writing technology, you're on a platform where you have access to this amazing distribution, whether it's B2B, B2C, doesn't really matter. That is the vision, and that is what something I'm really, really excited about. All right, I'm gonna end the talk in a positive note. You know, I want to make sure I walk you through this amazing power of our platform. We're gonna have 2 live demos. One showcasing the power of platform CRE. Zubin's gonna come in and show you how to solve a prediction market on CRE live, right? Again, it's doing a live demo is risky, but I got a team that can pull it off. And the second demo is about showing you the vision that I just explained live. We partner with Coinbase using the X402 API to pay to the workflow owner to kick off the workflow, and that's a part of the raffle that you all scan at the start of the talk. So with that, before I hand it off to him, this is all from me. Thank you very much. I hope you all have amazing SmartCon. Let's stay connected and see how we can solve hard problems, all right? Take it away, Zubin. Thank you.
Hello again, everybody. And thanks to Apurva. Give it up for Apurva, folks. That was a fantastic vision painted for CRE and making elegant solutions by solving really hard problems. So what I'm going to try and do for you today is give you a quick demo of something we built in collaboration with Google, just to help you understand what CRE does. Now, I'm going to use the context of a prediction market. And for those of you who aren't familiar with the prediction market, it's basically an on-chain it's a smart contract where people place their positions. Like, do they believe a future event is going to go this way or that way? Think of it as this is the proposition. Do you agree, yes or no? And so you have both sides of the marketplace. And I do have a confession to make. I grew up in the 80s and 90s being a massive Michael Jordan fan. So I'm a bit of a Bulls fan. And I looked for a recent event. Yep, wait till you see what happened. But on the 31st, there was a Knicks versus Bulls match. And I created a prediction market around that. And this is the smart contract up here. And I created the market saying, hey, are the Bulls going to beat the Knicks? Now, I apologize to all the New Yorkers here. Nothing against the Knicks. I've just been a Bulls fan for years and years and years. And of course, because it's a prediction market, we need to simulate what happened. So I took a past event because we know what the result is. And so now that we know that the game happened on the 31st, we know the result, etc. So you can see all this happen. So let me walk you through what you're actually going to see. So this is what a CRE workflow looks like. And I apologize for those of you who aren't technical. This may be a bit difficult for you to fully follow, but I'll try and keep it as digestible for you as I can. But at the core of CRE workflows, right, this is a single workflow. It's 100 lines, and it does a lot. It does a lot. It has a trigger. CRE has a bunch of triggers. This one's a log trigger, which means the moment my smart contract emanates an event, CRE will automatically pick it up. And then it does a handler on that. It does a bunch of actions, which is your business logic, right? That's what happens in response to the trigger. And what does this one do? Well, this one listens to an event called settlement requested, which is someone says, okay, this event's happened, let's settle the market, and then it does a bunch of things. It decodes that event log, it sends it to Gemini, right, Gemini AI, and say, use grounding, which is a Google feature on their AI, and confirm whether or not this event happened and give us the data. And then it settles the market. So far, we've done two things. We've done an HTTP request. CRE has orchestrated it, asked Gemini, got the response, used that response to do an on-chain write, to update the state of the smart contract with the response and the result. And then, just for extra redundancy, it also puts it into a Google Firestore database with more data in case you ever want to look at that. And right now, you'll see my front end has nothing, and so I'm not faking this. But we'll get to that in a moment. So that's pretty much what a workflow does. And so the first thing we want to try and do is try and settle the market. So I'm just going to copy this command here. I've created a market ID number 27, so I'm just going to update that. OK, so when I run this command, I'm going to call this smart contract and say, hey, can you settle the market, which means trigger CRE. Now, in the real world, if I deployed my workflow to CRE, you wouldn't see any of this because it's all orchestrated and automatic, and it just happens, right? For the purpose of the demo, I've had to break it down into steps and simulate it for you. But this is what will happen right now if you were to deploy a workflow. OK, so I'm going to call this. I'm going to request settlement. Give it a moment. It's going to speak to the blockchain. It's going to have the RPC request. And then what we're expecting to see at the end of this is a confirmation transaction with a hash. And there it is. There's the hash. OK, so I'm just going to copy that. Let's go over here. I'm going to refresh the block explorer. And we should see this hash show up here at the bottom in a couple of seconds, right? Takes a bit of time because of the latency. Let's keep refreshing. There we go, 23 seconds ago. You see that? And just to show you I'm not kidding, I'm going to paste. There you go. That's the same transaction hash. Now let's inspect what happened to this transaction hash. Let's look at the logs, and we see, oh, here it goes. It emitted this event called settlement requested. It had the market ID, which is 27, and here's the market question that both sides are playing, okay, on the prediction market. Let's go back to the contract for a second. OK, so now I'm going to copy that hash again just for security's sake, for safety's sake. And I am now going to simulate the CRE workflow. OK, so this command here is CRE workflow simulate. The CRE comes with a very powerful command line tool that handles all this abstraction for you and also lets you simulate locally. But interestingly, you can do a local simulation and have on-chain action. And that's why you have this broadcast flag right at the very end here, right? So we're going to do a local simulation of CRE, of your workflow, of this workflow, this main.ts file that I have here. That's going to get simulated locally, but there is going to be an on-chain write, so I can show you all that in a moment. OK, here we go. Demo gods, be good to me. OK, now it's asking for the transaction hash. Why? Normally, it would just have picked up the event, but because you're simulating, I'm giving it the, not that one, I'm giving it the transaction hash that we just saw a moment ago, and saying, well, that's where the event's coming from. It's going to say, what's the event log? That's 0, because it was just a single event. Now let's take a look at what's happening here. It said, oh, OK, got it. That's the event name, settlement requested. It's the market ID 27. The question was, will the Bulls beat the Knicks on 31st October? Sent the data to Gemini. Gemini's response was, yeah, well, it's a past event, so we know, it was able to settle the market with a confidence score of 10,000, which is the highest. And then it's going to write all this on-chain. Now, let me just stop here for a second and remind you again that this one workflow has done a number of things. It's been triggered by an on-chain event. It's made an HTTP request to Gemini. It's retrieved the data, submitted it with consensus back to your smart contract, so it stored it on-chain, and then sent all that data and the metadata off to Firestore to save it there. And now if you look, I'm just going to copy that transaction hash, and I'll show you that in a moment. But if you look back in our contract, let me refresh this page. If I look at the events, I'm going to see here a report call on my contract. This is CRE submitting all the data back right here. Right? So if I look at that transaction, I look at the logs, you will see that the settlement response from CRE to my smart contract had market ID 27, which is what it was. The status is now that it's closed and it's been resolved, and outcome is 2. 1 is no, 2 is yes, which is the outcome of the market, which is what we saw here. Yep, yes is 2, and that's what we see here. Back on my contract. And now let's take a look at GCP Firestore, right? If I refresh that, this has got all the data there, including all the grounding metadata. So if anyone wants to verify, they can do that. And if I search for my hash here, you will see even that's been stored here. So I'm not kidding. I'm not faking this. This just happened. And here on my front end, if I want, I'll refresh it, and you will see the market. And you'll see that the hash is the same one. And you'll see that it's 11th of November. 4th of November. Sorry, I'm Aussie, so I have it the other way around. 4th of November at 2:25, which is 2 minutes ago. Status code, there's the question, there's the response. So all of this is a way we solved a hard problem by making it as simple and accessible to you guys. Very powerful composability, orchestration, and automation through what is basically a 100-line workflow file that does all this on-chain and off-chain activity. OK? So hope you enjoy that. With that, let me hand it over to Harry. Good luck, mate.
OK, I know we're running a bit late, so I'm going to get straight into it. So we're going to do something now that we've never done before here at SmartCon. And hopefully some of you filled out the QR code and answered the question that we asked, which is, what would you build with CRE? Well, we're going to take the 3 best responses, and we're going to give these people 2 tickets to SmartCon each, next year's SmartCon. And we're going to do that live on stage right now. So, but we're not going to do it ourselves. We're going to get an AI agent to do the work for us. So you heard Apurva say just before, talking about this future vision of a CRE workflow network. Well, we decided to make that real, and we've built a giveaway workflow that we're going to run today. And thanks to our friends at Coinbase and the X402 protocol, we have monetized it so that any developer or AI agent can use our workflow. For those who don't know, X402 enables programmatic payments over HTTP. All right, are you ready, SmartCon? Let's go. So what's happening here is the AI agent has been scoring each of your responses as they come in, and it is taking the top 3 scores, and it's going to send them to CRE. And the way it does that is we have an X402 gateway set up that is basically a way to accept X402 payments. And that gateway is going to take the payment from the AI agent and the 3 results, and it's going to trigger the CRE workflow. The CRE workflow will validate the responses, and then it will send them on chain where we can see them on the UI. Now, we've kept the validation pretty light, but you can imagine some of the stuff you may do. Maybe you want to filter based on people that are here in person, so you want them to have a ticket to this year's SmartCon. All right, let's see the results. Boom. All right. AI RWA oracles. Building AI-powered RWA value oracles. Awesome. Love that one. Second winner, hybrid accounting orchestrator. Congratulations. Third one, trusted 3D, oh, this one's my favorite, trusted 3D manufacturing. Thank you to everyone who submitted responses, and congratulations to the winners. You'll be receiving an email today. So let's quickly take a look at the X402 payment here. You can see that was made from the agent to us as the workflow owners. In addition to this, let's take a look on chain. And we should be able to see the responses reflected here as well. And if we take a look at the CRE workflow, all right, it's not cached or something. But the CRE workflow has completed, and we have the responses on chain. So this is a glimpse of the future where CRE workflows act as these kind of composable utilities for other ecosystem participants to use and build upon. This is the vision. This is how we move to a world where we leverage the power of compounding momentum so that the ecosystem can run itself. Now, CRE is live today. If you're a developer, you can start building right now. Please go to our docs and you can start building. We also have a developer workshop at 3 o'clock upstairs on level 3. And we're running it tomorrow as well. We have some great lightning talks tomorrow on the Fulton Street stage as well. And if you're a financial institution, please contact us at enterprise.chain.link. We'd love to speak to you. We'd love to talk to you more about CRE. We'd love to run some developer workshops for you virtually or in your offices. Thank you, everyone.
Thank you, everyone. All right, welcome back. Moving on now, we'll be talking about our path to a connected world, and I want to bring onto the stage Chainlink's Chief Business Officer, Johann Eid. Welcome, Johann.
Chainlink is on a mission to connect people, a mission to connect societies, a mission to connect countries. Because a connected world is a flourishing world. And this isn't just an idea or a slogan I'm using here to sound nice. It's a reality. Our very histories are a witness to it. Just look at the world we inherited. Our world was built on connections. Post-World War II, we connected every single country through trade. With the rise of the internet and the digital age, we've been connecting every single country and society through information. And now, with the cryptographic age, with Bitcoin, we're aiming to connect every individual through money. Throughout these decades, what was the result? We've seen more growth around the world in a few years than in centuries combined. Average people today live better than kings of old. Now, you have to ask, though, all this change, all this growth, where is it leading us? You see, growth always comes with challenges. And one of the cruel ironies of history is that the more growth you get, the bigger your challenges become. Today, we are faced with 3 existential challenges, which are putting every single thing we've inherited into question. The first one is linked to information. You all know we are living in a society flooded by information. Information inflation is a phenomena of our age. With AI, with social media, information has never been so powerful. It's able to shape the very realities you see. Now, you have to ask, when you go online, whose reality are you watching? Is it yours? Is it mine? Is it a fake or manufactured reality? You see, that's a very important question, because with information inflation, objective truth starts disappearing. What's real and what's not starts getting blurred. And this is a very important point. Most financial crises, up to our day, have started with information and reality getting blurred. From the GFC in 2008 to FTX, closer to home, it's always the same pattern happening over and over again. Information today is a very powerful weapon. It can be wielded for good or for bad. When you work on technology, your goal is to ensure information is used for the good of our societies. For this, information needs to be verifiable. It needs to be transparent, it needs to be neutral, it cannot be manipulated. This is the first challenge. The second challenge relates to money. All of this growth all over the world has been sustained through unprecedented levels of money printing. And now, throughout the world, you're seeing the same reality. Inflation is no longer theoretical. It's no longer a concept you hear about on the news. It's a reality when you go to the grocery shop, when you go to the gas station, even when you travel. Most countries now are experiencing double-digit, triple-digit inflation. Hyperinflation leads to hyper-inequality. Those with assets keep getting richer and richer. Those without keep getting poorer and poorer. The result, society is more divided today than ever before. We need better money. Money that unites people instead of dividing them. Money is the energy of a society. If it's stable, society is stable. When it starts breaking, societies start breaking. The third challenge, and we will see this throughout history, when a society becomes unstable outside, it reverberates outside. It reverberates outside in the way it deals with other countries, other societies. Our third challenge is linked to trade. We inherited a world that was connected, countries trading with each other. This is not the case anymore. More and more, we are seeing an age of fragmentation. Countries are more and more having conflicts with each other instead of trades. Mistrust has become the rule of the game in many cases. We need to adapt to this new reality. For global trade to happen in the future, we will need neutral infrastructure. These are the challenges of our time, and these challenges have truly brought us to, in many ways, the brink of the abyss. We are now standing at the crossroads. We can keep going down that path we've been on, division, fragmentation, regression, or we can go down another path, one of connection, one of growth. This path is blockchains. Why? Because blockchains solve all the challenges of our time. Information asymmetry, it doesn't exist on-chain. On-chain, information is verifiable. We all get access to the same data, the same truth, the same ledger. You could ask 8 different countries the weather in New York today. You would get 8 different answers. You ask them the state of the Bitcoin ledger, they will give you one single answer. Hyper-inequality, it doesn't exist on chains. Blockchains don't care where you're born, where you're from, if you're rich, if you're poor, if you're retail, government institution. On-chain, we all play by the same ground rules. Mistrust between countries, inside societies. Blockchains are fully neutral. they belong to no one. They're run by no country, they're run by no individual, they belong to no one, they do serve everyone. Now, blockchains, just like our world, in order to grow, need to be connected. They need to be connected to information because you need to make information verifiable. They need to be connected to money so we can create better money. And they need to be connected to payments so we can have global trade on-chain. This is where Chainlink comes in. Chainlink is on a mission to connect blockchains so we can fulfill the potential of blockchains. Starting with information. When we put information on-chain, this information is fully verifiable. It's fully transparent. Everyone gets access to the same truth. No information asymmetry here. This is why today, DeFi is built on Chainlink. More than 70% of our space uses Chainlink data to price assets on-chain today. This is up from 50% earlier this year. Since the very first day we started putting data on-chain, we've secured over $27 trillion in transaction value. We work with 500 protocols, securing today more than $100 billion in value. Now, behind all of this growth is our go-to-market team. Our go-to-market team has been a win-win machine for the space. We work with tens of thousands of builders to connect them to the data they need in order to grow. We co-design with them, we solution with them. When they win, we win. When they grow, we grow. The second stage of connection for our space is not connecting crypto to more crypto. It's connecting the global financial system to our DeFi space. This is where data link comes in. Data link is our path to connecting the world's largest financial institutions to the blockchain through their data. We're working with Tradeweb, we're working with S&P Rating, we're working with FTSE Russell, with Deutsche Börse. We're working actually with many, many more. Some of them announced, some of them not announced yet. With all of these institutions, our main goal is if we put their data on-chain, we now enable TradFi workflows on-chain, tokenized repos, equities, derivatives. Once we get all of these use cases on-chain, we enable on-chain capital to flow into our space. This data is being match-made with some of the best builders in our space, in the derivative space. We are working with derivative exchanges, innovating on this data, and here we've seen a phenomena which keeps repeating itself. The more data we bring on-chain, the more builders we get on-chain. In just the last 2 weeks, we've announced 9 new partners using this data on-chain. I do want to give a special headlight today to Lighter. Lighter is one of the largest derivative exchanges in the space. They're now using our data to be able to price gold, silver, and many other commodities coming from the real world to the blockchain through this data. Now, we're seeing some pattern here, right? The more connections we create, the more the space grows. And this has been the very same phenomena since we first started providing data back in 2019. In 2019, this space did not exist. You had nothing on-chain. It was a desert. Once we started putting data on-chain, lending protocols started being able to build on-chain. It gave rise to DeFi Summer in 2020. Once we started putting data streams on-chain with low latency information, we enabled the age of on-chain perpetuals. And now, with Data Link, we're able to ensure institutional use cases can be built on-chain. Same formula over and over again. When you put new data on-chain, you usher in a new age of growth for our space every single time. The next age for our space won't be about only more data. It will be taking our space from a few $100 billion it is today to trillions of dollars. How do we do that? Tokenization. Equities, stocks, ETFs, all of them coming on-chain, all of them getting into DeFi. And tokenization, just like information, requires connections. And just like information, we provide the connections to make this tokenization happen. A tokenized asset is a connected asset. You need to connect it to its proof of reserve to ensure it's fully backed. You need to connect it to every chain to ensure this tokenized asset can flow everywhere. And you need to connect it to compliance and identity frameworks to ensure it can get into DeFi. Here again, we make all of these connections happen. Why do I need transparency, proof of reserve in my tokenized asset? Well, this headline answers why, okay? $300 trillion printed on-chain by a fat finger mistake. This should never happen. With proof of reserve, it doesn't have to happen. Proof of reserve caps the supply of your asset to its reserves. If you think about it, it's actually the first time in history when we've had money that can be provably backed by something and cannot be over-minted. Proof of reserve is a requirement for tokenization. It's a win-win for everyone. It's a win-win for asset issuers to ensure they're not associated with this type of headline. It's a win-win for DeFi protocols to ensure they never have to worry about 300 trillion coming into their protocol and draining all the money. And it's a win for tokenized asset holders so they know they won't get inflated into oblivion. Because of that, proof of reserves is getting adopted by the whole space. We have today more than $52.5 billion utilizing proof of reserves on-chain. Once your tokenized asset is issued on-chain, you want to get utility on it. You don't want this tokenized asset to just sit on-chain doing nothing, right? You want it to get yield. You want it to be used as collateral, to be able to borrow on top of it. This is where ACE comes in. The biggest blocker to connecting tokenized assets to DeFi up to now has been compliance. With ACE, this blocker is no more. With ACE, we are able to connect a tokenized asset to its compliance, regulatory frameworks, identity frameworks, to ensure any tokenized asset can now flow into DeFi. And here again, this is a win-win product. It's a win for DeFi protocols because they can get more tokenized assets into their protocol and grow from billions of dollars to trillions of dollars. It's a win for tokenized assets because now their asset can have utility on-chain. Now, once you're able to do that, you have your tokenized asset, it's on-chain, it's accruing yield. You want your asset to flow on every chain, right? This is where CCIP comes in. CCIP is our cross-chain solution. It's not only a cross-chain solution, though. CCIP is the only cross-chain solution in the space that's used both by TradFi and by DeFi. Not only does it connect your asset to every single chain, whether it's a public chain, a private chain, a government chain, it also connects the DeFi world and the TradFi world. Because of that, CCIP, again, is a win-win for everyone. It's a win-win for TradFi, it's a win-win for DeFi, and because of that, it's getting adopted by both. We are being used by some of the largest DeFi protocols in the space today. We actually have a super exciting announcement, which I wanted to have on this slide. It's coming up tomorrow, related to CCIP on the DeFi side. On the TradFi side, we are working also with some of the largest institutions, from Fidelity to ANZ to many others, to be able to connect these two worlds together. Now, tokenization has been enabled through connections. The more connections you get, the more you grow. And we're really seeing this example with CCIP. With CCIP, we see the same pattern happen over and over again. Whenever you get a tokenized asset on CCIP, you connect it to more distribution. You connect it to more chains. You connect it to more DeFi protocols, to more holders. As a result, tokenized assets grow 3, 4, 5x in size a few months after they get connected through CCIP. And you have a few examples here. We have many, many more to show for. All of this growth, all of these connections have led tokenization from being a pipe dream we were discussing a few years ago to a reality. Tokenization is happening everywhere. Asset by asset, market by market, the whole world is getting tokenized. And truly, this is actually great news. If you go behind all the buzzwords that people use for tokenization, etc., tokenization, at the end of the day, is better money. It's transparent money. It's money that's global. It's money that anyone can access. It breaks down the silos between countries and inside societies. Money is the energy of this world. When you make money better, you make the whole world better as a result. That's why tokenization is such a big deal. And that's why we've been working on it for many, many years. Today, Chainlink is the only platform that provides all the tooling you need in order to make tokenization happen. From proof of reserve to compliance with ACE, to NAV data, to cross-chain, to many, many other connections. We are the only ones who have been able to create this platform because we've been working on tokenization for the last 7 years. Now, once you get tokenized money, in order to scale it even more, you need to have tokenization into global trades, global finance. And this is really the last piece of the puzzle for us. Once all of the world's money is on-chain, all of the world's trade will also happen on-chain. And for that to happen, you need to connect every payment solutions to the blockchain. We are working here again with some of the world's largest institutions to see what is the outline of global trade on-chain going to look like. I'll go over one quick example here. In this example, we are aiming to have tokenized commodities be traded on a global scale. In this particular example, we worked with the Central Bank of Brazil, HKMA, Banco Inter, and Standard Chartered to see how a tokenized soybean contract being issued in Hong Kong can be traded for in Brazil can be traded for a Hong Kong stablecoin. I want you to notice one pattern here. 2 countries, 2 banks, 2 blockchains. That's the way it will work. Every single country, every single bank will have their own digital asset infrastructure. And in order to trade with each other, they will need a neutral connector in between. Chainlink CCIP in this example is the neutral connector. We have similar examples between Singapore and Australia, ADDX and ANZ. Again, same pattern. It's the pattern which really matters here. 2 countries, 2 banks, 2 blockchains, 1 neutral connector, CCIP. We are entering a new era. An era where all the world's information, all the world's money, all the world's payments will be on-chain. Chainlink has been working for the last 7 years to make this era actually come true. Now, why do we want this era to come true? We truly believe that blockchains are a solution to all the challenges of our times. But not only are they a solution to these challenges, they make these weaknesses of our day actually become strength. When you make information verifiable, not only do you tackle one of the biggest issues of our time, you also ensure the future is written not by those who control the information, but by those who actually make it truthful. When you create better money, not only do you help solve inequality, solve some of the biggest challenges of our era, you also ensure our societies will be more stable in the future. When you create trades on-chain, not only do you adapt to the new global reality where countries don't trust each other anymore, you also ensure the future will be made up of trade and connections rather than divisions and conflicts. What we do here really, really matters. And it's really up to us. You don't choose anything in this life. You don't choose what words you inherit. You don't choose your challenges. You don't choose your fights. The only thing you choose is how you actually react to them. And we have 2 paths here. We're at a crossroad as a society. One path is division. The other is connection. One path is universal growth for our world. The other is universal regression. Well, we've made our choice, and more people around the world are making this choice with us every single day. In only the last 2 weeks, we've announced more than 145 new partnerships. In only 2 weeks. And it's not only in Web3. With institutions, asset managers, index providers, we are seeing blockchains work with us. We are seeing tokenization platforms. The whole world is getting on board with this vision. And for the people who've been working on this, in this space for the last 7 years, you will know it's not an easy space to work in. It wasn't always this way, right? For many years, our space was shunned. It was mocked. People left it. Well, for the people who stuck up with us and kept working on these key existential issues, I want to say, at the end of the day, the only thing which will matter beyond all the short-term problems will be our collective imprint on society. Ours will have to build a new society, one which is connecting people, one which is connecting societies, one which is connecting countries, because the connected world is a flourishing world. Thank you very much. Thank you, thank you.
All right, everybody. Next up, we have a fireside chat between Fernando Vasquez from Chainlink and Lawrence Jeffens from UBS. Thank you.
Good afternoon. Johann is a really tough act to follow. But this afternoon, we have another great panelist and global thought leader. These days, we're witnessing one of the most significant shifts in financial market infrastructure in many decades. And as we discussed this morning with Donna from State Street, actually many financial institutions, including UBS, have been working in this space for almost a decade. This is probably a good instance of the Amara's law, where we overestimate the short-term effect of new tech, but we underestimate the long-term impact that it's going to have. And Lawrence, you at UBS have been working on your own tokenization platform, again, for quite a while. It is called UBS Tokenize, yes. And your organization and Chainlink worked together recently. And we demonstrated how tokenized funds can be moved securely and compliantly across networks. But can you tell us more about UBS Tokenize, what it is, again, what problems it's solving, and what is the role within UBS's broader digital strategy?
Yeah, thanks a lot for having me here, Fernando. Fantastic. I think there's so much movement, especially also on this side. And in the American continent, right, we see just so much moving. So, hi, I'm Lawrence. I'm leading UBS Tokenize, which is our in-house tokenization service. We actually work with all the different business divisions from UBS, meaning from personal corporate banking, wealth management, investment banking, and asset management. And we help them to develop tokenized products. And then, also bring them to the investors. So we help them along the whole value chain, meaning from the structuring, origination, tokenization, and the administration of the tokenized product. We also have custody capabilities and distribution capabilities. So.
And can you explain why you built all of that in-house? There are other, tokenization platforms in the market. So how is UBS Tokenize different? And what do you think is going to enable you to scale the business, again, as part of a universal bank?
Yeah. I think you mentioned it. It's actually quite a journey we've been in to figure out how do you design this best, right? And what you learn, or what's the key difference with tokenization, with the wider crypto world, is in tokenizing, you're combining securities, regulated products, with technology. And I think that's what we can do best as a bank as well. So we can actually leverage the product expertise and then build these new tech capabilities with the same trust and security which we apply to our traditional banking services. And I think that's one is key, right? The trust, the security around that. And there we see an advantage of us as a bank actually doing the tokenization directly in-house.
I think we could discuss an actual instance of, Tokenize, UBS Tokenize being used in production, or as a part of a pilot. As part of that, I would like to dig into, our collaboration, what we've been doing and what was announced recently. Can you give us an overview of the collaboration between UBS and Chainlink and what was achieved between us and also our another partner, third partner, Swift?
Yeah, absolutely. So really exciting stage now. So we launched our Singapore-based money market fund, the UMINT, last year. And that was really the first step. So you really bring a product into the token or the kind of blockchain ecosystem. So we launched it on Ethereum. But now, with the digital transfer agent, you really put a lot more utility. You start really bringing the whole fund onto the chain, right? It's the next step you have to take. It's a lot more functionality around it. So what we did today is actually the first in production transaction of redemptions and subscriptions directly on chain, enabled by the digital transfer agent standard from Chainlink, where we really see, well, it's a bit like a spacesuit, right? Or which we have now over our money market fund to bring the seamless connection directly on there as well. We're still a bit in a hybrid world, but the goal is really that you can use the advantages of a blockchain and fully manage the end-to-end life cycle of your fund directly onto the blockchain itself.
But I think the fact that it's hybrid, I think is actually meaningful, because we don't need to force, all the stakeholders across the life cycle of this transaction to replace their core banking systems and make a multi-$100 million investment for that to happen, right? So I think, again, with our approach and with UBS Tokenize, you can help, your partners organically grow into this new, DLT blockchain-powered feature.
Yeah, and I think one of the key features we see as well is the interconnectivity, because we're going to go into a hybrid world now, right? There's a slow adoption, increasingly quicker of tokenized assets, but by far, the majority of the liquidity, the investors, is still within the traditional systems, right? So if we go on, we have to be able that these worlds work seamlessly together. And that's what we focused on as well with the automation and the digital transfer agent capabilities, and especially also the test we did with Swift together is how can we bridge these two worlds, right? And if there's an on-chain event, how can we process it as well in an off-chain, in the traditional world, because not everybody is immediately going to be ready with all the capabilities you need to become an investor of a fully tokenized fund, or become a custodian, or anywhere else within the kind of value chain. And I think that's where it really comes in. It's all about data, connectivity, and then also liquidity, because you want to tap into the same liquidity where it is, otherwise you really can't have that liftoff, which we expect. Right?
So UBS Tokenize evolving along those lines over time, where you will remain hybrid and potentially enable fully, DLT blockchain-based use cases, or how do you see that playing out?
Yeah, we want to be ready for that world, right? It's like if the incentives are right and more assets move in that direction, then we want to be able to serve our clients, right, as we do on the traditional side, and give them the right tools that they can actually engage. And I think that was also one of the points which we showed this morning. It goes now beyond an experimentation. These are now real production trades, right, which we can support directly on chain.
So from the Chainlink point of view, this collaboration illustrates how Chainlink acts as the connectivity layer, or the connective tissue for the new on-chain financial system. But from UBS's perspective, can you explain what kind of role Chainlink plays when it comes to enabling your vision for tokenized markets?
Yeah. Maybe I have to also give a bit of history on how we designed UBS Tokenize. It was really designed of taking advantage of the blockchain, meaning the openness, the ecosystem you have around the composability, the programmability which you get out of the blockchain. And I think that's where we also see how it so nicely fits on how Chainlink develops products and how our product works, right? I talked a bit about the spacesuit because it's really compatible, right? If you look on chain, it's our human smart contract directly interacting with the digital transfer agent, right? And that really shows this composability, and you have the same approaches, right? It should be open and usable for the ecosystem to really get the benefits, right? So that we don't need custom integrations. We don't need to build additional tech barriers, right? No, we want to actually do the opposite. We want to remove tech barriers. We want to make it as easily as possible to interact with capital markets. And I think that's where it fits very nicely together. And then the other point is as well is, yeah, today securities are already mostly dematerialized. So it's all about data handling. But you have to be very secure about that data, right? And that's why the existing system is also, like, sometimes you could argue slow, but it's really very secure. And that's where we have to focus as well. If we bring it on chain, we have to have the same security standards, but now taking advantage of that kind of, of the blockchain. And I think that's one of the core expertises you're bringing from a Chainlink side as well, because you have been, handling data on chain already for, I don't know, a decade at least, right? So I think that's where it nicely comes together then.
What do you think is the already implications for the broader financial ecosystem where many other FIs, FMIs still rely on, existing standards, legacy protocols, and but they're still looking to, to get exposure to blockchain and DLT?
Yeah. So I see it as well, right? I mean, like, our clients, they don't ask for a tokenized asset, right? They're really more looking, is there an advantage? Is there a utility around which you can get when it's tokenized? And that's what we focused on. Like, if we tokenize something, can we do it better? Can we make it more efficient? Can we bring in a utility to that asset versus, the traditional one? And then you will have natural adoption, right? Then nobody needs to ask for something tokenized. It will just be a superior product.
Actually, just before coming to the stage, Lawrence and I were discussing a pilot that we did back in the day, 2023.
Yeah.
Back then, I was the CEO of SBI Digital in Japan. But could you share with us this story and how this fits into the discussion we're having now?
Yeah, I think we went together and we wanted to design and showcase that we can do a full cross-border transaction real life directly on a blockchain without going off-chain. So we can do everything on the existing legal frameworks, right? And I think that was already a great premise. And we sketched it out. We actually paid more for the lawyers than for technologists. So I think that is always one thing which I kept. But in the end, the transaction worked beautifully, right? And we were like all out of like 3 different jurisdictions, Switzerland, Singapore, and Japan watching it. But actually the one challenge we had was the traditional payment lag in the end when we were taking it off chain. That's the one thing where it broke. And I think that's a nice point again, is like, okay, I think as soon as we bring then the payment lag on chain as well, then you can avoid these type of disruptions, right?
Yeah, I think we kind of showed that actually by using DLT and blockchain, you can reduce the operational risk if you do the right thing and design the product properly from the get-go. So I want to get maybe more technical for the last 1 or 2 questions. Lawrence, UBS is now using Chainlink's DTA, Data Transfer Agent, which is a technical standard. And for those who are not familiar with it, can you explain what is this standard and what is relevant when it comes to institutional tokenization?
Yeah. So I mentioned it a little bit. It's a bit the spacesuit, right? It gives additional utility to the existing fund, right? And what it can do now is that you can really trigger all the transactions directly onto the blockchain, and then bring the whole fund administration and at some point maybe even the transfer agency directly on the blockchain and manage just one registry. And I think that's where the digital transfer agent standard from Chainlink comes in, because it has like all these great utility points which are then connected to the fund, meaning you want to trigger a subscription, you have all the data there to actually execute that transaction directly on chain. And yeah, we were able to test it, but now actually do it in real life this morning as well. You get other advantages as well, because what we see, we build in a blockchain agnostic world, so we started on Ethereum, but yeah, you don't know where this world is heading in 5 years, so I think that's where you'll see another advantage is then how do you manage cross-chain, right? Sometimes you have certain chains which have a purpose, a different purpose than ours, so we're also exploring there, like how can we use the DTA to manage our fund across different networks as well. without getting in the complexity that we have to go and launch everywhere as well.
Actually, I want to ask you what's coming in the next 5 years. So I think that this pilot between UBS Swift and Chainlink was a very meaningful milestone. But what comes next for UBS Tokenize? Can you share more about the product roadmap and what's coming? What do you guys have in the pipeline?
Yeah, I think we're on a very exciting point where we have like this increasing commercial adoption, right? And I think it's a couple of things falling in place. It starts with the regulation, it's technology, and now it's especially also the cash lag having in place. So for us, it's figuring out how can we now use this and make even more interesting products. But it's really about finding the right product fit, right? Because we have now established we can tokenize quite a variety of different assets. But where does it make sense, right? Where is the demand? Where can we bring an advantage for our clients to it? And I think that's what we want to look now is like on one side on like how can we bring more of the fun, for example, life cycle with the DTA on chain and really enable that in a scaled production setting. And the other side is also how can we bring new utility? Like we have now this like cash lag, stable coins, big topic. How can we use that and make our products actually more interesting?
I couldn't agree more. I think we need not either or. We need efficiencies and value for this to become mainstream. That's our thesis. And I said before, I think maybe you are too humble, and UBS underestimates the impact that you guys have had over a decade. And I'm looking forward to continuing to work with you guys and have you as agents of change. Again, just like many of you, it's up to us to make it happen. Again, I'm super bullish. So thank you for again joining the panel. And enjoy the rest of the conference. Thank you, guys.
Thanks for having me. Thanks. All right.
Hello, everybody. Next up, we have Ryan Lavelle from Chainlink, who's going to host a panel on bridging worlds, how standards enable seamless interconnectivity in the digital asset economy. Please welcome the entire panel on stage. Thank you.
So go in front. Go in front.
All right. Good afternoon, everyone. Thank you. All right. Good afternoon, everyone. Thank you for joining us on this panel. The title of this panel is Bridging Worlds: How Standards Enable Seamless Connectivity in the Digital Asset Economy. And I'm personally very excited for this panel. And we have some of the world's largest firms here with us that are focusing on this very problem. How do we glue together the fragmented blockchain ecosystem into a coherent digital asset economy? And I'm Ryan Lavelle, Director of Capital Markets at Chainlink. I'm delighted to be joined by Zschach, who is a digital asset strategy lead from Swift. Sandra Rowe, CEO of the Global Blockchain Business Council. And last but not least, Christoph Schneider, Head of IT Development and Operations at GLEIF. So we'll kick it off with a question to all panelists, and maybe we'll go left to right. The session is called Bridging Worlds. So in one sentence each, what worlds are your firms personally trying to bridge in your work, and why do standards now matter more than ever? We'll start with Zschach.
One sentence. I think to keep to the spirit, quite frankly, it's to allow financial institutions in the regulated space to be able to leverage existing infrastructure and access the kind of the DeFi kind of tokenization-based markets as we see the direction of travel going forward in this direction.
Well done, Sandra.
Thanks, Ryan. Thank you for everyone for being here. In one sentence, what are we trying to do at GBBC as the world's largest nonprofit focusing on this space is literally to bring the best of what is traditional finance and financial services infrastructure alongside and integrated into the very best of what is innovation on the DeFi and Web3 world. So, trying to make that happen here, and many of you are the builders of that.
Thank you. And one sentence is very hard. I'll try to be brief anyway. Sergey Nazarov mentioned earlier today on the stage that the financial crisis, the Lehman crisis, 2008, created Bitcoin. And it did one other thing. It motivated the G20 leaders to create the global LEI system. And almost 15 years later, it seems logical that we need a digital identity for organizations worldwide in a common addressable way. And this is why GLEIF created the verifiable LEI, the VLEI. And you asked, why do standards matter now more than ever? Because we need a global applicability and a global interoperability for these things to be effective.
Well said. I think I'll have a follow-up question here for Zschach specifically. So as I think most everyone in this room knows that SWIFT connects thousands of institutions globally. From your perspective, Zschach, what are the key interoperability challenges between traditional financial messaging and emerging blockchain networks?
Yeah, I think, look, we've been in this this kind of journey now from a kind of a Web3 crypto space, and blockchains have been around. Ethereum was in 2015. It's 10 years already. There's been a proliferation of different types of blockchains, different types of token standards. There's even still today quite a disparity between what institutions are doing, the amount of different kind of formats that are out there. And so when we talk to institutions kind of every day, there's very clearly a challenge that they run into around kind of which blockchains should they be investing in or trying to connect to. How do they manage the overhead of trying to connect into every single one where you have kind of different use cases, different value propositions of each. Some are relevant for parts of their business, others are relevant for other parts of the business, but they just don't know, and it's still complicated. And so there's a massive challenge of trying to sort that out as a regulated institution, and then also balance what they've already invested in over multiple decades now, right? And so when we think around traditional standards, obviously kind of at Swift we're known for obviously standards as a kind of one of the primary registration authorities of ISO. But when you look at having a common kind of standardized data model as ISO 20022 and 15022 in the security side there's a lot of good kind of effort and investment that's gone in globally across the financial system. So commercial banks, central banks, market infrastructures, there's a lot there that can be tapped into and leveraged in coordination with some of these blockchains to make sure you still have a standardized way of accessing, communicating, and transferring value across blockchains as well as traditional infrastructures.
I agree with that, and even some of our work together, you would explain some blockchain transactions to folks, and then if you just say something like, it's just an MT542, and they'd be like, I get it, because that's the Swift message for delivery versus payment. So you can see the power of standards, because in like a simple short text string, people understand a very complicated financial transaction. And I think that speaks to 50 years of consistent standards from the Swift network.
Yeah, I mean, when you look at Swift, we're so deeply embedded in bank and institutional back-end infrastructures and back-end systems that as soon as you can enable banks to leverage existing infrastructure that they have in place today, all of a sudden what that unlocks in terms of adoption and integration is exactly what the industry is looking for, right? And so it's something that I think works best for both sides, right? I mean, we need to see that there's a gradual path towards adoption. If you're expecting people to try and kind of develop and integrate brand new infrastructures, it's going to take a lot longer and a lot more investment. Yes.
Agreed. Next up, Sandra, a question for you. So the GBBC sits at this intersection. It's actually a very cool intersection. Policymakers, enterprises, and innovators. So how do you foster kind of a global consensus around standards when you're dealing with different jurisdictions, different technologies, and they're all moving at different speeds?
Yeah. I liken the very place that we sit in this world right now as sometimes we are connectors, just connecting the dots across groups around the world. Other times we are actually diplomats. I call peacemakers sometimes, because frankly, there are lots of different arguments about terminology and how we go about developing these standards. And that's actually healthy. We're very happy to see healthy debate around how we should be looking at the future of standards for blockchain technology and beyond. And sometimes we play the role, I would say, of actually participating directly in certain projects and certain groups in order for us to actually support. Some of you may have heard earlier today the capital markets risk mitigation framework that has been launched in concert with not only Chainlink, but Swift is participating, and GLEIF, we will hopefully get you guys to participate as well. But this is, again, bringing together lots of different groups to support a global standard. Do you know why we should all care about it? It's not because it's just a nice idea. It's because anyone here who wants to scale and have this become the multi-trillion-dollar, multi-level fold industry that everyone's hoping for, which I hear a lot, you should care. So basically, I say to folks, standards have been the way we scale responsibly. And that is something that has happened in every industry, and this is no different. So I hope that helps in a nutshell explain sort of the role that we're trying to play in this space. And just for those of you who may not have seen, there was a lot of news yesterday, especially from Chainlink, but we ourselves had our own news. We've just now joined ISO TC 307, which is the blockchain committee. We have a seat at the table now to help support the adoption and more accelerated adoption of blockchain standards through that particular group. So stay tuned for more.
How do you kind of, Sandra, work with, like, you know, I feel like the last several years, different jurisdictions have had different pace. Like, I think 3 years ago, we would always say, look at the MAS Guardian framework. They're very ahead of everyone else.
Yeah.
But how would you say people or at least jurisdictions are learning from each other? Because they're all learning at different paces. And what's your kind of role in tying that together?
So I'm a glass half full kind of person, so I will give the more optimistic and positive view of what's going on. There is a lot for regulators to take in, but they are talking to each other at a level that I think, I'm a former banker, I had never seen in TradFi. Like, we are seeing the level of coordination that outside of a crisis. Crisis, yes, they will get together, but we don't want them getting together necessarily because of a crisis. We want them getting together while we have times of like contemplation and actual debate that we could have around how do we harmonize these things. I agree with you. People are at different paces, you know, in evolution of understanding and thinking. However, the coordination across regulators should not be underestimated. It is happening. It's just certain regulators have more resources, capacity building, and ability to spend their time on crypto or digital assets, which, by the way, is usually a very small piece of their overall mandate within a given jurisdiction. So let's be a little bit empathetic to, like, crypto might be and digital assets might be our world, but that is only one piece of their larger responsibility. So I'm very optimistic that we're going to continue that dialogue, and the public-private sector conversations that are happening are pretty amazing, and we should all be encouraging more of that in every jurisdiction.
That's good to hear. Christoph, so GLEIF has long worked as a legal identity identifier. I think most firms know what LEI is. What's your LEI? What's your LEI? Let me onboard you with your LEI. And now that digital identity plays a growing role in the blockchain ecosystem, how can identity standards anchor trust and compliance in this multi-chain fragmented world?
Yeah, so the BLEI had always interoperability at its core from the beginning. And of course, there are many blockchain solutions, some for very specific use cases. And if we wanted to solve digital organizational identity for each of them individually, we would not only have to repeat all the know your customer, know your supplier, know your whatever work, but also everybody who wanted to use it needed to understand and be able to use all these different mechanisms. So a global standard for digital organizational identity can help to solve the organizational identity needs of any blockchain ecosystem.
And I think you're solving a very key problem because, as most people in this room know, a public blockchain address is just a random string with numbers and letters in there. And I think, Christoph, some of your work in basically be able to create reusable credentials that are on-chain, I think is very powerful and I think can solve a lot of problems going forward. So congrats on all the work made so far with GLEIF and the VLEI.
Thank you very much.
Next question I have is for all panelists once again. And standards can drive scale, but they also can risk slowing down innovation. So how do we find the right timing, setting standards early enough to guide the market, but not so early that they eventually become obsolete in 2 to 3 years? And maybe we'll go left to right.
Yeah, I think it's a matter of the kind of the timing, the evolution of it, right? So, I mean, to your point, you can't set standards so early that it prevents innovation from happening. I think there's a hugely important part that's kind of tied into innovation, experimentation, testing this out with the market, and that's something that we've certainly kind of taken that type of approach. We've done a number of proofs of concept with the people on the stage, many in the audience and global institutions over the past couple of years, and through those experiments, through those proof of concepts, we've landed around key upgrades that need to actually be kind of integrated into existing standards, for example. So when you look at ISO 20022, yes, it's a long-standing kind of financial messaging or standard or data model, but actually we've been spending time since I think 2021 or 2022 to actually enhance that to include various kind of blockchain data elements that are necessary to transact in digital assets and tokenized assets. And all that's informed through the experiments that we've done. So when you think around incorporating now data fields for blockchain wallet addresses, digital token identifiers, greater denomination to account for kind of, the fractionalization of tokens, different blockchain ledgers as new places of settlement, we wouldn't have gotten to that level of richness had we not spent the time getting our hands dirty. And now going forward, it's the same thing. And how do we kind of evolve that into the next level, right? And so we're doing work right now we have a prototype that we demoed about a month ago at Sibos around a new standardization platform for digital assets where we can align around defining business functions with the community. So we've been working with some of the major CSDs, DTCC, Euroclear, Clearstream on this. How do we then also define the functions and the interactions that would be how people would actually interact with digital assets, and then create effectively a repository where different reference implementations around how you actually then manifest in technical token form these different digital assets can be implemented onto different blockchains in a technology agnostic way. Again, this is something that you need to spend the time and kind of getting your hands dirty with. So more to come on that, but I think there's the huge piece at the end is you then need to get to a point where you have these standards to actually drive scale, as Sandra pointed out before.
So if we generally believe the world, no matter what tech we use, has to have an element of trust in order for us to interact and transact with each other, risk management, and especially at this time of maturity, we are ready to look at risk management from a positive standpoint, which is it is a actual benefit to business for us to put in risk management practices, to come up with standards and sound practices, to then grow and elevate the conversation to a level of maturity, I would argue, that actually makes it a positive. So I understand the question marks around doing things too early, and I would agree, like putting in standards before things are really baked in, but I do believe now we are either at that tipping point or getting very close to it, or we need to accelerate the standards discussion as well as the risk management discussion, because that will foster the trust that we also need to keep building. And I want to thank Chainlink in particular, Ryan, you, but also the Chainlink team, because standards usually sit in backwaters of a panel discussion somewhere else, and they've made it a major feature because it needs to be. And so I applaud you guys for doing that.
Appreciate that. Thank you. And finally, Christoph.
I join Sandra in thanking for putting us on the main stage. And I truly believe that standards are essential to drive scale because they are foundational for interoperability of fast-moving players. Standards ensure that the core aspects of an innovation are ensured and not sacrificed just to move fast, because doing the wrong thing fast does not create value. Regarding standards too early, of course, nobody needs premature optimization, but I believe standards have also shown their ability to be adaptable over time. I give the example of ISO 17442, the LEI standard. It started out just to be the standard of the code and the reference data elements and the scope of the identifier. And several years later, it was extended with a part 2 about LEIs in digital certificates and the first way to do digital identity with the VLEI. With the LEI. And then part 3, the VLEI, added the standards about the VLEI. So standards are not static and can evolve along the way.
Yeah, and I see this theme of, a lot of these things aren't necessarily new standards. We're not creating new standards. We're figuring out how to take long-standing existing standards and make them compatible with this new technology. And I think this panel is a great display and exhibition of 3 different firms and how we're actually doing that in practice. And maybe as a final question, which is a forward-looking question, and this is for all panelists, if we meet again next year, what visible signs of progress would tell you that we're truly operating in a connected, standards-based asset economy? And maybe a follow-up on that is, do you think a year is enough to show tangible progress? Or is this going to take 2, 3, 4, 5 years? So let's start with Zschach.
Let's go reverse order for the first.
We start over here? Okay. I think 3 concrete signs for me. First would be adoption of global recognized identifiers of digital identities. Number 2 would be cross-network transactions based on common data and trust frameworks. And number 3, regulatory and market alignment on interoperability standards. And very importantly, if we can see these in action and we just don't get together here talking about them, then I see this happening. Do I expect this to happen within 1 year? Perhaps not completely, but I think we will have considerable progress based, for example, on the collaboration that has been announced recently with Chainlink and GLEIF, where we have now an integration of the VLEI with the CCID on Chainlink, and these are steps to making this happen in reality.
I will piggyback off of what Christoph said and say we'll have a couple of concrete things to look forward to in the next year. One is what the work that GLEIF is doing is being integrated across many other different discussions, including our own. So that integration on the VLEI point will continue to deepen, and you'll just see GLEIF everywhere. And that's just going to be a pervasive, ubiquitous thing. That's number 1. Number 2, from a standards work that we are doing, you will see much more out of us related to tangibles on technical partners building on top of the framework. Because the reality is, if you put a framework out there and no one uses it, so what? And the regulators like it, but they don't actually go and adopt it to actually have their jurisdictions push it out, that's like, what's the point? So the utility, you will start seeing. Where did we start? Infrastructure. Now we're going to do on-chain digital payments risk mitigation. The 3rd layer in 2026 is crypto assets, native crypto assets. So all of that comes together in a package, and yeah, it will get done in the next year. So you can hold me to that for next year. And then the final piece, when I mention utility, it is about building businesses on top. So whether Chainlink is bringing together all their partners to come up with compliance solutions, and then we are also helping to underpin some of the risk frameworks around that. We all need to figure out commonality of bringing those things together, and you'll see much more of that integration.
Yeah, I think from our perspective at the Swift side and the institutions we work with, I think next year we'll have a kind of a working MVP of this kind of standardization platform hub that I mentioned before. I do think we'll see notable progress within a year, but it's going to be an evolution over a number of years, and I think there's going to be a very clear focus on specific assets, specific kind of use cases, and specific players, and in particular, as we look at some of the larger market infrastructure entities that drive a tremendous, maybe disproportionate amount of value and volumes throughout the ecosystem, because they have such an important role in the global financial system, and so you can really anchor around specific use cases and volumes. So I do think we're going to see some material movement in some of these places, and as well as we look at kind of certain kind of token formats or certain blockchains, right? Because of course there's still a litany of different technologies, different kind of tech kind of blockchain layers and token formats out there. So I do think it's going to could also happen in a bit of an evolved cadence.
Agreed. Well, thank you all for our fantastic panelists for sharing your views, and thank you all for joining our session. Thank you.
Awesome. Thanks for having us.
Okay, everybody, welcome back. Thank you so much. We're going to be moving on to our next panel, Automating Compliance for Complex Transactions, and it will be moderated by Jefferies' Andrew Moss. Please welcome them.
I think we messed up the order.
Start? Okay. Thank you all for being here. My name's Andrew Moss. I lead digital assets research at Jefferies. So token prices get all of the attention, but our view is that beneath the surface, there's an evolution of financial infrastructure that's already underway. So tokenized asset trading and settlement is increasingly migrating from traditional systems to blockchain-based infrastructure, but a key hurdle for highly regulated institutions is really around how to deal with the regulatory complexity, specifically around privacy, AML, KYC, identity, and much more. So we have 4 great panelists with us today, and why don't we start with some introductions? Please.
Thank you, Andrew. Mustafa Al-Niyama, I head capital markets for Mysten Labs. I've joined the firm about 3 months ago from Goldman Sachs, where I headed the digital assets desk in the Americas for 3 years.
And my name is Daniel Cohen. I'm Global Head of Digital Assets and Fund Distribution for Apex. I joined Apex 4 months ago now, following the acquisition of Tokeny, which I co-founded 8 years ago, and Tokeny authored the ERC 3643, which is potentially the only framework that is gone through the approval of Ethereum to create representation of assets on chain in a compliant way.
Hi, Ryan Lover. I'm the Chief Legal Officer at WisdomTree in terms of our digital asset and blockchain-based business. I was our general counsel for our ETF business before that until we moved over and started this division about 5 years ago.
Great. Larry Wade. I head Global Risk, Compliance, and Regulatory Relations for PayPal's Blockchain, Crypto, and Digital Currencies Group. I was actually employee number 1 when we were a startup within PayPal. So the risk and compliance strategy, the launch, PYUSD, et cetera, me and my team led that.
Thank you. So Daniel, let's start with you. So Apex is really at the intersection of fund distribution and blockchain infrastructure. How do you think about automating compliance from your perspective at your company?
Yeah, so for those who are not familiar with Apex, we are the largest privately owned asset servicer in the world. We are around 30,000 people. We operate in 42 countries, and we manage 37,000 funds. I don't know if you're familiar with how we process funds today, but you will be surprised that large platforms are still sending faxes to confirm orders on funds. So when we talk about compliance, automatic compliance, there is really a stretch between what really is happening in the industry and what the blockchain permits. Now, one thing when it comes to compliance is that typically the compliance is never happening at the moment of the transaction. It's happening before or after the transaction, but as this is a process that is happening completely off-chain, you never have both the settlement and the transaction and compliance happening at the same times. So now at Apex, we are bringing this ERC 3643 framework within the Apex organization to enable to create a token that carry the compliance elements. So when you indeed have a transaction on chain, you have the compliance specification that obviously are being defined at the time of issuing the token that are embedded in the tokens, and that is therefore enabling to ensure compliance at the time of the transaction. So we really use now the blockchain as a compliance layer and not as a reporting compliance layer that we were doing in the past through manual interventions.
That's great. Larry, let's go to you. So PayPal's obviously in a highly regulated industry, right? How do you think about automating compliance in practice when it comes to digital assets?
Yeah, I mean, well, one, you cannot fully automate compliance because as long as there are humans in an organization, there's going to be a certain level of discernment with regards to governance oversight and ethical decision making. With this said, the tools that are inherent to blockchain and digital asset technology allow you to kind of really boost your control suite, which then will allow you to have a lot more fun and kind of play in that space of innovation. So the way we like to think about it is one, I cannot mess up the mothership, right? Because to your point, we have a large business. The digital asset business is extremely important, especially given Genius, et cetera. And we do have the first branded stablecoin by a major fintech that we are really looking to integrate into all of our core activities, et cetera. And from a compliance perspective, the same kind of 3 areas you want to focus on, we use the ability for blockchain and digital asset kind of analytics and monitoring, again, to boost that. So one, it's onboarding, so upfront, knowing who your customer is, knowing who your merchant is, being able to have more real-time checks, et cetera. That first hop to a wallet when you're going on chain. Being able to have that in real time, again, allows you to now push through a lot more velocity of transactions in a way that you feel more comfortable. Second, and this is big from a regulator perspective, the continuous monitoring. I will tell everyone here, when you are in a space like this and where we are on the evolution curve, the story matters so much. And I promise you, you will get things wrong. So what you want to be able to do is have a story that you believe in, that you can defend, and when things go wrong, it will not be because you did not try to do things correctly. So that continuous monitoring of nefarious and non-nefarious. Sometimes a regulator in another part of the world will say, hey, we're noticing that things are happening in some DeFi pool with PYUSD. What's happening with that? And I need to be able to have a view. And then also, let's just say that someone is a bad actor, which there are a lot of them out there. What happens when it goes back into the real world, back on your platform? So that upfront, that continuous monitoring, and then when it comes back, can we work with law enforcement and regulators, et cetera, to overall lower the systemic risk for our offering and the space? These tools really allow us to do that in a way that you just couldn't do it in the traditional finance world.
That's great. Mustafa, let's go to you. So from the Mysten Labs perspective, how do you think about using a blockchain to support compliance automation? And before you answer, maybe just explain what Mysten Labs does.
So Mysten Labs is the labs behind the SWI blockchain, which is the thing that we are known for the most, alongside a bunch of other products. It's a full stack technology. And originally the founders were the original builders of the Dime and Libra at Facebook, and they basically built the Move programming language specifically to service 3 billion users from a payment system perspective. So they spun out this as a separate thing, and the mainnet has been live since May of 2023. So in terms of automation of compliance, I have bad news and good news for you. This is not a new issue. The banks have been trying to solve for AML KYC and the cost of AML KYC for many, many decades. The estimates are there is about $60 billion spent every year by the financial institutions on AML KYC and onboarding programs. So many attempts, tens of millions of dollars have been spent on trying to create utilities, Clariant, Bloomberg Entity Exchange, Swift KYC, IHS Market KYC. Generally, all of them failed, and none of these reasons particularly have been technology. There are actually a bunch of other reasons of why these utilities fail, and the last of it is components of technology. So to actually get to a real solution, you have to rethink the paradigm and then take advantage of what the solution is. Today, one of the biggest issues among the banks is that they cannot actually trust each other and depend on the checks that are done and the verifications that are done by another institution for multiple reasons, including liability. Because if you pass a false positive or a false negative and someone relies on your KYC and process a transaction that ends up being for someone who is on an OFAC list, everybody got dinged, not only just the bank that relied on the false negative. So we actually have to think about how do we use the technology to change that paradigm. And the best way of thinking about this is that you have a set of rule books, a set of policies that are agreed on, and then you have a regulated institution that generate a verifiable, cryptographically verifiable proof that they actually have followed that specific rule book and they have checked the documentation that have been stored in a specific kind of shared storage that only the customer would allow you to have access to on needs basis. And what that does is that the rule book is agreed on, and you have cryptographic proofs that all the rules, all the checks that exist within that rule book against all the documents that have been updated at a specific schedule or based on certain events have taken place, and that's how you create the reusability. It's not that the bank is now relying on another bank to do the verification and consume that. It's that there is a set of policies that actually exist within a rule book that everybody agrees if you follow that and if you provide me with the right cryptographic proof that this is actually taking place and the client has been cleared or the customer has been cleared, only then you process the transaction. And for you to do that, you actually need multiple components. You need a settlement layer, you need a smart storage, like what we have as Walrus distributed storage, that is a cryptographic type of storage. When you put all of these components together and rethink the model that way, then you give the financial institutions a new avenue where the regulators are comfortable because you're not basically deferring your risk to someone else. You're still doing your due diligence, but you are relying on rule books that have been agreed among all the financial institutions. So that's the way that I see the technology help. Rethink the paradigm and then try to implement the technology. Don't think the technology itself will solve for the issues that have already existed, for decades now.
Great. Ryan, over to you. So as financial transactions grow increasingly complex and those migrate over to blockchain infrastructure for settlement, how do you think about automating compliance that is able to maintain auditability and transparency without compromising on many of the other aspects that blockchains enable?
Yeah, so as we think about it, we have assets that span tokenized gold, so physical gold in a vault, to tokenized SEC-registered mutual funds that span a variety of asset classes, from treasuries to a traditional money market fund to essentially private equity exposures. And so, what we've focused on is public blockchains. So, support for, nearly 7 blockchains at this point, adding to those as well. But then adding a permissioned infrastructure on top of that. And that's really the compliance layer, is that permissioned infrastructure. And the way I like to think about it is it's sort of compliance behind the scenes that is still meeting the goals of compliance, the necessities, without impeding what the investor wants to do. And I think a really good example is just transferability. So if I think about that in the registered fund context or holding stocks or the like, if I'm a traditional holder with my traditional account, and I say, Larry has an account at same traditional provider, and I say, all I want to do is transfer my 100 shares today to Larry. That is actually a pretty complex task. It's going to take more than a day, potentially multiple days to do that. Actually, go home and try it. It'll frustrate you. But what we've done is actually added then permissioned infrastructure, so verified wallets. We continuously monitor those, but those aspects are really sitting behind the scenes to the investor. And so when I want to peer-to-peer transfer my fund, I can do it. It's registered automatically by the transfer agent and happens near simultaneously. So as I think about the future, it's really evolving those compliance frameworks, having them become more complex. I mean, that's just the tip of the iceberg. Having them become more complex to be able to continue to do more complex things that are still meeting, like I said, those compliance requirements, but kind of behind the scenes without really impeding what the user or the investor wants to do, having that fast settlement, but in that transparent and compliant way.
And Larry, I guess similar question. I will assume that privacy is important at PayPal, but is decentralization?
Yeah, and it's interesting, Ryan, just before I answer that, what you just highlighted is that really, and I don't want to say for the first time, but it's more front and center, that having a solid risk and compliance strategy is actually an enabler to growing the business. And those who can actually invest in that and figure it out a little sooner, you actually can build a moat, because we're in this kind of moment of the evolution of this whole ecosystem. So it was interesting just listening to you there, and I was just immediately thinking, because I'm always trying to figure out, and I'm talking to our product people, engineers, how do I get you to yes? That way, if I have to say no, you can trust me, because we didn't start off with convince me. It was more so, what can we do? So that was interesting there. So I got excited. So you're asking me about privacy and just like decentralization. At the end of the day, there are going to be different flavors for different constituents, right? So my mom, does not subscribe to, not your keys, not your crypto. She just buys her Bitcoin on PayPal via recurring buys because her son says you should do it.
So your mom buys crypto?
Yes. My wife, my mom, my sister-in-law. It is, fun fact, all my nieces, nephews, all the children, I ceased buying them gifts for Christmas and birthdays years ago. I buy them digital assets.
Do they appreciate that yet?
To Soul, to Bitcoin, ETH, etc. So that's what I do. Oh, I appreciate it. But yeah, so again, there are elements where the decentralization matters. Obviously, when you're starting to kind of get into this kind of hybrid of the traditional financial system versus this Web3, being able to have that privacy, being able to make sure things are regulatory compliant, there's a nice balancing act there. I think that as we continue to have more regulations come online globally, I think that'll begin to clear itself up a little bit, because again, I've seen I've been in this for a while, and there was the group of throw everything out the window, it's all new, let's build it. Then there was the other group of make all of this new stuff fit in here because we've been doing this for a while. And really, honestly, it's more like a nice little 80-20, and I kind of call it my zip code method. I've said this on every single panel I've ever been on, but I'll say it till I'm blue in the face. It's 80% of what you're doing here is tried and true best practices. What's the most kind of conservative regulation you look at in this part of the world? That way, if you want to go in this part of the world and the regime's a little unsure, and then making sure that that is very tight. And then spending the time on that 20% that is really net new. So for example, when we launched transfers, we were told that there'll be less than a 1% chance you'll ever be able to open a PayPal wallet. Like, we were told a lot that we could not do that. Well, we successfully did it, but it was interesting when we were going through the new product launch, had to think of a tail risk that you never thought of before. Okay, we supported Ethereum, but technically you could send an ERC20 on the Ethereum chain. So now all of a sudden, in this wallet address, in the PayPal ecosystem, there's a coin that we don't support. What do we do with it? That is totally net new, really fun to think about. That's the stuff that if you kind of leverage those best practices, you can then kind of focus on those items. So right now, I think that things are moving in a very positive way. Genius was big. Market infrastructure is coming, that's big. I think that there are still, for those entrepreneurs in the room, a lot of things that kind of keep me up at night that I would love for people to solve. I'll throw a couple out there for you. There's free business for you guys to try to figure something out. You take the travel rule. No matter what regulator you speak to around the world, I mean, the MAS to the FCA no one fully can adhere to it in the way that the regulators want you to. Because I give this example. Let's just say I have an unhosted wallet and I'm on vacation in Croatia and that cab driver has an unhosted wallet and I want to pay for my cab ride with a stablecoin. How do you do that from a travel perspective, right? Then, because it's, okay, and then also, how do I make sure that this is my wallet? Okay, is it a Satoshi test? Is it this, is that? So like, there are lots of things to solve for. But again, we're so far down the line now where I think we have enough to build and there are enough problems to add tremendous value. And I think it's going to be a hybrid of both.
Great. So Daniel, let's go back to you. So in fund operations, compliance often intersects with investor onboarding, AML, KYC requirements. In your view, where is the greatest opportunity to reduce manual processes?
Well, obviously, on the KYC side, this is still refers the #1 pain point for the industry. I don't think that the technology will solve the KYC problem in the short term because this is not a technology problem. This is a responsibility problem. If I do KYC and I'm relying on the KYC that you've been doing, if something goes wrong, who's responsible, right? But I do believe that when we try to bridge TradFi and DeFi, those solutions will bring benefits and enable to really make use of this KYC information in DeFi protocol. For example, if you have a protocol that is limited for institutional investors, how do you enable to restrict access if it is a retail investors? So as you were rightly mentioning, Mustafa, we have proof of KYC, right? I don't need to know who you are, I just need to know that you're an institutional investor. If that is the case, then the protocol will allow you to have access to this DeFi solution. So again, we're not going to solve the KYC problem. This is a much bigger problem, and I think that only regulators will provide guidance and taxonomy to enable to unify KYC, but we can start allowing, indeed, TradFi to merge with DeFi by leveraging technology.
Great. So I think we have time for one more question, but we'll go down the list. So let's think 5 years out. What does the state of the digital asset ecosystem look like? And what does compliance look like? And where is the intersection with blockchain technology? Let's start with you.
Yeah, I mean, I think we're definitely going to see a lot of RWAs that some of them might fall, within kind of regulated securities, and some of them might be kind of under CFTC, and all over the place. We're going to see a lot of RWAs coming to the ecosystem. And in many cases, depending on who is transacting, they're going to have different Bank Secrecy Act and FinCEN requirements, so they will continue to have to, commit to those regulatory requirements. And I think at some point in time, users will be owners of their data, and they will provide that kind of evidence of their identity or, article of incorporation, if it is a corporate. All of these things, they're going to be kind of permissioned to the entities that want to do a KYC on that specific customer. And then we have sets of rules that are agreed upon, multiple sets of rules, because it's really very complex once you start getting into product and jurisdiction and all these things. But you have multiple sets of rules that get applied to that data without exposing the sensitive PII, and then generate a verifiable cryptographic proof that would allow you to transact.
Well, I think the first thing that tokenization enables is to increase transferability. Now, if you embed compliance into the assets itself, then you increase the speed at which the assets can be transferred. in traditional finance world, you typically had trade date and settlement date, which historically for certain type of instruments was trade date plus 30, trade date plus 7, trade date plus 3, now we trade date plus 1. Now, if you embed compliance into the assets itself, the logic is in the token. The logic is in the assets, and that logic goes with the assets. So therefore, no matter where the asset is, the information will be available on end. You don't have to relate to the database where the information is stored. So this information becomes available instantly. So think about the speed at which the market will evolve. If, of course, with cash on chain, now you can start doing atomic settlement with embedded compliance.
Yeah, and I think it's going to be a couple things. One is, continuing to embed these rule sets, to the extent that the compliance infrastructure can be broken down to a rule, continuing to add to those, and also interoperability. So a compliance infrastructure that's interoperable among multiple blockchains, different blockchains, and then maybe I digress a second to what I think you made a very important point, though, is that you can't get away from, though, some subjectivity at the human level. So, I think that's going to continue to be kind of a push and pull is, what are the areas where the person needs to be there to provide that human element that the rules require? The rules and regulations have terms like materiality, reasonableness, and those kind of beg the necessity for a human to be involved to kind of make those subjective judgments. Does that get layered on then maybe with some AI as well? Probably, but at the end of the day, it's sort of where are we able to find that? And then also I think, importantly, probably what I call selective transparency. So you were getting to this point in terms of, what data is absolutely necessary to verify that compliant transaction. Right now, I pretty much need to expose all my data. I need to expose my name, address, social security number, and maybe all that's necessary is one of those data points. So how can we, embed that on the blockchain and expose it in a selective way that meets the requirement, but without completely, showing my full transparent data?
Absolutely. And risk and compliance has always been a bit of an art. I think that that's only going to kind of be more front and center. I think a solid, effective compliance strategy will not only be an enabler, but it will be a competitive advantage. Again, when you're moving value, you have the attention of every regulator and government around the world. They look at this way different than a social media platform. They even look at it differently than AI, to be honest with you, because the value matters. So I think this market will be trillions of dollars larger. I do believe that nearly all assets, if not all, will eventually be tokenized. I mean, not in the next 5 years, but that's where we're going. It just makes sense the more you really lean in. And I think that, surprisingly, a lot of the friction in the existing system that's a benefit to some incumbents, I think that friction is going to start dissipating, and a lot of value is going to be unlocked in just existing flows. Because you have faster, cheaper, programmable, more transparent, the ability to automate the compliance around it, the velocity of transactions and money just speeds up. So yes, there'll be net new amazing things, but I think there's a ton of value just to fix in existing activities.
Now imagine if you add agentic payments on top of that, and now think about what's going to happen when you're moving value. You have to verify the KYC.
Yeah. And think about this: is any digital twin or agentic AI going to use? I'm sorry, not with the banks, but Swift or ACH or send you $1 or €1? They're going to be utilizing these rails. They're going to be utilizing stablecoins. They're going to be utilizing those native tokens, depending on the case. And at the end of the day, to your point, I mean, this is also an AI kind of Internet of Things play as well.
Next year, I guess we'll have to come back and talk about agentic commerce. But thank you, everyone in the audience, for joining us. Thank you to my panelists, and I hope everyone enjoyed the discussion. Thank you. Thank you.
Thank you so much for that insightful discussion. We'll now be moving on to building the global interoperability layer of tokenized finance, and this will be moderated by Chainlink's co-founder, Sergey Nazarov.
Hi, everyone. So I'm really thrilled about this panel because this is a really accomplished group of people that have been really actively moving our industry forward in many different unique ways. And also, they're all Chainlink users, which is really great. So I'm thrilled to be here with them and to chat through their views on really more than anything how to move the industry forward. But they'll do a better job introducing themselves than me, so Chuck, please go ahead.
Sure. So great to be here. My name is Chuck Mounts. I'm the Chief DeFi Officer at S&P Global. As a role and a team that was created about 3 or 3.5 years ago with the express purpose to take our historical expertise in data analytics and benchmarks and create the products and services that are relevant for digital asset markets. So the first product we launched in the space from a risk assessment perspective was the stablecoin stability assessment. We launched that about a year and a half ago, and that is measuring the risk of a stablecoin depegging on its one-to-one mark against a fiat currency. And we've recently had very exciting news about that. And another first for us, we just, with Chainlink, brought our SSAs on chain. And that was a very exciting development for us to bring our analytic capabilities and benchmarking capabilities on chain for the first time.
So I'm Dan Doney, and I have a problem. I don't have the cool title that Chuck has. I like the Chief DeFi Officer. That's much cooler than mine. I am the Chief Technology Officer at DTCC Digital Assets. We're working to tokenize. DTCC is the CSD for the U.S. financial markets, the Central Securities Depository. We're responsible for the record keeping of $100 trillion worth of assets, and we do roughly $4 quadrillion in transactions on a yearly basis. We're working to bring this onto blockchain rails, and we've got an aggressive target to tokenize our inventory, and then to produce really useful things that you can do with the tokens once they're in that form. The center of this is something called a conversion service that allows people to take their assets in traditional books and records, so your shares of Apple and Microsoft, convert them to token form on the ledger of your choice so that you can use them with the protocols that exist there. And we're introducing a bunch of institutional financial tools. For example, collateral management, securities lending, repo markets. And here we're using Chainlink and their data services in order to have real-time pricing, haircut models, rate services, et cetera, so that these collateral processes come alive, and it allows for real-time collateral mobility.
Yeah, sorry, sound folks, there's a bit of echo on Dan's microphone. Could you please fix that immediately? Thank you. Please, Lawrence, go ahead.
Yeah, thanks. First of all, a fantastic group. I think this is exactly we have everybody here to do the next $1 trillion of tokenization. So thanks a lot for having me here. So I'm Lawrence. I'm leading UBS Tokenize, the in-house tokenization service for UBS. We are a global wealth manager, investment bank, asset manager, and personal and corporate banking. And I work with all the different business divisions, looking at, what type of use cases can we find, help them to bring the use cases to life. We started in 2023 with structured notes, taking advantage of the Swiss DLT law, so create them really natively directly on the blockchain. We do it on Ethereum. And then last year we launched Euromint, our money market fund in Singapore, also on Ethereum and on the same platform. And now we're really focused and excited to build that product out as well with Chainlink, where we just announced this morning the first live transaction for the digital transfer agency standard supported by Chainlink. So I think we're getting into a very, very exciting year and adoption for tokenization now.
Yeah, it's definitely going to the next level, I think, for our industry as a whole. And I agree with you, Lorenz. Like, these are the key organizations, yours, the DTCC, the S&P, that if they get behind tokenization in a real way, then I agree with you. Literally, just these three organizations going full steam into tokenization could make it happen in a big way for our industry, which is very exciting. So this panel is really about interoperability, and I wanted to think with you folks about how you view interoperability. Why is interoperability important for chains? Why do these chains need to get connected to each other at all? And how do you view the different risks of interoperability and how you're going to think through those and how you're going to work through those risks? So Chuck, please go ahead.
Yeah, so well, you're talking our language when you talk about risks and assessing the risks. So I think that the move on-chain introduces a myriad of new types of risk, both idiosyncratic risk and market structure and kind of systemic risk. And so what we look to do is bring our capabilities to help stakeholders navigate the risk landscape to make informed decisions on how they want to kind of position in that risk landscape, but also how to think about pricing risk. And so as an independent third-party provider of risk assessments, I think we can fulfill that role in the marketplace in this digital landscape that we also do in traditional markets, with the ultimate objective, and kind of going back to the theme of interoperability, I think one of the core promises from my seat is that blockchain capabilities and the development of a digital asset ecosystem will ultimately serve to reduce liquidity silos, so enhance liquidity and ultimately lower the cost of capital for all market participants. And I think that the people up here, we're all integral to ensuring that that's the direction of markets and that we together can achieve that optimal outcome.
Yeah, absolutely. I agree with you. I think all of these new on-chain operations carry their own set of risks and benefits, and those risks need to get managed. And I imagine you folks at S&P are definitely thinking about how to assess those and how to describe them and manage looking at them in an efficient way. So it's a super interesting topic.
Absolutely, and I think one of the things that we also strive to do as, we're the world's largest rating agency. We are also the world's largest NX provider, so you may have heard of the S&P 500 as an example. So we have an ability to bring our benchmarks into the ecosystem that allows people to understand different levels of risk and to navigate and compare risk points between different operating systems or different asset classes that, once again, inform decision-making and facilitate the pricing of risk.
Yeah. Dan, how do you view the need for interoperability and the risks that it could create?
So our vision is to move the world, the U.S. markets, from a T+1 settlement structure to a T0 settlement structure. So this past year, we moved from T2, trades that settle 2 days later, to T1. It was a large achievement for the US markets, but we're not done. We have to get to T0. In order to handle T0, what that means is the disposition of all transactions, all trades, all movement of value in any form can be settled on rails in near real time. That means all financial transactions, the target is for all financial transactions to happen on blockchain rails. To do that, the transaction volume we estimate is somewhere around 1 million transactions per second. The reality of blockchain networks is a single blockchain network cannot scale to 1 million transactions per second. You have the trilemma, you have a physics problem. But you can do a chain of chains. So what we know in the long run is there will be many chains. That's always going to be true, which introduces the interoperability challenge. If there are many chains, how do you move value and data between those chains such that you can have efficient transactions? If you're not able to make this movement freely between the chains, we're really left with the same world that we had before, which was one that scales out and handles all of these transactions through various disparate systems that are not connected together and not interoperable. We need to do better. We know we can do better, but it really centers around the kinds of technologies like Chainlink has showed today that allow us to move data and value freely between the network of chains that we know is already developing. Almost on a daily basis, you see new chains coming into the market.
Lawrence?
Yeah, I think
I come a bit from two viewpoints. One is the manufacturer of tokenized products, right? And there we're interested in having, aggregated liquidity. And if everybody, we see there's sometimes different purposes why you want to have different networks. But if you want to have the asset, ideally you have the asset and the cash lag on the same place, right? But for different reasons, that's not going to be the reality, right? And I think interoperability is not just interoperability between different networks, it's interoperability between traditional systems and the new networks. Because that's where all the liquidity is, right? And I think that's where we have to look, how can we bring this together, right? That we can take the advantages, that we can start building, more and more on the blockchain, take advantage of what we have from the capabilities there, but also bring the liquidity from the traditional systems there. I think that's the biggest interoperability which we need to, do well over the next couple of years. And I also like the point, right, from Chuck. I think S&P has always had like a quite forward-looking view on what does it mean to tokenize. Well, we tokenize securities. It's still a security, right? That doesn't change. But you have tech risk. You have maybe a legal framework which you have to do due diligence. That's the second point of view. We look at, well, we're the largest wealth manager, so what we look at if we have a tokenized product to bring it in, right? And I think, how can we bring the same trust and security levels, and they have to be super high when you go into securities markets, right? It's like, crypto market has been performing well, but it's still, 2-3 trillion, and we're talking about, 250 trillion markets moving in that direction. So I think we have to have the right capabilities in place to make that work.
Yeah, those are all really astute points from all of you. I think we're definitely going to end up in a world where there's a lot of chains, there's a lot of liquidity in all the different chains. The chains need to interoperate with each other. I think it's a really interesting point, Lorenz, that you see the cash, I'm guessing the cash lag happening in off-chain systems in relation to on-chain assets, right? So, that's definitely something that we've been building towards together with Swift, together with others, about how does the cash lag and all that liquidity that exists off-chain still interact with the on-chain world in a meaningful way. And then as stablecoins become more prevalent and as collateral management is better and better, I think you'll have more and more, on-chain form of payments as well. But I think it's definitely a problem that needs to be solved. My personal view is that, and Chuck, feel free to tell me what your, how you feel about this, because it's more or less of a risk thing. Is, there will be different ways of bridging. There will be different ways of tokenizing. There will be different ways of proving things about assets through things like proof of reserves or something. And the systems, or sorry, not the systems, but the assets or the smart contracts that have less proof or have a less reliable bridge or have less information about, the underlying assets wherever they are, will probably, from your point of view, be seen as more risky, right? They'll be scored against those risks. The bridging risk, the proof of reserves risk that you could over-mint because there is no proof of reserves. These things seem to me like, obvious kind of risk considerations. But what do you think?
Yeah, I agree. I mean, one of the things that we've stated internally as we kind of build capabilities out is that a lot of the existing risks from traditional markets will remain. Like credit risk is credit risk no matter how credit risk is intermediated across markets. But there are going to be some risks that are diminished. For instance, say counterparty risk, when you go to live transactions and not T+2 or T+3 or whatever, and you take intermediaries out. So you have some reduction in transaction risk and some reduction in counterparty risk. But then you have introduction of entirely new forms of risk. It could be smart contract risk. It could be bridging risk. It could take a lot of different forms. And what's really critical is that a party like us, a trusted third-party provider, have the tools and capabilities to provide a holistic view of the risk, whether it's idiosyncratic risk that may stem from an individual player or an individual structure, to systemic risks that are going to develop as this ecosystem evolves, and as, for instance, stablecoins become maybe the largest buyers of U.S. Treasuries. So there are a lot of systemic risks that will come with the growth of stablecoins and that shift in markets. So we're taking a very wide lens at how we look at that the pathway of change for risk, including like when you think about like operating in like cyber risk in a Web 2 world is quite different from cyber risk in a Web 3 world. And like having a solid understanding of what cyber risk in from a Web 2 concept, cyber risk, what it means in a Web 3 world where those kind of risks are integrated into the very fabric of the product and the market ecosystem is something that firms like us and all stakeholders are going to have to get our head around.
Yes, I absolutely agree. I think personally, whatever the most reliable bridging system, the most reliable proving system, data system, whatever that is going to be the one that ends up allowing the creation of the best assets or ascribing the least additional risk to an asset that passes through a system, right? And so that's kind of what we're building towards in the Chainlink standards and what we're building towards with Chainlink in general. So I think that's what adds up from my point of view. But I think we should also discuss the importance of standards, because standards are really a critical aspect, I think, of what makes markets efficient and what makes innovation happen and what makes building of new things happen, is that you can efficiently build against the set of conditions that others will also adopt. And so if you're on a certain standard, that they will adopt it, and you'll have a customer base that wants to deal with you against that standard. And so Dan has a ton of experience with standards, and so it'd be thrilling to hear your views in addition to others. But let's please start with you. What are your thoughts on standards, their importance, and how you think they'll develop in our industry?
So the importance of standards can really be seen most clearly in the success of ERC20. The reason we're all here as a baseline is because there is a simple standard that represents a unit of value where you can easily transact one wallet to another and understand your balance. That is the total number of those units that you hold and operate in a super straightforward way. You can download any wallet, access any wallet provider, and it knows how to move that value. There's another standard, ERC 165, where I can look at a smart contract and it will tell me what functions it supports. So I know as one smart contract whether I can interact with another smart contract. The piece that's been missing is the data standard component. So we can understand the functions of a smart contract, but not what it means. So this is a new element, but we expect it to have the same unlocking value in terms of smart contract automation that ERC20 has had. For example, let's say S&P does a rating on a financial instrument, and in my smart contract, I want to use S&P's rating to determine if it's collateral eligible. How do I know that it was S&P who set that rating? How do I know what the possible values are? How do I know that that data's been represented in the proper format? We've developed a mechanism that allows for a decentralized database where parties are able to set standards. S&P can own their own rating. Just as an example, there might be a property called maturity date. How do you know whether it's in European format date or US format date? If you can agree on that model, if you have the property itself has its own smart contract address, we know that when we say maturity date, we mean the same thing. That allows smart contracts to reason over those objects, and this allows anything from collateral mobility to automated compliance from the previous channel. So these are big unlocks, and they're all driven by the fact that we can have reliable meaning on a central database. We work this with Chainlink on Project Calm, on corporate actions. Corporate actions, for those who aren't super familiar with the discipline, it's the connection between an issuer of an asset, that's a company, and its ultimate holders. It goes from the issuer to the transfer agent to the CSD to the custodial broker to the broker-dealer to maybe an RIA to the end user. All of those are physical systems that have to agree. There's lots of errors, enormous costs associated with that model. By introducing a common data standard, you can introduce, as we showed together with Chainlink, a model where you can fully automate those corporate actions. And that's an exciting development. There's a lot more in terms of financial processes through the use of data standards.
I think you're absolutely right. Sorry, I'm just adding more time. It's our panel, so I'm just gonna add more time. It's my conference, so I get to do that. That's what I was doing. But I generally agree with every single word Dan says. I don't even really need to hear them, but I completely agree. Lorenz, how do you view standards? What are your thoughts about them? As I guess I would say I would view you as a consumer of standards. So how would you view those?
Yeah, we are a consumer, and actually we're interested that there is a broad adoption of standards, right? Mm-hmm. One of the points why we decided to go into the tokenization journey, well, what we really liked is the open source standard, right? We use a public blockchain because it's an open source standard where everybody can bring their own capabilities, and you avoid to have custom integrations. Because then all your network effects fall away. It actually builds quite a lot of independent risk if you have to manage like unstandardized different connections. So from the beginning, we went for an open source standard as well for our smart contract. So we're using the CMT-AT, it's an ERC20 based one plus, right? Because we're doing security, so you have some add-ons there, and they have different modules as well for, if it's a debt security, you have certain standards there. So I think that's really how we started it. And now if we say we bring more and more logic from the assets on chain, again, we need standards because we want as broad as a community to be able to custody it, process it, etc. And again, if we just say, yes, we just setting whatever we'd like, whatever works best, well, next door it's not gonna work like that anymore, right? And that's what we want to avoid. So we have been always interested to work with the industry, and I think the digital transfer agent standard is again the same thing, right? I think that's what we like. It's a utility for our fund, but it's something which is a standard, so it's easy to integrate and it's composable with the existing ecosystem, and avoids trying to make the best working thingy, but just for one niche application, right? And much more, it's a broader one. And I think that's really then the utility which you get if you tokenize, because it's a standard, and everybody who can custody an ERC20 token can, for example, custody the tokens for our human, right? And now the same should be happening for any processing, any data. Standardizing data in finance has been a long discussion, is nothing new. But bringing that now on chain, how does an event look, etc., that should absolutely be standardized, and we should be able to rely then from a risk perspective also on that. So I think that's another important thing, is especially if we look now from a distribution perspective, if you have to start doing due diligence on every single asset and all the different events and how we should integrate our own systems with it, if we don't have standards, we're just not going to get anywhere, right? It's too much risk. It would be too much effort to actually be able to give access to the assets and services from which are blockchain based now.
Yeah, so it seems to me like you have problems around the servicing, the processing of transactions, the ability for transactions to work for these tokenized funds, and you fundamentally don't want to solve them. Like, you don't want to be the ones who have to figure out how transfer agency works on chain, or data works on chain, or these other things work on chain. And that absolutely makes sense to me, because in the traditional world, those aren't problems you need to solve, right? Those are problems that are solved, and at least on a country-by-country basis, those standards exist, right? The interesting thing about the blockchain world, from my point of view, is that it's not doing it on a country-by-country basis. It's doing it on kind of a global basis. So in that sense, the value of a standard is even greater than the value of a standard of any specific country. Even though I do think there will still be country-specific standards, like CMAT or others, that relate to the specific laws of that country. And then the other thing that you said many things that are interesting, but one of the things that I really picked up on is that if there isn't a standard and there isn't an assurance that, if I do it this way, then there will be a lot of counterparties that can transact with me as a result of all the effort I put into doing it this way, then the attractiveness of doing it at all is lower, right? Because you would do it some weird way, some special way that someone cooked up in your team or something, and then you wouldn't have assurances that anyone else would want to deal with you in that way, right? So the lack of the standard, it seems like what it does from your point of view as a consumer of the standard, in this case the Chainlink digital transfer agency technical standard, is it simplifies this question to a point where you have an assurance that you'll have counterparties that want to deal with you. Does that sound, which is obviously very important from a commercial point of view?
Yeah, to give it an example, right, is, for example, maybe the other side is not ready for stable coins yet, right? And one side is ready, but we want either side to be able to transact with our tokenized fund, right? And that's where, with the digital transfer agent, for example, you bring a traditional standard, which is the Swift one, but you make it compatible with the blockchain, right? So you still keep that row, and you don't impose, a way of interaction to it. And I think that's really then unlocking a lot more scale down the road, versus what we have today, where the systems don't work well together. Right? There's still kind of silos in each of their own parts. So I think that's really getting the exciting part now. And we're literally replacing fax standards into bringing into blockchain standards, right? So I think that's what makes it then also really interesting. Once you can deal with the same standard on a blockchain basis, well, I'm sure we're all going to be very creative on how we can bring new utility to that.
Yeah, absolutely. And I agree with you completely that a standard that does on-chain servicing or processing or something should be capable of dealing with both the on-chain value and the off-chain value, and as well as the off-chain data, right? It should be inclusive of all the ways that the liquidity in the market wants to interact, right? So I completely agree with you on that. So Zschach, from your point of view, how do you view standards and their value?
So this is a super interesting conversation to me, especially so you mentioned a global standard, and then also mentioned that there will be specific or idiosyncratic approaches to that at a national level with the layer of regulation or policy formation that can sit on top of or alongside those standards. And so I think that's where a firm like us can help provide transparency and decision-making to establish the benchmark between those with the specific layer over that may come from different jurisdictions to allow stakeholders to make those judgments of, okay, here's a standard, but here's how it's applied in one ecosystem versus another ecosystem based by regulatory frameworks. And us helping provide the benchmarks that enables people to understand the differences and price that. So I think it all kind of hangs together, that we all, here on the stage, we can all have a role in getting to that place where we're enabling the capabilities to be built out and for stakeholders to interact, make decisions with confidence of what the outcomes would be and what the risks they're taking in order to get there.
Yeah, absolutely. I think all these differences will need to be deeply understood by the market. So I think funnily enough, I think there'll be so much initial complexity from all the different chains and all the different things going on that as more value flows on chain, I think if S&P can move quickly enough with your help, which I'm seeing happen, which is great, that it'll actually have an exciting new booming business. It might be one of the big initial booming businesses because we're also in the Chainlink world part of fixing and reducing complexity. And, I can promise you for the next 3 to 5 years, there's going to be a lot of complexity that needs to get resolved. So I do want to, jump into some of the things we've all done together, which is, I think, timely at the conference and to talk through. So Dan, from your point of view, what is the value of putting corporate actions on chain? And, how does that relate to tokenization, accelerating, and what are the things, that we've done together to accelerate that, and how do you view that?
I think the cost estimates are somewhere around $10 billion a year spent by financial institutions to process, globally, to process corporate actions. And the problem is, as we described earlier, one system that has to speak to another system, and all parties have to agree. There are a lot of mistakes and errors and value that needs to get pulled back as a result of that interoperability problem in legacy finance. This can be fixed through the use of blockchain and through data standards. And ultimately, this leads to massive cost savings for financial institutions, but also more efficient value for end users. Things like shareholder voting. In the end, you actually don't have your shareholder voting rights in many cases, just because there's so many layers in between that you don't get to practically exercise those rights. But on a system where the issuer can come directly to the beneficial end users and can vote in near real time on corporate actions and topics of interest to the company, that's a much more active, dynamic, engaged company and investor core. And so these are all the beginning of the kinds of possibilities that will get unlocked through standard data formats riding on the perfect rail to express data, which is blockchain.
Lorenz, could you tell us what we've done together in a little bit more detail, and how that's helped move fund tokenization along, and what your experience has been like working with Chainlink?
Yeah, sure, happy to do so. Well, we really work together on the digital transfer agent standard, right? And how I see it a bit, and I got mixed reviews from that comparison, but it's a bit like a spacesuit for our fund, right? It gives a certain utility where you can do new stuff, right? So we have the fund, we have the availability, we expose the fund onto the blockchain so you can access it economically. But what we really want to do now is bring the whole fund to life on chain and be able to manage it end to end, and then really get the advantages out of that. And I think that's where the DTA standard really comes in, is it brings all these different utility points which have to be standardized to a degree, right? It's around, how do you settle it, right? Or it actually starts first from the initial event, the subscription redemption event. We want to have that standardized and processed in a secure way. And then you have calculations behind, you have possible settlement instruments behind. So I think it really is this nice Swiss knife tool, or in a spacesuit on our fund in the end, right? Which gives these different utilities around there. And then, yeah, I'm very excited to see how it's going to get used, right? And yeah, we're working with a partner, which is our distribution partner, DTCC, and they are already fully on chain, so they're very keen to use a utility like that, right? It fits perfectly into their architecture.
Yeah, I think it's been great working with the GFT and making the first live transactions with you and them over the transfer agency standards. So that's great. And Chuck, we've put on chain the SSA. I got to get this right. Stablecoin
stability assessment.
You helped me there. I would have gotten it. The stablecoin stability assessment, for a number of tokens, we've put that on chain as the first data from S&P. Could you just tell us what that is, and how we were able to work together to get it on chain?
Right. So we launched this product at the SSA, which measures that risk of stablecoins depegging. So it's not a credit evaluation of ongoing viability and default. It's looking at just a point in time, what's the risk that a stablecoin could be depegged. So we wanted to put that on chain so that our assessments could be integrated into the fabric of new products that are being created, could be integrated into portfolio construction, could be integrated into on-chain structured products that are created that maybe integrate a stablecoin into that structured product. Keeping in mind that at the moment you hit a trigger in a structured product and the stablecoin gets pulled, you need to know if the stablecoin is going to be worth the $1 it's supposed to be worth. So we felt by bringing these stablecoins on chain, we would start to embed our analysis into that next set of capabilities and the build out of the capabilities in the marketplace as a whole. But what I would say is that's just the beginning. We have a lot of hopes and ambitions to bring a much broader sense of our data sets and our analytic outputs and our benchmarks on chain to fulfill that role in digital asset markets similar to what we have in traditional markets. So this is just, in my view, a very exciting start to what will be a big kind of game plan in the coming years.
Yeah, absolutely. I think all three of these problems, transfer agency, corporate actions, ratings, and other key, indice and risk data, being on chain and working on chain well is really the start of like the formation of a working ecosystem, the formation of like a working financial system on chain that goes beyond DeFi, right? Because DeFi doesn't necessarily have these problems, even though interestingly, I think DeFi will be the first big consumer of your stablecoin assessments because they have such large exposure in their markets to the stablecoins of different types. So I can definitely see the risk teams in DeFi even automating, their exposure to different coins against something like your risk assessments, which I think will just be more and more common. But I think we're kind of really at the start of the formation of an ecosystem, right, where corporate actions can be solved, transfer agency can be solved, ratings and risk management can be solved. And that's when I think the institutions will be comfortable coming in, is when these problems that they already have solved in the TradFi world and that they've kind of conditioned their systems and their processes and their product teams and everyone, like, okay, in order for me to do this, I need a rating from S&P. I need to process corporate actions. I need transfer agency. I need these things to work. And my view is that, we're kind of in the process together with you, enabling you folks to essentially consume the service or provide the service in DTCC's case or S&P's case to build this great ecosystem of services and capabilities that's really going to take our industry to the next level. So I'm really, really thrilled and grateful to be working with each of you. I think the services that are going to be provided on chain from your organizations are going to open a new chapter in our industry. And Lorenz, thank you so much for being a consumer of the services, because without your consumption of the services, I don't think anything would be going anywhere. So it's an absolute pleasure to speak with all.
So far, so good.
So that's right. Let's keep it going in that direction for sure. So thank you once again for all the great collaboration and the thoughtful discussion on this panel. It's been a real pleasure as always. Thank you very much.
Pleasure. Thank you.
Thank you.
Thank you so much, Sergey. That was a fantastic discussion. And now we're moving on from DVP in practice, from POC to production. This will be moderated by Chainlink Labs' Colin Cunningham. Please welcome this panel to the stage.
It's a little bit of a...
I guess so.
Turn my mic on a little early. Hi, everybody. Here we go. Delivery versus payment, from POC to production. Before we dive in, I want to make sure that our panelists here have a chance to introduce themselves, talk a little bit about their view on this, and then we'll get into some questions. Meredith.
Great. Thank you so much for having us. I'm Meredith Hannon, and I lead business development for WisdomTree's digital assets business. We are a large, traditionally ETF and ETP issuer that is now venturing into tokenization. We have 14 products. We've raised almost $700 million to date, and that's through 2 platforms, a US retail platform and an institutional platform that we'll talk a little bit today about what we're doing and how we're evolving towards DVP. So thanks for having me.
Lydia?
Thanks for having me as well.
Oh, microphone, please.
Does it work? Yeah, now it seems
there
to work.
You go.
Great. Yeah, thanks for having me as well. My name is Lydia Kurt. I'm CEO at Centurion and BX Digital. Those are the 2 tokenized asset businesses of the Börse Stuttgart Group. We are one of the larger European exchange groups. We are building with Centurion a tokenized asset settlement platform, pan-European wide. We're actually just in the process of receiving the license with an expected go live somewhere end of 2026. And our Swiss venture, BX Digital, is actually the first DLT exchange receiving a license in Switzerland. We received that at the beginning of the year, and we are running on Centurion, the settlement platform already. So those 2 businesses are connected, and happy to talk about that today.
Wonderful.
Hi, everyone. I'm Nelly Zaltzman from Connexus by JP Morgan, where I lead platform settlement solutions, mouthful. What does that mean? It means we look at how we take the Connexus blockchain rails of JP Morgan when it comes to payments to facilitate settlement in the digital asset ecosystem.
Thank you all for being here. All right. So, Nelly, we're going to start with you. Let's just set the stage of delivery versus payment in the traditional sense before we start diving into DVP and some of the benefits of what happens on chain. Can you help us just set the stage there for a second?
Sure. So just the basics, delivery versus payment. You're presuming there are 2 legs of a transaction, something being delivered and something being paid for. I think the great advent of blockchain and what we're used to hearing about is the phrase atomic settlement, which means, one leg can't move without the other. In the context of traditional payments, what has long been, I think, a tension point for settling transactions is in true traditional rails like wires or ACH, that conditionality is very hard to orchestrate against an asset leg without applying a new layer of technology to it. And so we are trying to solution for that. For my job, we are trying to solution from it from the payment standpoint, and my lovely panelists are looking at it from the asset standpoint. So.
Yeah. So, Lydia, maybe a question over to you is, when we're thinking about some of the improvements, some of the benefits that we're getting in some of whether it be the trading solutions or the settlement solutions, talk to us a little bit about what are the benefits we're gathering in DVP on-chain versus off-chain?
Yes, so maybe first adding on Nelly's point, how it's currently being done is basically you have a digital registry. So an intermediary is actually looking, okay, who owns the asset, who owns which cash, and someone, easy spoken, moves the asset and the cash from left to right, but it's simply a registry entry. By moving on chain, we actually make the asset and the cash digitally itself. That allows for DVP on the blockchain and much more automated functions. To give you an example, so currently those processes of actually doing settlement takes up to 2 days, certain asset classes even 5 days. It's a very lengthy process, very cumbersome, very complex. In Europe, we even have 26 different CSDs doing that job, so it's not one cross-jurisdictional infrastructure. And those are monopolistic structures which are very costly. Now, moving on an on-chain DVP infrastructure actually implies that we can do instant or near instant settlement. It implies that we can do that at a reduced cost. So with our infrastructure as an example, we reduce costs by 90% in settlement as well as issuance. So it's a massive efficiency gain when moving DVP on-chain.
Very helpful. Meredith, we've heard a little bit from the settlement side, trading side. Talk to us a little bit, WisdomTree's view, the asset issuer perspective. How is some of the benefits of DVP and what's happening on chain, how is that impacting how you think about building products, launching products, going to market, meeting client needs on the issuer side?
Absolutely, and I think there's the cash element of this, which obviously was covered, and then there's the securities and a lot of these transactions that are inevitably wanting to be received. And I think what's unique here is that while cash through stable coins can be atomically settled, can be instantly sent, still the underlying of equities, bonds are still settling on traditional time frames and timelines, meaning banking hours and trading hours. So there still very much is work to be done across these segments, especially when you talk about regulated securities. And we're also talking about the global stage of wanting it to be crypto-like, but yet there's still securities laws, jurisdictional considerations, fund considerations. So it is very much we need to build out different building blocks before we're going to necessarily get to atomic settlement. But what we're doing is building towards that. So I'll give an example. We recently launched an on-receipt function, meaning that our clients can send us stable coins or send us fund tokens and then receive back on-chain the opposite of that trade. So it's not atomic today, but it is trying to get to be more and more native on-chain and bring those processes, to Lydia's point, and those workflows to be natively on-chain to meet those needs. So once the underlying of the securities catch up with the rest of crypto and the infrastructure, we're able to be ready and to process those transactions.
Yes, that's where we're headed. I have a question for you, Lydia. Meredith was just making a point about global scale, right? And obviously with BX Digital and Centurion, you're operating in different environments from a jurisdiction and regulatory perspective, right? When you think about, you mentioned the 26 CSDs, a little bit of the fragmentation that exists in some of the markets that you operate in. Help us understand, how are you thinking about DVP in those contexts? How is that informing or changing anything that you all do when you think about bringing or kind of transacting on chain or providing services to your clients?
Yes, so we are servicing multiple jurisdictions. Those are different regulatory environments. But what is very good about the European markets is that they're very, very far ahead in terms of regulations for tokenized securities. I know about the big boss currently in the US, where we have a lot of regulations coming and being in place. But it's worth looking a bit across the sea and see what's being done in Europe already for a couple of years. And the very interesting part is that actually we have a regulation in place now in Europe which allows us to do settlement without a CSD. So that's something that, in my opinion, having the various conversations here in the US, hasn't really reached that point yet. Whether that's something that should also be implemented in the US, because what does it imply? You can benefit from the full potential of the blockchains if you have an alternative model to settle than through a CSD. You can use public blockchains, you can use automated settlement infrastructure, you can much more efficiently settle transactions if you go away from this monopolistic settlement infrastructures that we currently have in the world. And that's a bit what unifies Europe, although it's different jurisdictions. This idea of actually allowing for an alternative settlement infrastructure unifies the different jurisdictions. So we can do that in every jurisdiction. We can do it in Switzerland. We can do it across Europe. That's, I believe, the biggest innovation benefit that we currently have in Europe and that we are using.
This idea of kind of creating like a unified experience, I think, is important. Nelly, I want to come to you and talk a little bit about when it comes to settlement at Connexus, and you think about, you know, Connexus as a private chain versus I was on a panel earlier, and we were talking a little bit about the proliferation of how many new chains are coming out every week, every month, every year. Let's talk a little bit about interoperability. How do you think about, you know, the traditional payments business of JP Morgan and what you all are doing at Connexus from a digital perspective? How do you think about kind of future path and building towards a future where we're at X number of chains today and we don't see that slowing down? How are you thinking about interoperability in a DVP sense?
Sure. So for those who aren't familiar, the core Connexus payment product is something we call a blockchain deposit account, and it lives within sort of the four walls of JP Morgan. And then we have a separate product called the JPMD deposit token, and that is issued externally to JP Morgan. And I like to say to people, no matter if we have JPMD or not, which we do, the blockchain deposit account plays an important role in sort of the sustainability of the overall offering as kind of home base to a client where they can come in and out of the banking relationship. And so when we think about the plumbing to make payment rails interoperable, the most important thing I think is that we try to do it with as much kind of neutrality to the potential chains that our clients may elect to do asset transactions on. And so one of the great things about some of the solutions we've been working on with Chainlink is that we're not actually trying to issue out assets in order to be interoperable. We are seeking to digest information to trigger smart money movement in tandem with other chains. This allows us to scale much more widely across a variety of chains and kind of follow the volume as to where our clients would like us to ingest those transactions for payment settlement, be much more dynamic for different use cases, and kind of give our clients the most optionality.
That's a great point. Meredith, we're thinking about that same interoperability principle, right? This proliferation of chains. I'm sure WisdomTree is no stranger to trying to keep up with, understand, figure out where does distribution go, where is demand forming. How are you all thinking about interoperability and kind of making, inserting yourself into this, maybe less from a POC perspective, but maybe more from like production forward-looking basis?
Absolutely. So we're on 7 chains today that we're able to mint onto, and that's a huge focus too of ours, is to think about not only the commercial viability of it, but where is there real demand and where is there real distribution. And I think that ties back to also the DVP and atomic settlement one is, what are those funding mechanisms? So if you think about a distribution platform that may have clients that have cash that now want to enter into this ecosystem, how are they able to on-ramp that cash? So it might be through a Connexus platform, it might be through the traditional banking system, and get access to these products in a way that's really innovative. So we're very much thinking about interoperability in terms of commercial viability, in terms of builders, in terms of where's there really demand. And I think what we're really focused on is not necessarily even just the chain itself, but also what's the client segment and how is this really a benefit to the end user? Because I think for all of us, we think that the real goal is when the technology is, not to say hidden, but it's not the main focal point of it. It's just a better investment experience. It's a better way to spend. You get your assets instantaneously, or there's some other new feature than what you would have in a Web 2 version of it. That's where you're going to see the real benefit and the real mainstream adoption. So we're continuously looking for those types of opportunities to think about use cases, but also usability and utility of these assets in a new way. And I think that's where atomic settlement, from a trading perspective, gets really interesting. If you think about what if you could earn yield constantly on assets? What if you could spend off of assets? What if you could trade on nights or weekends in a way that the liquidity is there? Those what if questions are actually real possibilities with this technology, and depending on the chain and interoperability being key to the liquidity part of that is a real reality in the short term.
Please.
I'd like to add one point on the interoperability. I think it's very good to talk about the interoperability across the different chains, but I think it's very important also to talk about the interoperability to off-chain systems. What we, for example, did is we said trading is going to stay off-chain, because we don't believe by bringing trading on the blockchain that that's going to solve certain issues we have. Trading is very efficient. We keep trading as it is, which allows, again, the banks to keep their connectivities to the different trading venues they have. So trading remains off-chain. So we integrate the off-chain trading with an on-chain settlement platform. And also within the settlement platform, we said, okay, the banks are not yet ready for on-chain cash to a certain degree. For example, in Europe, Euro on-chain cash, we have multiple stablecoins. The industry hasn't yet decided on a favorite stablecoin or on-chain cash instrument. Switzerland, we don't have any on-chain cash at all. So we needed to have an on-chain cash. We needed to have a cash which is off-chain. So we are integrating into traditional payment system. In Switzerland, SIC, in Europe, Target 2. So having this interoperability, not just within blockchain system, but also to legacy system and other off-chain system is very important in my opinion, because we cannot have, or we cannot think everything on the blockchain from day one. We need to see it more on a timeline where things move on the blockchain step by step.
And that's where mainstream, sorry.
Yeah. Oh yeah, let's go.
No, I mean, I guess one, I just say, we're not quite at day one. So we've been at this a little while, right? And I think the industry gets into trouble when we start generalizing things like banks aren't ready for on-chain cash and trying to kind of lump that in with the notion of, stablecoin equals on-chain cash always. So again, like what we've been doing for quite a long time now at JP Morgan is using blockchain infrastructure within the same legal and accounting principles that we would use off-chain account infrastructure, right? And that is simply taking the same product, but truly using the technology at its core to enhance the offering. You don't need something to stop being a deposit or a deposit account for it to benefit from new technology. Our blockchain deposit accounts are highly interoperable with the rest of the bank, while also being extremely interoperable with public blockchain through our use of Chainlink and other mechanisms, right? So we have the best of both worlds. Our clients can come in and out of the system, which is one of our strong value propositions. They benefit from programmability of the payments, which is a benefit of uplifting the technology, as well as our ability to ingest events and coordinate them amongst other chains. So I just think we need to be a little careful and clear about that. So,
Fair point. Meredith, you were going to say?
I was just going to add that I thought that from connecting back to traditional systems, I think it's important when you really want to focus on mainstream adoption, which is I think is the end goal, is that it's not just on-chain participants, but it's the masses that are able to use this. That connectivity, and also going back to what are the traditional systems and also the structure of it, and that was what I was saying too about fund structures. It's not like that's left in the dust, right? That there needs to be a connective tissue to it, and to bring that into this new ecosystem, and then also send it back, right? I think that's an important point, so that everything is able to work a little bit more cohesively than perhaps today that does.
I want to tie a couple of ideas here just around, Nelly, your comment around like the programmability of payments.
Yep.
Also with this concept of the synchronization of off-chain data with on-chain transactions. Lydia, coming back to you, you were saying that trading, in your opinion, stays off-chain, right? But you move settlement solutions on-chain, okay? When you're thinking about the data that's required for DVP-type transactions in a settlement perspective on-chain, what are the data points that are important from what you've seen in the businesses that you're building? And then maybe to Meredith's point, and this is for the group, what are the points of information if we are doing DVP on-chain? What do we need to be sending back off-chain to books and records in order for this to really move from POC to production and for DVP to really thrive?
The data point, we see the data case as an important use case that could move on the blockchain. We see massive problems in today's data distribution areas where banks have to enter the same data multiple times in different systems. So having a single source of truth in terms of data is a great case. So that's also why we are doing work together with Chainlink on that front. It's one of many use cases. For us, it's data could be one that moves on the blockchain. But as many things, I believe that we will have parallel systems for quite some time, but we can get to that in a second. And I also believe with data, we cannot say, okay, from next day, data is going to be on chain, and then that's going to be the only source. I think that needs some time, yeah.
Okay. Nelly or Meredith, any other thoughts to contribute?
I mean, I'm not the trading expert. All I would say is that when I think about transaction initiation, one of the weakest points, I think, of merging the TradFi and sort of on-chain technology is this notion that the payment needs to be, the overall transaction needs to be initiated somewhere else. I actually think that's one of the things that blockchain is really good for. Like, parties can sign the terms of the transaction with distinct keys that authenticate it, and it can set off an extremely composable process, both in terms of moving the asset, pulling in nav data when it's relevant, then triggering the payment. And it's like a beautiful, seamless process. So I just think thinking more open-mindedly about where we see this going is where I'm at, kind of.
Completely agree. And to my earlier example of on receipt, actually, that's a blockchain event triggering an action that then we take in an off-chain system. So it's a great example of how an on-chain event can then trigger something that is off-chain through a regulated system, and how those can come together. And over time, may all be on-chain, but at least for the short term, as we're talking about actual equities and bonds that are trading traditionally, it's a great, I think, building block to where we could potentially be over time.
I agree, and I think one of the things that all four of us have agreed on is that we're in this moment where we're moving towards production, right? We should be thinking in a production kind of focused mindset. Meredith, I want to come back to you and kind of think a little bit about client experience in a production environment, on-chain. As we proliferate there, what are some of the improvements that you all are looking at or you want to see? Whether it's something that WisdomTree controls, right, in-house and you're able to affect, or if there's maybe delineate that against, here's some of the things the industry needs to do writ large, right, to see this proliferate on-chain in a more, let's say, more scalable way, if you will.
Well, I'm looking at our head of legal. There's a lot in the regulatory space, so he's quite busy for everything that we're talking about here. And even, I'll just give a small example of something that's changed. We have a transfer agent, even going from integrated record keeping, from having off-chain books and records and then an on-chain copy to integrated record keeping. It seems like such a simple change, but that actually required a significant amount of work from a regulatory perspective. So it's even minute changes of that, of recognizing from a regulation perspective of what we're doing as being the source of truth on-chain. I think that's a good example of this too.
Can I jump in real quick? Just the technical side of that versus the regulatory side of that. Can you just parse that out quickly?
Sure.
Or technically, it's like we're there.
And
from a regulatory perspective, it's got a ways to go.
So we built it where it's integrated record keeping, right? So that our transfer agent has one book and records, essentially. So from a regulatory perspective, that view was important, but from a technical perspective, we were there, right? So I do think that is an interesting point. And I'd also say, too, to what we can control, a lot of what we're doing is client-driven and demand-driven. Of clients are saying that they're looking for specific on and off ramps, meaning cash, or specific products, and we can build to that, or some of the features that I've discussed earlier. But then there's this larger aspect of, and at least, again, talking from an asset issuer perspective, what's the underlying and where is that being held? And again, as long as it's going to be custodied in a traditional custodian and not necessarily on chain, I think that's a lot of the work of what you all are doing, of how we can bring that more and more on chain and have it natively on chain. There's still going to be this time delay. That is just the fact of the underlying, and not necessarily that tokenizing these funds magically makes them more liquid. It means that there can be potentially a secondary market, but it doesn't mean that the underlying is going to fundamentally change until those changes are made. So I think there's a few different pieces. Regulatory, also from a structural technology perspective of what's accepted and what's put on chain. And then from a demand side too, I do think it's more and more mass adoption. We're still very much playing in terms of the realm of the on-chain economy. And I think more and more as more mainstream types of platforms are starting to integrate with blockchain systems, that we'll see more adoption, which will drive and fuel even more growth.
Lydia, how do you feel about BX Digital and the place that you all sit within this concept of kind of like mainstream adoption? And what does that take for your business as you think about going into production, going into scale? What is it going to take for that to be successful on your end?
Yes, so production is here. So we are doing pilots. We're obviously still doing pilots, but production is here as well. So we can go live. We have the license. We can scale. So really, the time of of production is here, and we don't longer have to wait for that. In terms of really mass adoption, it takes a lot of players to be involved in that space. And to give you a bit of an insight there, we are building that business, so the European-wide business Ethereum, together with large partners, meaning that they will be major partners in actually using this platform and being partners of that platform. And the conversation we have with the large banks around the world are very, very good. There is great momentum of doing what we are doing at this moment. The first partnership we announced is with Société Générale, a large French bank, who said publicly a couple of weeks ago, we are going to use Ethereum. We have roughly 10 further banks in the pipeline who are willing to actually go out and do that with us. And I think that's a major statement, because we all know that it takes time to move large financial institutions, but we see the momentum, as Nelly was saying as well. The banks are moving now, and the banks can do things that they couldn't do quite some time ago. So I think the start for mass adoption is here, and we're going to see large steps over the next few years, I'd say, yeah.
Well, let's dive into that a little deeper. So just as we think about our final question here, Nelly, we'll start with you. Production's here, mass adoption is here.
Yeah.
Everything's moving faster. The banks are coming. It's a beautiful time.
Some of the banks are here already.
Some of the banks are here. Fair enough. But it's,
Yes.
What did you say? It was a beautiful, rosy picture of the world, some version of that?
Yes.
Don't be too rosy or paint too beautiful a
Okay.
picture. But if you had to think about what does success feel like a year from now on this front, what does that feel like for you all at Connexus?
I think, well, to be fair, I think on a lot of different levels we have achieved what we feel is a success story for like treasury and cross-border use cases. DVP is kind of a unique segment because it really does involve a lot of ecosystem collaboration and buy-in. And so a success really looks like, true on-chain, as in like, Connexus or other provider payment rails being used in a cohesive ecosystem with a number of assets. And for us, we're very institutionally focused, so it would be an institutional marketplace where not only are you using blockchain but you're using it, again, for the reasons why you should be using blockchain. So the composability of it all, the automation end-to-end of a transaction on both the asset and the payment side, the benefits, frankly, on authentication that can come if you are open to triggering the overall transaction on-chain, the auditability of it, so all this good stuff, but you need real assets and you need real volume, and I think we're getting there, and I'm very optimistic.
That's great. Lydia?
So we are talking about changing how financial market infrastructure works. And I'm talking about the backbone of our financial system. That's going to take a lot of years to do so. And the technology we are talking about of actually being able to do that exists since roughly 10 years. And I'm talking about Ethereum having smart contract capabilities. So 10 years is nothing if you talk about changing the financial market infrastructure as a whole. So success looks like that if, I'm saying like maybe in 10 years or something like that, we have moved large parts of the assets on tokenized rails. And 10 years would even be a great success in my opinion. I looked up the numbers for the US. In US you had physical certificates and started with book entry securities in the 80s. And today you still have 1% of your securities being physical certificates. So it's 80 to 25, it's like 45 years, I'm calculating right, and we still have parallel systems running. That's what we need to expect, what's coming towards us with regard to tokenized securities. So we will have parallel systems for the next decades. So it would be a great, massive success if we have a majority of those securities being moved within the next 10 years.
I completely agree. I think that would be I think success is building blocks and building the right building blocks to get us to that future, and to do that as a group, I think that will be huge. So, and I would add to Nelly's list, customization. I think that's another one too that I think is a real unlock with this technology, and being able to seek success of that to really improve the investor's end experience.
So can I just press you for 1 year from now, if it's customization, is there an idea that you have in mind or a thought?
Yes, I have a few thoughts, none of which are public, but I would say in terms of this notion around, and we didn't even talk about smart contracts, but what smart contracts can mean for what investors can access and how they can access them, and what that means from their point of transaction. So what can they fund with and what can they receive back, and have that be a more seamless experience.
Wonderful. Thank you all so much for your time. Thank you all.
Thanks, Tom.
All right, next up, we have Colin Cunningham from Chainlink hosting a panel on the future of funding with on-chain repo and tokenized liquidity. So let's welcome the panel to the stage.
Back. All right. Final panel of the day. On-chain repo, tokenized liquidity. We're looking to the future. You all get to have the final word of SmartCon on day one. So excited to have you both with us. Anna and Naomi, why don't you introduce yourself? Tell us a little bit about yourself, and then Dan, we'll go to you. Then we'll get into it.
Yeah, thank you very much. Yeah, my name is Anna Naomi. I work at UBS Investment Bank at a trading team. I'm a trained lawyer, and my role is to create new products. We issue many traditional notes, structured products, and bonds, and cash solutions, and we, since many years now, also issue tokenized products, digitally native on blockchain. So my particular specialty is issuing notes on public blockchains, and it has a lot of legal finesses which are important to keep in mind when issuing notes on public blockchains.
Dan?
Thanks for having me, Colin.
Thanks for being
my
here.
name's Dan Phillips. I'm from the markets team at JP Morgan. Our team came together in 2022. So for the past couple of years, we've had about 10 people that are focused on building next generation markets products, specifically trying to use blockchains to make them just generically better.
Sounds about right. So, Anna and Naomi, let's start with you. We want to talk a little bit from UBS side, issuer side, asset manager side. Tell us a little bit, just from your view, as we look at repo markets historically, how they've worked, and you start to think about some of the benefits of blockchain technology. What are some of the inefficiencies that you might have seen in a traditional sense off-chain? And what are some of the benefits from a repo market that would emerge on-chain?
Yeah, I mean, I would say the repo market is really the very obvious perfect use case, and it's this is the reason why this is also relatively mature already. So we have these DLR, Broadridge solutions, and HQLX since a few years, and it's relatively ripe and also used in real business, so not experiments or so. And the reason is that you can get efficiencies, you even can make the liquidity buffer greater because the liquidity is much higher, and through the automation you have less failure in the trades.
Got it. Dan, I want to take that same question over to you, but give us more from the markets side of the world, right? Like you all are seeing at JP Morgan, obviously, you see the whole market. You understand, you've been built, I mean, what was originally Onyx and is now Connexus has been a 10-year journey, right? You've been there seeing most of that from different pieces of your seat on the JP Morgan market side. What are some of the things that you all look for as you think about and you look at these assets and you think about these markets? What are some of the inefficiencies that you look at on a historical basis, and what are some of the things that is the promise of the future, if you will, in these on-chain markets?
So I feel like I've got a reasonably strong opinion on this after working on it for 3.5 years. And it's going to sound trivial, but the reality is that most of the repo market works where somebody makes a phone call or enters a number on a computer and says, I want to borrow this many dollars, and I want to get it today, and I'll pay it back on another date. And the reality is that you might get that money at 8:31 or 12:45 or 2:59, and you have no way of knowing when that money is going to come. And it's kind of outrageous that we're so particular with our standards on our consumer lives. Like, if you ordered an Uber and they said that they would be here sometime in the next 8 hours, like, you'd never tolerate that. But if you want to borrow $1 billion from JP Morgan, that's what you expect. So the repo application that we've been working on for the past couple years, I don't know if we realized this when we started, but the real differentiator is that the fact that we allow people to negotiate repo trades that have a start time and an end time. So again, if you need this money to make a margin call or to fund your business in some sense, you can tell JP Morgan the minute that you need the cash, and it will almost certainly be there. I would say certainly, but there might be some lawyers here. It will probably be there, right? What we found so far is that the programmableness of a blockchain settlement system is what really differentiates it from everywhere else that we've seen.
Well, I'm thrilled then that we preceded this panel with the talk of delivery versus payment. I just want to go back in time a little bit, and maybe this is a question for both of you, but Dan, start. How did we get to that historical precedent in traditional repo markets with the example that you provided, right? Where start time is kind of, willy-nilly, if you will. How did we get there?
I don't know if I actually know the answer. Historically, I assume that at some point people were physically delivering collateral to people.
Right.
And then it was very difficult to know. It was like, you come here at this time and I'll give you the money and you give me the collateral.
Yep.
And they didn't really change that standard when all of a sudden it became an electronic transfer.
Yep.
I think that's what I meant with this is the obvious use case, because you have to move collateral from one custodian to the other. And there you can really use the blockchain, a decentralized ledger, where everyone looks at who is participating in these transactions and have the same source of truth. And there you can just have a registry how the collateral moves. And there you gain these efficiencies.
Yep. Now, here's another question I'll maybe put back to you, Ann and Naomi, on the same precedent, right? So in Dan's example, right, we're talking about you would never wait or take the plus minus of 4 hours for an Uber to come and pick you up, right? If this is, the projects that you mentioned and some of the progress that UBS has made in this space, if this is so much better from a delivery perspective, why have we not seen more flourish towards this over the last X amount of years that this has started to move on chain? Why has this not become the new norm faster, in your opinion?
Well, I think in the repo market, it is already very mature. I mean, we have HQLX has, I think, over 1 billion traded over XQLS, and Broadridge 280 million only in the US, billion. So it is impressive numbers, and the reason is because it is the obvious first step.
Yep.
I think where we have completely different picture is in tokenization of other funding instruments like bonds or short-term notes, and also in the collateralization of other assets like custody assets. There it's a completely different picture. There we are really at the start of a long journey where we say we need a certain ecosystem to be ready to have a bigger adoption. And I mean with that, we need other counterparties who need to be able to consume these assets, these tokenized assets. We need to have, and I guess Chainlink can be of great help for this, because you can help to bridge the traditional world with the traditional messages to the new world on blockchain. And I think this is the missing part.
Got it. Dan, let's switch back to you. So, good example. Now let's just go a bit deeper. Let's talk a little bit about some of collateral mobility. What are some of the other pieces, whether it be collateral mobility, settlement cycles, overall transparency for your clients? How do we think about blockchain infrastructure entering into repo markets? And what are some of the other benefits that we're going to see and some of the things that you're excited about?
So most of the work that we've done has actually been focused on optimizing the cash flows.
Yep.
Right? So there certainly is opportunity for other products to come along that improve collateral mobility. And I do feel like that has become a popular topic again this year. The idea of being able to take a traditional asset and leave it in its native infrastructure and then represent it on a blockchain, which in theory, again, is more programmable, is more transparent. The transfers are cheaper and faster. I think all of those things are happening relatively slowly. From my seat, what I saw is that some of the unforeseen obstacles actually had to do with more about regulation, right? So everybody solved the idea of using money market funds as collateral, like the operational component they solved, but then they didn't realize that it was actually, there was a regulatory angle to that problem too. So I think people are still continuing to figure out like what are the types of collateral that they really want to free up to mobilize, and then they're going to work through like what are they allowed to use and how to make that happen.
Got it. And can we just go a little deeper there? When you think about where the technology sits today, right, and the role that you play around these assets and in these markets versus the regulatory clarity or the asset selection, how would you put those two against one another? Like, are we already there from a technology perspective and you feel like that's kind of figured out and it's more regulatory catching up? Or are we still in this world where markets are kind of forming and we're trying to figure out the right asset?
I think from a technology perspective, like the process of tokenization, that has been solved.
Okay.
Right? People have slightly different takes on it, but there are plenty of products that are, like we said, are tokenizing billions of dollars of these assets, and everybody's comfortable with that. I think that the opportunity for technology, which is maybe what we're going to talk about next, is that once an asset is tokenized in one particular location, how do you make that most useful?
Yep.
Right? So if I've got an asset on chain 1, but my counterpart wants to receive it as variation margin on chain B, all of a sudden we have a new problem. Right? So I think that we've sort of matured to getting that assets on chain, and now it's about how do you use them most effectively. That is the new technology problem.
Got it. Anna, Naomi, maybe take us through that side of things for you. How is UBS thinking about this type of mobilization of the assets that you have as you think about kind of the next gen of these markets, the next iteration of, the next improvements of? How are you thinking about kind of creating the right cross-chain environment for the assets you're issued and for the investors that are holding them?
Yeah, I think one big topic is standardization. So we need standards for tokens, for terms, for the investors. We need to know, in order be able to distribute tokenized products. The distributor needs to be able to consume the token that is being created. And I think the best way, and we have also experience with that, is standards that are open source, for example, can be checked by counterparts, and then the counterpart can easily say, I can consume it, or I need to change this and this. But it is important to have a standard, because if it goes more peer-to-peer, and that's one big advantage of this tokenization topic, then we need standards. And the second topic is as Dan said, the regulation. The regulation needs to be clear and also kind of aligned in a way that we don't have a global law, but the minimum standards need to be fulfilled.
Yep. Dan, coming back to where you were kind of leading us a moment ago around cross-chain interoperability, tell us why that's important for you all at Markets, and what you think needs to be, if you think we figured out tokenization, right? What does it need to feel like as we move forward for cross-chain interoperability of these assets, and what's the benefit that accrues to perhaps JP Morgan's Markets business, and then also to the investors or the holders of these assets?
So I think interoperability becomes such an important piece because we know that it's very unlikely for there to be an outcome where there's only one option for any piece of the transaction, right? There's not going to be one chain. There's not going to be one preferred cash solution. There's not going to be one tokenization agent. So the idea is that you want to have a menu where you can accommodate the widest variety of transactions.
Yep.
So, for example, the JP Morgan intraday repo product, we have our own tokenization engine, and we've got some integrations with different collateral locations. We've added on the ability for collateral to be managed by the vendor HQLAX. So that is technically on a different distributed ledger.
Yep.
And we have a piece of technology that coordinates a DVP settlement. So you have a piece of collateral that is moving on chain A and cash that is moving on chain B. Right? So again, this is a short story to show that offering variety to your participants of the trade is critical. The other way to resolve that is that you can actually move the assets from one chain to another. So we did this sort of cross-ledger repo for the last couple of years. That was our first attempt at progressing the space. And now we're interested in taking approach 2, which is you've got an asset that has been issued on, we'll call it Ethereum, to make it easy, and suggest that we want to be able to use that in the JP Morgan blockchain ecosystem. So the idea is you can take a couple different approaches, but ultimately encumber it on its original location and then have the working version of it exist on a different blockchain. So now if your trading partner, again, wants to work in the JP Morgan ecosystem, you've resolved that for both people.
Yep. Go ahead.
If I may.
Please.
I think one big topic in terms of interoperability is also the interoperability of the traditional system and the blockchain. So meaning we need to be able to somehow bring the exposure of traditional assets on the blockchain. And this is possible, for example, through the tokenization of a portfolio, even a dynamic portfolio. So you could tokenize assets which are in traditional custody into a token, and then either change this token as some kind of strategy. In this example, the token would be the leader, and the custody assets follow the changes in the token. But it could also be the other way around, that you have a certain portfolio and that changes, so the custody bit changes and the token kind of follows the existing or the custody assets. And this is also a big part, or a very important part, of interoperability, because this way you get it interoperable between traditional assets and the move of an asset on the blockchain.
I like this interplay between kind of creating like a tokenized portfolio, right, and the custodian, and kind of this vice versa. And then I think if you pair that idea, maybe Dan, with your kind of the focus on interoperability and the importance of that moving forward, maybe a question to both of you is, those to me feel like technology kind of related like solutions that we're working towards and of utmost importance. Can you give some color maybe on like, and I'll go to you first on this, Dan, is from the ecosystem perspective, or from kind of like market dynamics, market participants around the transactions, what are some of the improvements that you'd like to see there, right? As some of the other players in the market, what, you know, obviously your time at JP Morgan Markets, right? Like, you know, the entire traditional set versus in the digital set, right, of the digital ecosystem. What are some of the key pieces we're missing just from an ecosystem perspective? What's some of the depth we need from a market participation perspective for these on-chain kind of repo markets and these liquidity, like the liquidity flywheel to really get going?
So I think that there's probably people in this room that are much more qualified to talk about the details of tokenized money market funds than me, but I'm going to try.
Yeah. Or just the ecosystem broadly, right? Like when you think about some of the participants that you'd want to see there around you.
Yeah, I mean, I think it's a pretty reasonable suggestion to think that the people that are holding this new form of asset, again, want to have maximum optionality, right? Like they know that they can redeem at a certain time, in a certain time window, and it's going to cost them a certain amount. And they can subscribe during a certain time period, and it's going to cost them a certain amount. But giving them the option to use that for something else just seems so obvious, right? And the idea of lending cash against a cash equivalent sounds a little bit quirky. But again, I think that the reality is that right now, as the ecosystem is developing, there's still some friction that makes it would make it more economical to borrow and pay a short-term borrow fee as opposed to redeem, make your margin payment, get paid by somebody else later in the afternoon, and resubscribe. So I think it makes a ton of sense, and I'm really happy that we're working together to try to offer some different clever financing solutions for this sort of growing asset class.
Absolutely. Final kind of question to both of you. Anna and Naomi, we'll go to you first, and then Dan, we'll let you close it down. When you think about this whole conference is about this converging of worlds, right? The traditional financial world with DeFi and Web3. What's the direction of travel for UBS here as we start to think about on-chain repo markets, but then maybe even broader liquidity in the sense of some of the assets that you're issuing and creating and what investors are holding? What's your dream or your vision of how those will look and interact or have value, utility in the sense of DeFi?
Well, I think for me personally, the most interesting topic is exactly the collateralization topic. So using portfolios to be able to use as a collateral. And I mean, the new thing is that you don't have to have the custodian and the receiver of collateral in one house, like it is currently. You can suddenly use your collateral in a completely different spot. And I think that gives, first of all, much more opportunity for the investor or the person who wants to use the collateral can use it suddenly 24/7 in any certain place, has instant accessibility, but it is also a possibility to create new products and finally bring a whole new picture into the product scope.
Thank you. Dan? Final thoughts.
I think my final thought is that the people at JP Morgan are as excited as most of the people in the crypto world about the sort of the new regulatory landscape in the US. And I think that the JP teams are leaning in very aggressively to try to come up with interesting products that can be sold on and traded on public blockchains. So all of the things that we've been doing the past 5 years in terms of corporate bond issuance and FX derivatives and financing transactions, I expect some variety of them to come into public chain ecosystems very, very soon. And I hope that that can kind of continue to leak into DeFi eventually.
Awesome. Thank you both so much for your time. Really appreciate it.
Thank you.
Thanks. Thank you all.
All right. Thank you so much, everyone. That closes day one of SmartCon. It's been so incredible having you. We do have a mixer event sponsored by Tron on the expo floor.
And we're not entirely done. Tomorrow, we kick off day 2, so let's see you all here no later than 9:30 in the morning for a fantastic banging day 2. Have a great evening, everybody.
Thank you.